Good morning. It is 9 a.m. on Thursday, February 17th. I'm Julie Hyman. That is Brian Sozzi, and this is Yahoo Finance Live. Let's take a look at what's going on with the futures here this morning. We are seeing something of a pullback. Seems like there's a couple of factors at work here, one of them being perhaps some worse than estimated tech earnings. That's weighing on the NASDAQ, which is indicating a drop of 1% at the open. We also will bring you the latest on the headlines out of Russia and Ukraine. Democracy doesn't die in darkness, according to Charlie Munger. It can be killed by inflation. Why the Oracle of Omaha's right-hand man is sounding the alarm on rising prices. And speaking of rising prices, used car prices have soared over the past year. That's been good news for AutoNation. We'll speak to new CEO Mike Manley. That's coming up. And record revenue that failed to impress. Shares of Nvidia down even after most of the numbers beat estimates. Those shares off by 2.5%. We will explain. Plus a look at some of the other big movers of the morning. On the upside, we've got DoorDash, which came out firing on all cylinders. Those shares up 22%. On the flip side, Palantir disappointing investors. Those shares among those tech disappointments I mentioned that are weighing on the NASDAQ. But first here this morning, we got to get to another big company that was out with numbers. I'm talking, of course, about Walmart. Walmart coming out, and there's a lot to unpack here when it comes to Walmart, of course. The shares right now are up about 0.7%. Bottom line beating estimates, $1.53, which is 2 cents above what analysts had been predicting. Overall revenue also ahead of estimates, $152.9 billion, call it. That was ahead of what analysts had been predicting. And then also you have to, of course, look at the comp sales when it comes to Walmart. The U.S. comps, excluding gasoline sales, up 6.3%. That was just about in line with what analysts had been predicting. You also have to talk about a big buyback that the company's announcing. They're going to buy back at least $10 billion worth of shares, they're saying, in fiscal 2023 and raised the dividend. So that's a lot already, and there's still more to talk about. Sozzi, what do you want to dive into here?
Julie, I think you packed everything. Let's keep it moving here. Let's hit some DoorDash, talk about food delivery. No, but Walmart here, a couple interesting takeaways. One, Walmart's business, or I should say the stock, tends to be driven by the U.S. same-store sales number. That came in pretty good, 5.6% increase. Estimates were 5.5% increase. Check done, pretty good. Street also is calling out here, just according to some notes I saw in the early going here, likes that the gross profit margin for Walmart up 54 basis points year over year in the most recent quarter, despite everything that is going on with inflation. Check done. Last, the company out with an earnings outlook for this year that, based on my back-of-the-envelope math, is about 3 cents ahead of most analyst estimates out there on the street. Check done. Market likes that. What the market probably doesn't like, and I think why you're seeing the stock weaken here from that initial pop, is the pandemic is still very much with this company. Walmart highlighting that transportation costs up $400 million more than they expected coming in the quarter. Market does not like to hear that. And then secondarily, I caught up briefly with Walmart CFO Brett Biggs, and we talked a little bit about inflation and if consumers are trading down. Positive takeaway on this front here, Julie. Biggs telling me that he's not seeing consumers trade down due to high inflationary levels. And that is surprising, Julie. We've talked to P&G's CEO in recent weeks. We have talked to PepsiCo CFO in recent weeks. They have pushed through some serious price increases. So to see Walmart come out here and today and their CFO telling Yahoo Finance that consumers, by and large, are hanging tough, that is a positive. So I would say the positives outweigh the negatives with Walmart, but still, it wasn't a totally clean quarter.
At the same time, there are some other indicators where we can try to read between the lines here. Average ticket price of purchases down year over year. Overall transactions up, which is kind of interesting. Another thing that they talked about, price gaps with competitors slightly wider than before the pandemic. In other words, that sort of emphasizes something that we've been hearing from Walmart, which is that they are going to hold the line on keeping prices low. And to your point on margins, that doesn't seem to have eroded margins. You mentioned the year-over-year change in margins. We saw a quarter-over-quarter gain in gross margins of 10 basis points, so not a huge gain. But again, to your point, still directionally going the right way, right? We didn't see a decline in margins, even though we know that Walmart is keeping prices low to get people in the door. So that's a really interesting comment from Biggs. And really, I would say of a piece of with what we have heard from other CEOs, that we aren't yet seeing consumers pull back.
It was no. So look, we've heard it from a lot of the vendors that sell into Walmart, a lot of the packaged food companies. By and large, they've been able to push these in price increases. We even heard it from restaurant makers, Julie. Chipotle comes to top of mind. We heard from their CFO last week, Jack Hartung. But it is interesting. You have to take a step back and wonder what gets Walmart shares working again. Shares of Walmart are down 8% over the past year, really despite a year and a half plus of very strong same-store sales during the pandemic. By and large, pretty good numbers on the profit line. And don't think Walmart's not watching its stock price. They know that their strong performance is probably not being reflected here. They also came out, Julie, today and said they want to repurchase $10 billion worth of their stock over the next 12 months. That is a very interesting signal being sent by Walmart.
Yes, definitely so. So the running theme, of course, that goes through those Walmart earnings, as well as the earnings from many of the companies we've been talking about, is indeed inflation. So I want to turn to the three assets that you got to watch today, the three charts that you got to watch today. And the first of them is the 10-year note. Pretty basic here. If you take a look at the Wi-Fi Interactive, we have the 10-year note actually pulling back a little bit this morning. We saw a little bit of housing data coming out this morning, housing starts, building permits, and those showing that perhaps there's a little bit of weakening there on inflation and also on higher mortgage rates, but still relatively robust. We also, of course, had Fed minutes yesterday, and the takeaway from the Fed minutes from the last meeting is that the Fed is prepared to react to inflation by being more aggressive on rates and bringing up the rates more quickly. So I think that's an important thing to note. This is the 1-month chart. Of course, we have seen the 10-year breach 2% multiple times. The other asset class I'm watching here have to do with what's going on in the commodity complex. And let's first take a look at what's going on with crude oil futures. Here they are on an intraday basis, and we are seeing a decline there. We've had a lot of headlines once again come out on Russia and Ukraine this morning, and a U.S. envoy to the region talking about a perhaps imminent invasion. So that's something that markets are definitely taking notice of this morning. The Russian Foreign Ministry pushing back on some global skepticism that they are pulling back from the border with Ukraine. So oil prices as well as markets overall reacting to that. Here's the 6-day chart of crude oil futures, which have been all over the map as they've been reactive to these headlines. But the other thing that we haven't checked lately, Brian Sazzi, gold prices. Good old Haven gold here is catching a bid. We have traditionally seen gold benefit when there are concerns over geopolitical conflict. It's sort of lost some of its luster over the past several years as we have seen such a pumping of liquidity into the system and people buying more risky assets. But gold has been sort of quietly catching a bid here. Here's the year-to-date chart as we have seen stocks pull back. Gold's up 5%, Saz.
Yeah, wow, there we go. Quite the move in gold. Also seeing a nice move in lumber prices too as well. But Julie, just going back to what you mentioned, what you were showing in terms of oil prices, you have to wonder, at what point do rising gas prices in this country really make a company like a Walmart see a pullback in sales just given all of this inflation? Gas prices in some parts of the country are over $5 a gallon right now. It's starting to get out of hand a little bit.
It is, and that affects sentiment seemingly more than anything else because people are still spending, as we've been talking about. And if you looked at the retail sales that came out earlier in the week, gasoline sales at gasoline stations were actually down, which is pretty interesting, given what we have been seeing with those gasoline prices. Well, there's somebody else who has been weighing in on all of this inflation, whether it's in gasoline and food or in some of the other items we were talking about. And that is Charlie Munger. Our editor-in-chief, Andy Serwer, had the chance to talk to him yesterday, and he made some very interesting comments on the inflation front.
We think it's way overdue. We ran a campaign last year. We were, I think, very reasonable. We added 2 directors. We gave it some time to play out. And unfortunately, we had probably one of the worst years, for any retailer last year, for Kohl's from a top line perspective, from a stock performance perspective. And when we see the maneuvers they've made, putting in a poison pill, rejecting bona fide offers, we hear the level of interest that's out there. we really see a board that we think behaving somewhat disingenuously. They seem very self-serving, very entrenched. They seem intent on protecting their jobs over creating shareholder value.
Well, that was obviously not Charlie Munger. So hopefully we have the sound from Charlie Munger. But the point is, he was talking about the risk of inflation and what we have seen in some nations around the globe throughout history, and what has happened when we have seen spikes in nations. Now, typically, what he referred to and referenced were sort of more emerging market nations where we have seen unstable currencies, where we have seen inflation. But nonetheless, his point is well taken that you can get certainly populist concern, and even worse when you do get spikes in inflation.
Yeah. Julie, I know we're supposed to be doing serious news here, and what we do is in fact serious, but Charlie Munger, he's just good TV. He's just fun to watch. He just lets it all hang out. He was also talking about crypto, compared it to owning it if one had a venereal disease. Munger, he pulls no punches. Just can't get enough of Charlie Munger. But I think to your point, he was referencing really more democracies overseas and emerging markets, and obviously democracies in the United States dying because of inflation.
If you look at the situation with inflation, though, obviously what this speaks to is the acute concern that the market currently has over the rise of inflation, the acute concern that the Fed has, and the fact that the Fed has said it is going to be aggressive. It doesn't use the word aggressive, but I think we can safely use the word aggressive when you look at the minutes yesterday and the Fed saying if inflation does not move down, as the Fed expects, it would be appropriate for the committee to remove policy accommodation at a faster pace. And that fast pace is indeed what is causing some concern out here.
I really do. If you read the tea leaves, of course, I think investors are still digesting what Jim Bullard has said in a couple interviews over the past 2 weeks. But still, you do get the sense that March is shaping up to be a very volatile month for the markets as the Fed ultimately moves on rates, likely mid-month. And also reading the tea leaves, Julie, I would argue that we are set up for that 50 basis point rate hike in March. Just given everything we've seen on inflation from companies, look what Walmart had to say in terms of inflation today, CPI, PPI earlier in the week. We have just gotten a continued barrage of very hot readings.
We have, and that's something I want to ask Mohamed El-Arian about. He'll be joining us at the top of the next hour. 50 basis points. I'm curious what Mohamed thinks and whether the Fed really has a choice in the matter. In other words, do they have to do 50 basis points at that meeting and then maybe trail off and diminish the size of rate hikes as the year goes on? That is going to be a very interesting part of that conversation. Coming up, though, in just a bit, we're going to be digging into those AutoNation numbers and trying to figure out what the future of car prices, particularly used car prices, is in the United States right now. Mike Manley will be joining us. Just took over as AutoNation CEO from longtime CEO Mike Jackson. He is an auto industry veteran coming from Stellantis, Fiat Chrysler. Going to be really interesting to get his perspective on all of this. Keep it right here.
AutoNation out with some stunning earnings results ahead of the market open here. Let's welcome in AutoNation's new CEO, Mike Manley. Mike, good to see you here this morning. How do you explain results like this? Inflation has been a key topic amongst all the executives we talk with, but how do you explain consumers willing to spend even more for new cars and of course, used cars?
Well, I think there's a few dynamics that are ongoing at this moment in time. Obviously, the supply of new vehicles, as everyone's been talking about for months now, has been incredibly tight. We're at the lowest levels of inventory that we have. So even though new vehicle volumes are down 20%, so they're down 20% in the quarter, margins are obviously up. And we can talk a little bit about that as well. But where I think AutoNation have really done well is what I call structural changes to the business. You know, our used car volume is up 20% in the quarter, driven from same-store sales plus the additions. Our after-sales business has improved as people are driving more miles, and our F&I product sales have done well. So when you get that combination with good new car margins, you end up with a great quarter, and I'm really pleased with what the team were able to deliver.
Mike, from what you can tell, have we seen the peak in used car prices?
You know, it's very difficult to tell, but what I would say from the information that I look at and all of the data that comes across our used car team, I think we've begun to see mitigation in prices, particularly in vehicles 2 years and younger. I think it will be a little while before that filters through all of the other price bands, but it's begun, and I think it will continue throughout this year. So I do believe we're going to see that mitigation. Obviously, we'll run into interest rate hikes, so affordability may be a question later in the year, but I think we've seen the peak and it's now going to come down.
Mike, how concerned are you about rising interest rates and how that might impact your shopper?
Well, you know, we've obviously enjoyed the benefit of rising prices, but if I take used cars, for example, the actual margin on used cars, if you go all the way back to 2018, has only fluctuated about 1%. So the benefit in the margin, the per unit margin that we've enjoyed really has come through from that increased pricing. So as we see mitigation in pricing, I think that will be offset obviously by interest rates. So what you may find now is that because we have such a large pent-up demand for used vehicles, a number of those buyers, as we get additional stock in the marketplace, may downsize or may reduce the options that they're looking for to maintain those monthly payments. And those others that are still waiting for their used car of choice, I think will continue to buy. So it's going to be a combination of that mitigation in prices, partially offset by interest rate increases, I think.
And Mike, if you look at the competitive landscape right now, obviously the car market is always pretty competitive, right? But you have a lot of new entrants in the market, or relatively new entrants in the market that are online native businesses. How do you retain market share in that kind of environment? And you know, especially in an environment where prices are going up, are you guys, you know, offering anything in the way of pricing to try to keep customers coming in?
So, you know, when I often get asked about new entrants into the marketplace and what is going to be the response of the so-called traditional retailers. And I tend to turn that around because what we're actually seeing is the emergence of a preferred buying channel from our customers. And we, as a big automaker, the leading auto retailer, have obviously had to adapt in the past to changing buying patterns and how people want to understand vehicles and go through the buying process. So what we have been building and need to continue to build is a much more seamless digital interface that enables customers to access our stock, our services, our parts, whether they want to do it digitally or whether they want to do it physically. So that's been a big focus, a big investment, frankly, through this pandemic period. And I think if we get that right, we will be able to match the same levels of services, the same quality of services, but bring the added benefit of the bricks and mortar that I think many, many people still want as part of their buying process. So for me, it's not about new entrants per se, it's more about making sure that we keep up with and ahead of consumer buying preferences, and that's been a massive focus for us here at AutoNation.
Mike, you're likely to be, or you're going to be the CEO that brings AutoNation into the electric vehicle future. You know, is that one of your biggest priorities taking over now? I imagine you have to probably hire different service technicians. You have to build EV charging stations in your parking lots. How are you thinking about it?
I'm thinking very much as this is the future of automotives in this country. I saw it when I was on the OEM side. I'm fully convinced that this is going to happen. The transition will begin slowly, but we will reach an inflection point, and we need to be incredibly ready for that. So I have already started investing ahead of that curve. Over 75% of all of our locations will be full charging stations by the end of the year. The balance of those, we're in process of working with our OEMs in terms of what are they actually looking for, but as soon as we understand that, they will be put into our program. And by the way, this will also include our standalone used car sites. And you may ask, why are you doing used car sites when electrification will take years to get into that? And for me, it's about convenience for our customers. We'll provide a network of charging stations for our customers with other amenities so that we make that transition for them as smooth as absolutely possible. Now, you're quite right. We need to retrain internally as well. We, for many, many years, are still going to be dealing with a very large quantity of gas combustion engines coming into our workshops, but an increasing mix, obviously, of EVs. So it's important for us to invest in training, not just for our technicians and our service advisors, but also our sales executives, because we know when we talk to customers about EVs, the level of information, particularly in the early stages of adoption, needs to be much more granular, much more detailed, and we need to take much more time. So we're also thinking about that customer journey, really, and what does it mean and how can we be part of this transition? So yes, we're investing. Yes, we're convinced it's going to happen. We're not going to walk away from a very strong base of customers that we have, which is over 11 million and growing in the existing gas combustion engine area, but we're going to make sure that the group is well positioned, not just in terms of traditional services, but this is going to open up the market for other non-traditional things that haven't been done yet in retailers, and we're going to make sure we're there as well. So I'm incredibly excited about that transition.
And Mike, you talked about an inflection point that we are coming to in terms of electric vehicles. I've been sort of trying to wrap my head around. Right now, it's a push from automakers in terms of product, right? A lot of talk about investment, a lot of talk about product. What does the pull look like from consumers? In other words, what kind of interest and demand are you seeing from consumers at this point?
Well, I would say that at the top end of the pricing range, we are seeing a significant increase in interest in full electric vehicles, as well as plug-in hybrid vehicles. For the inflection point to really happen, I think two things have to be in place. One, there has to be more infrastructure available for users of full electric vehicles. The demand and the interest that we've got today are from people that will have charging stations in their offices, they'll have charging stations at home, but we've got to make sure that these are publicly available as prices come down. And that for me is the critical thing. We are not yet at the point where we have an offering that really caters for the heart of the market, and we've got to get to that area. And when I talk to automakers, we're launching, I think it was 150 new EVs and plug-in hybrids next year, and that will continue. What will also help is when the technology and the battery chemistry begin to really drive those prices down, and that's when you're going to see, I think, more adoption. But from a retail perspective, we can't wait for that, because we also need to be investing ahead of the curve. We also need to demonstrate the fact that we are knowledgeable in this area, that we're a go-to brand, and really continue with the work that AutoNation have put in for many years. So inflection point will not be there for mass market in this 12 months or the next 12 months, but it certainly will come, in my opinion.
You're the new guy at AutoNation. Mike, what do investors need to know about you? Do you race cars on the weekend? What's in your garage? Tell us.
Well, you probably know from my profile, one of the things people talk about is, I'm a workaholic. And I don't tend to put it in that way. I love retailing cars. I started retailing cars when I was a kid. I'm super pleased to be back to retailing cars, because I've always thought about it as not just providing great pleasure to people, because everybody loves a new car, there's no doubt about that, but also solving problems. And it's something that's in my blood. So for me, to a large extent, as sad as it may sound, I enjoy walking through our dealerships even at the weekend. So as things settle down, maybe I'll learn to play golf.
All right. All right. Well, enjoy those dealership visits. Appreciate those hard efforts. Looking forward to continuing to talk to you. AutoNation CEO Mike Manley. We'll talk to you soon. All right, coming up, a little bit of a comeback quarter for Cisco, and the markets liked it. And then DoorDash blowing the roof off its latest quarter. More on these names making big moves this morning. Next.
This is Yahoo Finance Live. We are heading to the opening bell here on this Thursday morning and looking at a lower open, Brian Sozzi. It looks like NASDAQ futures are down the most. Yes, indeed, down 0.9%. We keep watching the headlines out of the Russia-Ukraine situation. The latest I'm seeing is that President Biden says the probability of invasion is, quote, very high. He was speaking to reporters just a little while ago. He said he has no plans to call Vladimir Putin of Russia at this point. And on the flip side, IFX wire service is reporting that Russia says there is no Ukraine invasion and none planned. So obviously competing headlines continuing here, and the markets continue to sort of jitter around, if you will, as we are watching all of that. That in addition to the Fed minutes coming out yesterday, focus on inflation, your earnings coming out after the bell yesterday and this morning, all of this equaling some trepidation in the markets this morning. And by the way, we've got oil prices down this morning. So in terms of those inflation concerns feeding through to higher oil and then to pressure on stocks, that doesn't necessarily seem to be the narrative. And there we had the opening bell and that lower open that we were predicting. And I want to dive right into mover saws because this is an important part of the story this morning. Let's start with NVIDIA, the biggie, the biggest publicly traded chip maker at this point. And the company's numbers largely looked strong, yet the stock has been trading lower. It traded lower after the earnings last night. It's been trading lower this morning. So let's take sort of the big headline numbers here. Earnings per share, $1.32. That's 10 cents ahead of estimates. Sales from NVIDIA, $7.64 billion. That's ahead of estimates. So there, things looking pretty good. The company also came out with a forecast that looks like it leaves room for it to miss estimates. First quarter revenue is going to be $8.1 billion. That's ahead of estimates. And the shares are down 5%. This is something we were sort of trying to wrap our heads around this morning.
Yeah,
Gross
this is
margin, yeah, I don't know. Go ahead.
This is almost what we saw at a Zoom Info yesterday, where perfect is not perfect enough when it comes to NVIDIA. I look at these. I tweeted this morning that NVIDIA is getting a raw deal in this quarter, and it really is. And gaming sales up 37%, data center sales up 71%. The only really red flag, and I can't even call it that, was auto sales down 14%, but that's in large part because of the production cutbacks at the major automakers. This was a very clean, very stellar quarter here. If anything, and some of the chatter I'm seeing on the street this morning, Julie, is a tiny bit of disappointment, believe it or not, with data center sales only up 71%. Now, NVIDIA went through great length last night on the earnings call, acknowledging they're still seeing some supply constraints for chips in data centers, but still, this is a big quarter year over year and also sequentially. Let's keep in mind here, chip makers like an AMD and NVIDIA, they get judged on how they did in the preceding quarter because the results have been so off the charts. By and large, this is a big quarter. I don't know why investors weren't here. Absolutely bonkers.
Well, just to offer a little more perspective here, I do think there is a focus on that automotive revenue, right? Because as you said, yes, there are some things to explain it, but nonetheless, it did come in below estimates. And that's an area where NVIDIA has not traditionally has been expanding aggressively. It's also a very competitive area because pretty much all the chip makers now are trying to make their bones in the auto business. NVIDIA earlier in the week announcing a new partnership with Jaguar Land Rover on that front. So the fact that NVIDIA has been emphasizing that area so much and that it's disappointing, I think is something perhaps for investors to pay attention to. Gross margin, by the way, also an important area for NVIDIA. That coming in at 67%, which was pretty much in line with estimates, but perhaps there were some hopes for it to come in above those levels. Analog Devices, just as an example and point of comparison, reported gross margin of 72% yesterday when it came out with its numbers. So that's something to keep in mind. There's also the stock perspective to keep in mind. Yes, NVIDIA is down more than 20% from the record high where it closed in late November. Yes, most definitely. But it's still up 80% over the past year. And this thing has been a monster performer over the past several years. So even though in the immediate run-up to this earnings report, you didn't necessarily have a lot of optimism baked in, this is a company where traditionally expectations have been pretty lofty.
Well, I defer to you on all things NVIDIA, Julie. You are indeed the NVIDIA whisperer here, but I will just add this. If you're looking at making a trade here, is it AMD or is it NVIDIA on weakness? Obviously, we're not telling you to buy any stocks out there, but AMD has an interesting setup. They just closed that Xilinx deal that we talked to Dr. Lisa Su, the CEO of AMD, earlier in the week. They're likely to come out in the next few weeks and issue some pretty optimistic guidance. Let's keep in mind their guidance that they have issued for this year does not include that likely sales and profit boost from Xilinx, so that could be a pretty interesting positive catalyst.
Yeah, we'll be watching that one. Speaking of guidance, by the way, Cisco came out with some guidance, of course. The company talking about the current quarter, the shares are up by 3%. Sales, it says, are going to be up 3 to 5% in the current quarter. That's pretty much in line with estimates, but nonetheless, still giving the stock a boost this morning. Also, perhaps giving a boost is the expansion of share buyback authorization. So that also helping matters here, Saz.
Yeah, the only thing I'm really, overall, pretty good quarter from Cisco in their recurring revenue streams, also their service business. I know they've been really trying to pitch Wall Street over the past 6 months that they should be seen more as a service company, more higher margin business than just selling lower margin hardware of switchers and routers. Overall, pretty good. But the thread I am tying together here, Julie, is that the chip supply shortage, it continues. It's not getting any better. I have a story on the Yahoo Finance homepage right now with some commentary from Cisco CEO Chuck Robbins saying he's not sure when the shortage will end. And the CFO, Scott Herron, talking about maybe it's later this year, maybe it's not. We also had Lisa Su earlier this week, as I mentioned. She's not seeing much of an improvement in the chip supply situation until perhaps next year. So this is, it's worrying, especially if you like trading those automaker stocks. That's why a lot of these automakers are cutting back on production because they just don't have the chips.
Yeah, exactly. Those shares, by the way, extending their gains even as we watch here out of the gate this morning, now up by about 3.5%. But there's one stock on a percentage basis that is blowing it out of the water. I'm talking about DoorDash here this morning. And indeed, it is trading back above the IPO price, which was $102. That's what we were watching for this morning. It's at 110. That is a 16% gain for shares of DoorDash. So let's run through some of the numbers that we are watching from DoorDash here. So you look at a little bit of a wider loss than estimated, but the company's revenue slightly above estimates. Look at some of the other metrics here. DoorDash saying during the quarter, customers placed 369 million orders. That is an increase of 35% year over year. So we are definitely seeing usage of the platform. It is going to be interesting to see once we see this Omicron fade, will we continue to see that kind of volume? I think that's going to be interesting for all of these companies, but the company also coming out and raising its guidance. So perhaps allaying some of those concerns that would otherwise be there.
Yeah, I really love this earnings call last night, Julia. DoorDash's co-founder really talking about how this quarter perhaps busts that myth. Just because people are out there going out to eat more, they're not going to order food at home. And I would have to argue, this is a record quarter for orders from this company. Monthly active users at 25 million, very, very strong. Also, membership, the retention of customers appears to be at a record, just according to a note I just received from the folks over at Wells Fargo, analyst Brian Fitzgerald. All in all, a pretty good quarter from this company.
Yeah, I'm sure that, cooking at home fatigue. Speaking personally, I will not be stopping ordering.
Thanks for not inviting me over. I appreciate it. Thanks for no invite. Appreciate it.
If you want to drive to Jersey, you are more than welcome at any time.
Got you on the record. I set you up for it.
Okay, all right, that's all right. Before we go to break, just want to check once again on shares of Walmart following that company's earnings report, stronger than expected numbers coming out earlier this morning. Those shares are up by about 1.6% here this morning. We wanted to look at some of the other discounters, if you will. Target, of course, the most direct competitor, and those shares are down a little bit this morning. It reports next week. Dollar General, Dollar Tree, also trading mixed here in TJX, rounding that out. Coming up next, we're going to check in with our Jared Blickery on the floor of the New York Stock Exchange. He has been watching all the early action. We'll be right back.
Let's head over to the New York Stock Exchange and check out Yahoo Finance's Jared Blickery. Jared.
I know we're talking about the New York Stock Exchange here, and this is where I am, but we got to talk about futures because I'm seeing a lot of different futures. It's kind of a mixed action today. Crude oil, a lot of the energy market down right now, but I'm looking at the Wi-Fi Interactive, and we have some base metals popping right now. Also lumber. So let's get straight to crude oil. That has been in focus because of the Ukraine situation. And here we can see, ever since we popped up to about $95 per barrel, as you can see on your screen there, just a few sessions ago, we've basically been consolidating this range. And so it looks like 88, 89, 90, that could be a bottom here. Have to see what happens, but really haven't seen much action to the downside in crude. Every single dip has been bought within 1 or 2 days. Then you take a look at other metals, like here's palladium. This has been jumping since Russia became front and center in the news here. Let me just put a line chart there. You can see popping up recently, although it has been depressed. A lot of these commodities, like lumber, which I'm going to show you right now, had huge run-ups and then huge fallouts. So here's a 2-year of lumber. We can see that peak well above $1,500. And we haven't seen those prices. Those were record prices at the time. Came all the way down, shed 2/3 of its value down to about $450 and change, and then we're right back up to $1,230. So incredible movements in the commodities markets. And obviously it doesn't have to do all with Ukraine. A lot of it has to do with inflation and expectations therein. Now, I want to get a check also of the S&P 500 because I've been talking about this chart here. We came back, we weren't able to puncture 4,600 to the upside, and then to the downside, it looks like we might have had a false breakdown, but not necessarily. Still kind of in no man's land right here, just kind of punching around. We've had several low volatility sessions, and so I think we're simply waiting for the next catalyst here, and we'll have to see what brings. I want to go back to the heat maps and also check out the sector action for today because we are seeing energy as a sole sector that is in the green. Financials are, it looks like financials are leading to the downside off about 1 1/3%, followed by materials, healthcare, and industrials. So all in all, kind of a little bit of a risk-off action to the start of the day here, but not too much volatility so far, guys.
Thanks for that lumber analysis, Jared. That's how you build a good segment. We'll check back with you later. Yahoo Finance stat of the day for you crypto fanboys and fangirls out there, 64%. That's how many folks polled in a new JP Morgan survey said they view the recent rally in crypto markets as a, quote, dead cat bounce. The remaining 36% of respondents said crypto assets have turned the corner and will continue to rally. All right, the price of chicken wings may be soaring, but that has not stopped Wingstop from frying up a good quarter. We're back with Wingstop CEO Charlie Morrison next. Welcome back to Yahoo Finance Live. Let's get a quick check of the markets here. Seeing lots of red on the screen here in the early going of the session. The S&P 500 in the red, the Dow in the red, NASDAQ is also in the red here. Watching shares of Walmart too, following the company's better than expected sales. Walmart shares one of the top trending tickers on the Yahoo Finance platform right now. And we'll be right back. All right, welcome back to Yahoo Finance Live. Wingstop putting up a pretty savory quarter here on the back of really strong inflation in various prices, but also good response to their various menu initiatives. Let's bring in Wingstop CEO Charlie Morrison. Charlie, always great to get some time with you. Appreciate you taking the time. Maybe you could settle this debate for us. There's been some stories recently on a wing shortage. Are you seeing that in your business? And if so, any sign that is about to abate?
No, there's not a wing shortage. The supply has been really tight for quite some time. The prices have been really high, and a lot of that is fueled by labor shortages in a lot of the chicken plants and the suppliers that support us. But for Wingstop, we've been able to demonstrate really strong growth, continue to add wings to our business, and it hasn't presented a challenge other than the inflationary factor that's affecting so many businesses.
And speaking of that inflationary factor, you did talk a little bit about pricing in the release and in the conference call. And it sounds like that some of the price, explain for me, please, if you would. You guys talked about that you had price increases, of about 10% or so year over year. But then it sounds like that those increases are not going to be borne out over the course of the year. In other words, if there are increases, they're definitely going to be smaller as the year goes on. Am I interpreting that right?
Yeah, last year we took about 5 points of price early in the year in anticipation, and also seeing some of the commodity increases we were dealing with. Towards the back half of the year, really in the fourth quarter, we took another 5 points of price. That's about 10 points total for the year. We're going to start rolling over some of that in the first quarter of this year, and then the rollover effect of that will wane as the year goes on. We don't anticipate taking significantly much more price in 2022, other than our natural cadence, which has always been about 1 to 2 points of price per year, and that'll take effect towards the back half of the year.
Charlie, you continue to be one of the most resourceful companies in thinking through ways just to combat this inflation. I think you've recently came out with thigh bites, using that thighs to put together something boneless and something margin favorable. What other measures are you looking at here?
Well, this is all part of a strategy of trying to utilize more of the chicken, quite frankly. We've always been great about having our wings for Wingstop, certainly the breast meat for our boneless product, but actually the ability to use the entire bird gives us a real advantage in supply chain and managing that. And it has to do with utilization. We can take more control of the supply chain by doing so and start to look at ways that we can integrate our business into the chicken business more and alleviate a lot of the volatility we've seen. The thigh bites were a great example of that. It launched mid-year last year, has been a successful campaign for us, and we expect to continue to see that grow throughout not just this year, but well into the future.
Full disclosure, I ordered 30 boneless wings for my Super Bowl party. Enjoyed the experience. So I walk into my local Wingstop. I saw a lot of digital orders. I was packed. I mean, that's a high-class problem to have. But how large is your digital business right now as a percentage of sales? And then as you think about opening new restaurants, do you need any restaurants with seats in them?
Yeah, we have eclipsed over $1.5 billion of system-wide sales in digital alone. That represents a little over 60% of our total sales. And your point is valid. We have not opened a lot of our dining rooms since we closed them in the pandemic. Some are in the right markets, but not everywhere. We just debuted a brand new concept that has no seats in it. It's digital focused. It's already achieving over 70% of our sales is digital. We believe we can digitize every transaction at Wingstop. The next big milestone for us is ways to take care of phone orders and turn those into digital transactions. The real benefit for Wingstop and our franchisees is that every transaction that comes through a digital channel is about a $5 higher average ticket. So it's really profitable for the business, better for the guest in terms of controlling the menu and the experience. And it's something we're going to keep working on diligently.
And so kind of following up on that, you all raised your target for the eventual number of stores you want to open to 4,000. I think that's 200 target this year. How are those going to look different, or maybe even be designed differently, given that changing shift of how customers are ordering and eating?
Yeah, I think you'll see in the future a change in our prototype to become smaller, fewer seats, more digital focused. We also have started working in earnest on ghost kitchens as a key part of our strategy. The best example of that is our recent introduction of the brand into Manhattan. And we started with a ghost kitchen. We've complemented it with a couple other street side locations. We're going to continue to build out the borough of Manhattan over the course of the next year or two. But it's a good demonstration even of what we've seen in the UK. The complement of both ghost kitchens and street side locations, we think, is the best way to penetrate big markets, existing markets with Wingstop. And quite frankly, we think there's more density for us to go get by way of this strategy, and thus why we believe that 4,000 restaurants is the right number in the future.
Charlie, lastly, you got asked a little bit on the earnings call. Any new menu innovations coming up? Do you have anything coming down the pike?
You know, right now we're focused on optimizing the supply chain. That's step one, so that when we do see this inflation subside, we're going to focus on making sure that we mitigate that for the future. We recently just launched a new flavor, Orange Szechuan. It's been a fan favorite like others. Over the course of the next year or two, you'll continue to see new flavor introductions, some new ideas. But right now, our focus is on the dark meat with our thigh bites, continuing to build that business model, and then working on the supply chain.
Well, I still have not tried those thigh bites, but to your point, I have spent a little more on the app. I just keep ordering extra sauces. It's a true story. Always good to see you, Wingstop CEO Charlie Morrison. We'll talk to you soon. All right, let's get a quick check of these markets here. Seeing losses really accelerate to the downside here. S&P 500 down about 1.3%. The Dow is now down more than 400 points. We'll put all things markets to Mohamed Al-Arian, who's coming up in the next hour. Stick around. Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside the one, the only, Julie Hyman. And it's Walmart earnings day in America. Let's see how the markets are taking this better than expected read on the U.S. consumer. Well, they're not taking it too well. You're seeing all three major indices deeply in the red, accelerated losses throughout the session. Lots more focus, I would argue, remains on the situation between Russia and Ukraine. Markets shrugging off that better than expected Walmart sales quarter. Now, here are some other things we are watching for you at this moment. A stock maybe on sale. That's the first blush reaction off of Walmart's better than expected earnings. The company beat estimates on profits and U.S. same-store sales. Despite inflation weighing on the minds of shoppers, Walmart CFO Brett Biggs told me this morning on the inflation topic, quote, "We haven't seen any meaningful difference yet in how consumers are shopping." And not so fun, toy maker Hasbro finds itself in a new battle with an activist investor. We'll dive into the situation. And reclaiming the flame. Burger King parent company Restaurant Brands says it's doubling down on being the home of the Whopper. We're live with Restaurant Brands CEO Jose Sill to see what he is cooking up next. First, over to Yahoo Finance's Inez Ferre for a tour of the markets. Inez.
Taking a look at commodities, we do want to point out oil, WTI, and Brent crude. Take a look at our Wi-Fi interactive board. We're watching WTI down 1.9% right now, but trimming some of those losses. We've got, of course, tensions between Russia and Ukraine, and one oil analyst saying that the oil market has been locked in a tug of war between Iranian sanctions relief and the Russian-Ukraine tension. Looking also at gold futures, we're watching gold up 1.3%. In fact, if we take a look year to date, gold is up more than 5%. I do want to point out a couple of trending tickers on our Wi-Fi interactive board. Particularly, we've been watching shares of Palantir, which are lower after the company reported its quarterly results, down 11%. In fact, Palantir seeing its biggest decline since March of 2021. Citigroup saying saying that the results and outlook for the company showed slowing growth. And finally, I also want to point out Fastly, just plunging 30% right now after its outlook missed expectations. Numerous price target slashes on this stock right now. Brian, Julie?
Inez, thank you very much. Appreciate it. Well, as Inez just pointed out, all of these headlines coming out on Ukraine and Russia, it's a very fast-moving situation, a lot of conflicting headlines, and the market has been very sensitive to those headlines. So let's get some perspective on this, as well as, of course, perspective on the Fed and inflation. I want to bring in Mohammed El-Arian. He's president of Queens College at Cambridge University and chief economic advisor at Allianz. Mohammed, it's always great to see you. You know, we've been through a lot of market cycles, right? And we have seen geopolitical conflicts before, or threats of conflicts, that don't really seem to affect U.S. equity markets. This one feels a little bit different. Is that because of the nature of the conflict or the nature of markets right now?
It is both. The conflict itself, if it were to get worse, which is a big if, but if it were to get worse, would blow a very strong stagflationary wind through the global economy. So that factor is something that the markets are keeping an eye on. But there's also something else, as you rightly point out. We have lost our most important anchor. For a very long time, this market had the anchor of a very accommodating liquidity regime. Inflation changes all that. We can no longer depend and rely and predict massive injections by the Federal Reserve. And once you take that anchor away, you're left with a corporate earnings anchor. And that one is significant. That's why actually markets have behaved relatively well, but it's nothing like the bigger one that has gone away, which is this continued injections of liquidity.
I do want to pick up on that, but first follow up on the first comment you made about Russia, Ukraine, maybe presenting a stagflationary threat to the markets. We've seen the effect that on oil prices, right? Pushing oil prices up because of concerns about supply. Is that your primary concern here regarding that, and then the knock-on effects of that, or are there other elements that we should be considering?
So it's more than oil. If you look at Russia and Ukraine, they are major exporters of a number of commodities. And if a conflict were to break out, a military conflict, then you would have sanctions that would limit exports from Russia, and you would have disruptions in Ukraine. So the first element is simply a big cost push. Second, you would have a significant blow to sentiment, confidence, and a further blow to globalization. So that's why this is a significant thing to look at. The marketplace right now is pricing somewhere between we get a good diplomatic resolution or we stay in this uncomfortable no war and no peace. We're not really pricing in the possibility that this may be an armed conflict. I understand why that's the case, because most people think it's not going to happen, but that explains also why the market's so sensitive when there's news of some sort of problem, if you like, on the ground.
And Mohammed, if the situation does escalate, you could very easily get oil prices well over $100 a barrel, gas prices $5 to $6 a pop. Is that recession worthy for this year?
It would certainly, as I said, have this stagflationary wind. Does it mean recession automatically? I don't think so. Certainly not for the United States. It would be more problematic for Europe, because you'd also get supply disruptions on top of the price hit. But I think for the United States, don't underestimate the resilience of the US economy. I think the biggest risk to the US economy is a Fed policy mistake. That is the biggest risk.
Well, that's something we've talked a lot about before, Mohammed. So take me to the March meeting of the Federal Reserve. Do they need to raise by 50 basis points?
It's a really tough question. You know, one of the problems of being so far behind, and that's why you've heard me for the last 9 months say, be careful, the Fed is falling behind, is you no longer have a best policy. It's your least bad policy. And you've got to make difficult judgments. They could hike by 50. The argument being move in a bold manner and try to regain the policy credibility that we've lost. The problem is that they may end up pricing in subsequent increases of not 25, but 50. What if they just keep 25? Well, the market may be at first relieved that we didn't get more of a hawkish response, but very quickly they're going to figure out that persistent inflation is an issue and increases the probability of the Fed slamming down the brakes down the road. So, we have this issue now that we're in the world of second best, and there's going to be really delicate judgment calls to be made. If it were me, I would try to regain the policy narrative by only doing 25 and being very clear on what comes next. But I wouldn't validate 7 rate hikes. I think that's too much for the US economy.
Mohammed, these rate hikes, when do they start impacting the U.S. economy? Even a 25 basis point hike in March, it's still raising interest rates. What's the economic effect of that?
So the direct economic effect should be small. We're starting from very low levels. Liquidity is still abundant. I mean, even today, the Fed is still injecting liquidity. We have an inflation rate of 7.5%, and the Fed is still injecting liquidity. That doesn't stop till next month. So if it is, it's still a very liquid environment. The concern, Brian, is that there's also QT around the corner. And the market hasn't quite figured out how do you price QT. So it's put QT on the side, saying we'll get to that later. And that's why you've had a repricing of the interest rate complex without any disruptions. When you start playing around with liquidity, then it becomes more challenging. So the answer to your question is no one knows, because we haven't had a situation where we have significant QT and higher rates coming at a time when the market has been accustomed for so long on zero interest rates and just massive injections.
But do you think, Mohammed, a 25 basis point hike in March, would that do anything for inflation? Because as you know, we're seeing this inflation because we're still in the middle of a global pandemic.
Yeah, I mean, people confuse this all the time. They say the major problem, supply disruption, labor shortages, the Fed can't do anything about them. That's absolutely right. But historical episodes of inflation happen in the following way. There was some shock to the system. In the 70s, it was the oil price increase. Then next thing you know, the inflation process becomes much broad-based. That's what's happening today. And then inflationary expectations get de-anchored. What do I mean by that? In a perfect world, you want people to say, this inflation is truly transitory. I don't need to change my behavior. But because inflation has stayed high for so long, people are changing their behavior. They're asking for compensation, higher wages. Companies are raising prices. That is all adaptive. You're adapting to what has happened. The really dangerous phase is anticipatory. When you feel that to protect your purchasing power, to protect your profit margins, you need to protect against future inflation. And that's what the Fed can help avoid, is that inflationary expectations become a main driver of inflation. We're not there yet, but if the Fed is not careful, we will get there. And that's why it's important for it to show that A, it understands the inflation dynamic, because right now it has very low inflation credibility because it got the call wrong for so long. And then second, that it regains control of the policy narrative.
Mohammed, something else that we've talked a lot about is something, people keep saying we haven't had inflation for years. Well, we had asset inflation for years, right? Of all different types. And we have started to see that come down in anticipation of what the Fed's going to do. Stocks with lofty valuations in the private markets to some extent, crypto has come down to some extent. As the Fed actually embarks upon its raising and tightening cycle, what do you think the effect is going to be on all of these assets where money has just been pouring in over the past several years?
So it should come as no surprise to people that we've had some pullback. When the buyer, the most reliable buyer with their own printing press and an incredible willingness to buy, when they step out of the market, that is a fundamental change to the marketplace. So it shouldn't come as a surprise that we are lower because 120 billion a month of asset purchases are disappearing. Now that need not be disorderly. If you can establish and you still have strong fundamentals, people will come in and take the leg up based on something much more lasting than a liquidity regime. The concern we have is by being late, the Fed also puts economic growth in play. And that means earnings become more uncertain. So that's why this is a very delicate period. There is still a window to get this right. But unfortunately, that window is closing. And the last set of data, the CPI, the PPI, and the retail sales, just give you a sense of how far the Fed is and how much more difficult it will be to get a soft landing.
We're all holding our breath, so to speak, amidst all of this. Mohammed, good to see you. Thank you so much. Mohammed Al-Arian, president of Queen's College at Cambridge University and chief economic advisor at Allianz. Thank you so much. Coming up next, Amazon and Visa have settled a dispute over credit card fees. We'll have that story and other top business headlines on the other side of the break. Visa card users shopping on Amazon will no longer have to worry about additional fees. The two companies announced today they've come to an agreement to allow Visa cards to be used on the site without those fees. They've been a growing source of tension between the two companies. Last year, Amazon customers in Australia and Singapore would be charged an additional 0.5% fee for purchases made with a Visa card. In Britain, Amazon went as far as threatening to stop accepting Visa cards altogether. It's since backed off that stance. Amazon blamed Visa's high processing fees for its action. Federal Aviation Administration Chief Steve Dickson announced he will be resigning from his position effective March 31st. Dickson, who oversaw the agency in the wake of the two fatal Boeing 757 crashes, is only halfway through his 5-year term. In an email to staff, Dickson wrote he wishes to turn his attention to his family after a long separation from them. The former Delta Airlines captain was appointed to the position by President Trump. And Twitter's new CEO, Parag Agrawal, announced he's taken a few weeks off for paternity leave. In a statement, Twitter said Agrawal and his wife are expecting another baby. He'll take some time off to be with his family. Twitter offers a total of 20 weeks of parental leave. It doesn't appear that Agrawal will be taking the full 20 weeks off, at least not all at once. This will be the first time since Mark Zuckerberg in 2017 that a major tech CEO has taken paternity leave. An interim CEO who's going to serve during those few weeks has not been announced. Brian?
Hey, Julie, also watching shares of Hasbro here. Stock is up close to 7%. And really a situation we have not seen happen at Hasbro just based on my time covering the company, which is a while. An activist situation here. AutoFox, which they're nominating 5 members to Hasbro's board of directors. Also, just got an email from the folks over there. They're ultimately pushing for Hasbro to spin off its Wizards of the Coast digital gaming business. This has been a very key growth driver for Hasbro in recent quarters here. And comes, we've seen a lot of transactions in the gaming space right now. Of course, Take-Two buying Zynga. So I think AltaFox looking for them to extract value. Now that team over there says if that spinoff was to happen, could unlock about $13 billion in total value. Julie, Hasbro's overall market cap is at about $14 billion. Now, Hasbro has responded to AltaFox saying they believe they are, quote, on the right path to deliver sustainable growth. So a very interesting situation to manage and comes here after Hasbro shares up 2% over the past 5 years, S&P 500 up 90%.
Yeah, that Wizards of the Coast, by the way, includes the classic game Dungeons and Dragons as well, not just the newfangled online stuff, but that classic role player game. It's interesting here because AltaFox is not a household name, right, when it comes to activists. So it's interesting here that we see some of these more recent activist campaigns being conducted by sort of newcomers to the activist space or upstarts in the activist space. That's been an interesting thread that we've been following, even as some of the classic activists have also been quite active, for lack of a better word, as well. Even if they haven't been waging campaigns, have been outspoken. There was a story in the Wall Street Journal today about Dan Loeb of Third Point sort of talking up Amazon. Now, he holds those Amazon shares. There's no indication he's going to start some kind of campaign here. But the headline was him saying he sees $1 trillion in untapped value at the company, perhaps through some of its units, things like AWS. Now, again, there's no reporting that indicates he's going to actually wage a campaign, but it is interesting that these comments are coming out.
Yeah, good luck to Dan Loeb trying to put forward an activist campaign against Amazon. And that's one stock that has just minted money for human beings over the past decade. Wish him well. But I do understand where he's coming from. You look at the stock price, it hasn't done much the past year, Julie, in large part because Amazon has been in a major investment cycle. Now, Amazon, I would say, backed off of that, investment cycle. When they reported earnings a couple weeks ago, stock reacted. The market liked to hear that, but still, an argument could be made. There could be more value to the upside here for Amazon. Whether Loeb can help shake that out, to be determined. All right, coming up, we're going to switch gears here and go on to the restaurant industry. We'll take a look at Restaurant Brands. The company reported better than expected sales this week, really on the back on one of their new brands. We're live with Restaurant Brands CEO Jose Sill next.
Restaurant Brands reported results earlier in the week, and the company coming out ahead of estimates on pretty much firing on all cylinders here across its different chains, but especially when it comes to recovery in Tim Hortons as well as Burger King. I want to bring in Jose Sill now, Restaurant Brands International CEO. Jose, it's always good to see you. Talk to me about
Julie,
Tim
how are
Hortons.
you? Good morning.
I'm doing well. Okay, I'm going to start in a funny place here, and that's with Justin Bieber, Jose, because I know that the promotion that you guys did with him for Tim Hortons was particularly successful. How successful was it? And would you attribute, how much of the gain that you saw in the quarter can you attribute to that promotion?
Well, it's great to be here as always. Thanks so much for the opportunity. We were really excited about the performance at the end of the year. We saw, I'll come back to Tim's in a second, but we saw a sequential acceleration in our comp sales for all brands. We saw good momentum from a development standpoint. We had more commitments for new development and new markets for Popeyes and Tim's than ever before in 2021. We saw good growth in system-wide sales in the neighborhood of 14%, and we saw really good momentum from a digital sales standpoint. So we grew almost 70% year over year in digital sales and got to 10 billion for the full year of 2021, and that cut across all brands actually, internationally as well as domestically. And then we had a really good capital return to shareholders in the quarter and for the full year. So it was an exciting finish to 2021. Lots of work to do still, and Tim's was a really important part of it. We saw really good sales momentum in the quarter. Obviously, I shared during the call on Tuesday that the Bieber promotion, the Tim Biebs promotion, was really quite powerful and helped us engage with a younger audience. But what was exciting about the performance is that it was really based on kind of the underlying core business growing. So we had an espresso-based relaunch in the quarter, and that did really well, reintroducing Canadians to our great lattes. We had our breakfast offering continue to do well. Our lunch offering and dinner offering beginning to gain some momentum. We've made a lot of progress on innovating for growth around the core with beverages as well as food. So and our digital business has become really powerful. It's a third of our sales in Canada going through our loyalty program. So a lot of good momentum, and the Tim Biebs promotion was basically icing on the cake, and that's why I was happy to share that I'm a believer and really looking forward to to additional collaborations with Justin in the coming year.
Well, Jose, the world is indeed filled with believers, and I'm going to contain myself not to ask you another one here, but I want to know what you talked about on the call regarding reclaiming the flame. What is going on with the Whopper? Is it still going to be put in plaster all over coupons? What's your strategy to revive that burger?
Yeah, look, we have a new leader in the business. Tom Curtis joined. He's been with the company for a bit of time, but he joined as president for Burger King, and he was on the earnings call on Tuesday. So he had a chance to introduce himself to investors and analysts all around the world. Lots of experience, comes with nearly 35 years of experience in the space as a franchisee, in addition to being a senior leader in the QSR space, and tons of operational experience, which is really critical. And the view, and Tom and I have worked together with the Burger King leadership team as well as the franchisees. The focus, there's a lot of excitement. The focus is all around the customer and making sure that we do a great job delivering our great tasting products, our flagship being the Whopper, doing it exceptionally well, and doing it through the different channels that we've been expanding upon over the last couple years. Digital becoming more important. Drive-through obviously has been an important part of our business for a long time, but it's gotten even stronger over the last 2 years. We're investing behind it. We have outdoor digital menu boards and technology that's enhancing that experience. And so the team is really focused on the guest experience, and Whopper being at the center of that. We felt it was important to invest behind it, to elevate an already flagship and iconic product, and make sure that it becomes the centerpiece of our game plan going forward.
Jose, why isn't there a Whopper chicken sandwich? When I think Whopper, I just think huge. I would sign up for buying a Whopper chicken sandwich with 3 pieces of chicken on it. I'm okay with paying a little bit more, but it makes sense to me.
Look, I think if you weren't so good at what you do, you'd probably be in marketing or in product innovation, Brian. But look, we have a very strong chicken business. We've been in the chicken business for since the late '70s with the original chicken sandwich, and we think it's an important part of our business. We've got the chicken fries as well, which is a very unique and innovative handheld chicken product. We've got the nuggets, and so we believe in chicken. At Burger King, we think it's going to be an important part of the business going forward, and the team is taking time to evaluate the entire portfolio, make sure we've got the best products, the best offering for the customers, and make sure we can deliver that exceptionally well through our drive-throughs, through digital and other platforms and service modes as well.
Oh, Brian Sozzi, come on now. A Whopper's a burger. Everybody knows a Whopper's a burger.
Whopper's big. You can still flame grill anything. Come on.
You can. True enough. Jose, I want to ask you about pricing. You talked a little bit about on the call. You raised prices last year, and your franchisees did. You expect some more price increases to come through this year. Now, of course, it's a very diverse set of different types of restaurants, but what kind of insight can you give us into a magnitude here? How big are price increases going to be? Where potentially are those increases going to be?
Look, our focus is making sure we manage the difficulties and challenges that you may face from time to time with these commodity inflation, and we're certainly in a very unique moment. But at this and making sure we've got the right margins for the franchisees, but at the same time ensuring that we address consumer demands and we don't get too far ahead of the consumer from a pricing standpoint. So we work closely with the franchisees. They have access to third-party consultants. So they can really analyze locally what's happening, make sure they understand the impact on their P&L, but understand as well what's happening with the competition, as well as what's happening on the consumer side. And then we take a very cautious and measured approach in terms of taking pricing at the right levels to ensure we manage both sides of the equation and don't get too far ahead of the consumer. So the demand piece is really important for us. We don't have any, we haven't communicated any plans in terms of additional price increases, but we look at it very, very regularly, and we're working closely with the owners to make sure they have the right information to make those decisions.
In this type of inflationary environment, Jose, if it persists, and it does look like it's going to persist this year, do you have to do away with the value menu? Can the franchisee support a menu like that when we're seeing 10% plus inflation?
Yeah, that's one of the areas we look at. We ensure that we have the full basket of offerings to our guests is what drives the overall margin in the business. And so you may have some products that have a lower margin, but you may have others that have a higher margin. And the contribution, when you look at product mix and different promotional activities, all of that is what drives the overall margin. And that's what we look at, and that's what we work on alongside our franchisees. Sometimes it can become overwhelming if you focus on one item. You need to look at the full offering and make sure that you understand the mix and the contribution of each of those to the overall restaurant margin. And that's how we look at it, and that's how we work with our franchisees. There's a lot of data that goes into it, and I think we're managing that carefully and staying close to CPI and ensuring we don't get too far ahead of the consumer.
Last time we talked to you, Jose, that was on the day you purchased Firehouse Subs. That brand put up 15.2% comp, if I'm correct. I mean, that is a very major number. Why do you think that brand is completely dusting Subway?
Look, it's an awesome brand. We talked about it back in November when I shared the great news that we were acquiring the brand. We were really excited when we got to learn more about Firehouse Subs, the purpose-driven brand that it is. Its public safety foundation is super powerful and connects well locally. The franchise owners in that business are doing a fantastic job operationally. It's one of the better brands that I've seen in terms of overall satisfaction on the consumer side. And they've done a great job with digital. They're now at 27% of their business is digital. And the comp it was 14 and change, almost 15 for the quarter, but for the full year, it was 21%, Brian. So it's really strong growth. I think they're doing it based on great tasting products and having great service, as well as having a purpose that is meaningful to the local communities in which they operate. And so we feel really excited to be part of that brand. The team is doing a wonderful job, and we're looking forward to accelerating growth in the U.S. We think there's a great opportunity in Canada, and we're super excited about being able to plug Firehouse Subs into the development machine we have internationally. which we think will be a key driver for growth over the long term.
Great to catch up with you as you continue that expansion and report those numbers. Jose, we love talking to you. The hazard, of course, as always, is when we show the video of the food. Makes me really hungry. Jose Sill, Restaurant Brands International CEO. Thanks for being here. We appreciate it. And we want to look at what's going on in the markets right now because we are seeing losses accelerate here in the major averages. The NASDAQ leading the downturn. It's off by 1.5%, but the Dow is off now about 460 points. A lot of Russia headlines coming out. One of the latest that caught my eye comes from the New York Times, which says Russia's government has expelled the #2 U.S. diplomat. American officials apparently calling this a, quote, escalatory step that could limit diplomatic solutions for this ongoing ratcheting up of tension. So market participants paying a lot of attention to this situation. They're also paying attention to a lot of individual movers today. One of them is DoorDash. DoorDash shares are surging following that company's earnings. Should you buy in after this big boost? We'll talk about that after the break.
DoorDash shares are surging, follow the company's better than expected overall earnings report, which included record orders. Stock is the top trending ticker on the Yahoo Finance platform this morning. So what's the trade here? JMP Securities analyst Andrew Boone joins us for more. Andrew, buy or sell after a strong report like this from DoorDash?
We're buyers here. Going back to last night, we thought the key takeaway was just that order frequency continues to be strong from diners. So if you think back, you go back kind of 6 months, 3Q, a bunch of companies highlighted kind of the reopening and issues there. You saw more companies highlight that in 4Q, and yet you're seeing diner frequency and just overall diner engagement remain very strong on DoorDash's platform as they're executing exceptionally well.
And Andrew, talk to us about how and why, right? What is DoorDash doing right here? Because we know that the environment's pretty competitive.
Yeah, it's very much true. One of the things that they're doing right is moving people to Dash Pass, right? So Dash Pass is DoorDash's subscription platform. Historically, the company's talked about order frequency being kind of double that of non-members for Dash Pass. And so as these guys have moved now 10 million people onto Dash Pass, that's helping to sustain order frequency. If you look at open table data, people are returning to restaurants, and yet, DoorDash is continuing to drive selection for consumers. They talked about adding 150,000 restaurants to the platform in 2021. They're adding value, right? Dash Pass makes it cheaper for every order and yet increases frequency. So overall, it's a positive for the company. And they're very simply just executing exceptionally well, right? Like they're doing a better job with customer service. They're doing a better job with making sure that orders are getting to consumers fresh and hot. There was news out kind of last week that they redid their McDonald's contract to ensure that there's a penalty actually if Dashers have to wait longer for food. So all of that means that diners are just happier with the product overall.
And I'm also curious not just about the diner side of it and that customer service side of it, but also the relationship with the restaurants. You mentioned McDonald's, but in the past, there have been some criticisms of DoorDash and some of its competitors for that matter, in terms of the fees that they charge for the restaurants with which they have relationships, et cetera. Where does that situation kind of stand here as they are doing that expansion that you talked about?
Yeah, I mean, look, overall, they did 40 billion of gross food sales on the platform in 2021, right? So they're a key partner for restaurants in terms of the marketing channel. If you go back earlier in the year, I think it was April, DoorDash introduced a new pricing tier for restaurants. So there's now more variety. If you're a restaurant, you may not want the full suite of services, but if you do, it's now available and you can pay up for that. DoorDash is essentially just becoming a better partner for restaurants in terms of the marketing channel, as well as just offering different tiers of fees. And so if you're a restaurant, you can kind of pick whatever's the right service for you. And I think that makes them more friendly. If you think about the regulatory environment where there were fee caps in 2020, 2021, a lot of that is now rolling off, right? And so I think you're basically seeing a more favorable kind of perception of DoorDash from restaurant partners as well as local city officials and certainly consumers.
Their main competitors, is it fair to say that they are outperforming Uber Eats?
Really interesting point. So Uber kind of highlighted that they thought that they had share gains in terms of 4Q. If you look at the actual numbers, I'm looking at quarter over quarter sequential growth for kind of 4Q. It looks like DoorDash took share. And so, the company talks about kind of 2 points in 2021 of market share gains overall. I think the bigger picture is that any of the smaller kind of food delivery players, those that were private, those that were more regional, are certainly losing share to the bigger two. And so this is increasingly, in how we view it, a two-horse race between DoorDash as well as Uber Eats. They're taking share across New York, which used to be more of a seamless market, right? They're taking share across different metros. It's Uber Eats and DoorDash at this point.
Indeed it is. Just a really big quarter out of DoorDash. Market responding accordingly. JMP Securities Analyst Andrew Boone, thanks so much for joining us. Appreciate it. All right, all eyes on Starbucks as baristas across the country are brewing up unions. Yahoo Finance's Danny Romero is here with us. Danny, what's the latest here?
Yeah, Brian, Starbucks baristas at an Arizona store will now have to wait on whether or not they will unionize. And that vote was postponed due to the fact that the National Labor Relations Board did not make a decision on Starbucks's request for review on who could be eligible for union representation. So until the board makes that decision, those votes will not be tallied. But again, a day that would have been really frustrating for these Starbucks baristas in turn really unfazed them about the delay. During a press conference, they were fired up. They're confident that they will get this vote count despite Starbucks' pressure. They're calling this another union busting tactic. Take a listen.
We've dealt with a lot of union busting and really psychological torment that they've been trying to push on us. And we are still here today, and we still have a great community of our baristas, our partners. We have come together stronger because of this. And that's why we're able to stand here and know that we have winning ballots in there. So whenever we come back to this in a few days or a week, we know that we're going to be here for our celebration.
And you can hear it right there that they are not backing down. This store would have been the first Starbucks store in Arizona to unionize and the third in the country following the stores in Buffalo. According to the union attorney, Ian Hayes, they said that the Starbucks request was filed on January 24th. So it's still unclear when the board will actually make that decision and when this vote count will really happen. There are 43 workers that are eligible, but according to these Starbucks baristas in Arizona, they say that Starbucks actually inflated that number by adding 16 to 18 workers to their store. Now, I reached out to Starbucks in clarification about what they're specifically asking for, and a spokesperson say that they believe in a district or market-wide vote is the most appropriate way to count the votes, not just one store. So they believe that every partner should have a voice, and that's something that they have been pushing since the beginning of their unionization effort. So, like I said, another big vote count will come up next week in Buffalo. So we'll have to stay tuned on what happens there as well. Brian?
All right, Yahoo Finance's Danny Romero, thanks so much. All right, it's bonus payout season. We're back with some hot tips on how to invest that bonus check next.
It is bonus season, and for a lot of American workers this season, it means they're getting a nice little addition to their paycheck, especially at a time that is very competitive in terms of finding workers on the part of employers. But what should you be doing with that bonus? That's a big question. Alicia Reese is with us now, Business of Your Life financial planner. She joined us as part of our financial advisors Corner. Alicia, first of all, I guess the question is, when you get the bonus, should you be thinking of it as sort of just part of your regular pay, or do you think of it sort of differently when you're figuring out what to do with that money?
First, thank you so much for having me today. That's a great question. When you first get a bonus, you should actually be thinking about it as more supplemental income. So from a financial planning standpoint, we typically don't want to have to, so obviously when it comes to bonuses, sometimes they're variable, sometimes they're not guaranteed. So we certainly don't want to have to rely on a bonus to pay for our necessary expenses. So from a financial planning standpoint, when we're looking at what can someone afford each month in terms of housing or their living expenses, we don't want to include the bonus or consider the bonus in that calculation. So we do see it as supplemental income. And from that standpoint, the way that I like to approach a bonus is, or other lump sum of money, is to think about it strategically when you're looking over your financial plan and your financial goals, and to think about strategically using it to accomplish your goals or to make progress towards your other financial goals.
Alicia, let's say I pull in $100,000 a year bonus here. It was a good year for me, really kicked butt at work. You know, what component of that should go into the stock market?
So again, everybody's situation is different. However, if you were to get that sizable of a bonus, yes, we would step back and take a look at your different financial goals. So first, we're going to, for most people, we would probably start with making sure that they had enough cash reserves set aside in an emergency cash savings account. And we would also take a look at any outstanding debt that they had. And one thing that I like to keep in mind is that we don't need to just focus on one financial planning goal. It's possible to make progress in different areas. So, after taking a look at maybe a cash reserve and any outstanding, maybe high interest debt that you have, we would certainly take a look at funding an IRA, an individual retirement account. And most likely, if you're earning a bonus, you are earning income, and anyone with earned income and or a spouse can contribute to an individual retirement account. And right now, we would be able to contribute for the year 2022, but up until tax day, you still have time to contribute for 2021. And so that's obviously within your IRA, you would invest. And then the next place would be, I think, an often overlooked account is actually just the regular taxable brokerage account, where individuals, it's different than a savings account in that you actually can keep cash, but you have the ability to invest that money. And within that account, going back to your question, we would look at what financial goals you have. And so we can invest within that account, not only for the longer term for retirement, but we can also invest for more medium term goals that you may have, let's say in 10 to 15 years. So it's not necessarily a set amount for everybody. We would kind of look at all of those different components and factors of somebody's financial plan.
And finally, Alicia, given all of the inflation that we have been talking a lot about, if you're getting this lump sum right now, the value of your money's likely to deteriorate, right? So just in 30 seconds, what is your favorite inflation-proof or inflation-resistant investment to recommend to folks right now?
So I have to say, that's just like you said, this is kind of currently something that individuals are dealing with. And if it's more short-term money that we're talking about, and if interest rates are not kind of moving up in terms of in the savings account or CD, and we're looking for another cash-like investment, we can certainly look at I-bonds that, again, for a cash position to keep up with inflation. Otherwise, if we were investing for the long term, it would be in equities.
Gotcha. All of that very important to keep in mind right now. Alicia Reese, thank you so much for being here. The Business of Your Life financial planner, joining us as part of our Financial Advisors Corner. Speaking of stocks, speaking of equities for the long term, they're not so good in the very short term. That is today, as we see stocks sell off. We're going to have more on today's market action next. We have stocks remaining in the red here on this Thursday morning. Russia headlines continue to spook investors. Plus, we've got some numbers that are just not pleasing people when it comes to earnings. Walmart aside, got some big tech names that are falling. So that means the NASDAQ is the most deeply in the red of the three major averages. But Saz, we were just talking about some of the big movers that are falling today. Palantir is one of them. The company is coming out and saying its adjusted operating margin this quarter is going to be 23%. The average annual assessment, 26.6%. So those shares off by 12%. You know, there's just so much focus on margins right now at some of these companies.
Yeah, and especially within these very richly valued big cap tech companies as Palantir is, you miss in any part of your income statement, any part of your guidance, you're going to get obliterated.
Yeah, and this company's been trying to migrate away from its core government customers to expand also into more corporations, and it doesn't seem as though necessarily that effort is bearing fruit. Another one, an ugly one, Fastly, cloud software company, saying 2022 revenue growth is going to slow more than the street had been predicting, and the shares are down by almost 30% in a single session. Now, we were talking earlier today, it feels like we are seeing bigger reactions in the markets this earnings season than we have as of late. I'm going to have to get some numbers on that, but that's just sort of anecdotally. And when you see something like this, that definitely, you feel it acutely. We are seeing tech, by the way, in terms of the sectors, pull back the most in today's session. I believe the financials are also taking it on the chin today. Financials, the XLF off by 1.7%. So there's plenty of pain, unfortunately, to go around here today, despite the increase in Walmart. And by the way, consumer staples, the only group in the green today with the help of Walmart. That does it for Brian and I on this Thursday morning. We will be continuing to watch all the action, and Akiko and Brian are going to take you through the next 2 hours of trading.
Welcome to Yahoo Finance Live, 11 a.m. here on the East Coast. I am Brian Chung. Akiko Fujita has the day off, but plenty happening on this Thursday, February 17th. Some would call it Friday Eve, but markets on the move, and it's red across the board. As you can see, the Dow Jones down about 1 1/3%, the S&P 500 down about the same, and the Nasdaq, those tech stocks, seeing a little bit of an accelerated sell-off today, 1.6%. We'll see what bears out in the next few hours of trading. But coming up in the show, a big earnings day for Walmart. We'll take a deep dive into the economics of one of the nation's largest employers and get some perspective on how the company famous for rollbacks is navigating inflation. And then those plastic shoes we've all come to know, Crocs, of course. The Colorado-based company reported earnings yesterday with revenues up 43% year over year. So why is the stock down? Well, CEO Andrew Reese will stop by to talk about strategy going forward, which involves leaning on some big celebrities like Bad Bunny. But first, a brief update on the happenings on the Russia-Ukraine situation, which appears to be weighing on the stock market this morning. International bodies are pushing back on Russia's insistence that it's paring back its presence at the border. And just this morning, we heard President Joe Biden on the White House lawn say about an hour and a half ago that the odds are very high for Russia to invade Ukraine still. Take a listen.
Mr. President, how high is the threat of a Russian invasion right now?
It's very high.
Why?
It's very high because they have not moved any of their troops out. They've moved more troops in.
Is your sense that this is going to happen now?
Yes. My sense this will happen within the next several days.
A bit of a reversal in sentiment from earlier this week when there was some speculation that maybe Russia would be indeed backing off of the Ukrainian border. The U.S. Secretary of Defense saying they're not seeing any kind of withdrawal from Russian forces, noting that if anything, Russia actually might be flying in more combat and support aircraft. And then over at NATO, the Secretary General Jens Stoltenberg saying he has not seen any signs of de-escalation around Ukraine. And again, markets appearing to move negatively on all of these developments. So for more on the market breakdown and kind of the actions that we've seen so far in the first few hours of trading, let's bring in Yahoo Finance's Jared Blickery, who's watching the global activity as well. Jared.
That's right. We've seen these on again, off again moves with respect to the potential minor incursion. We hope that's all it is. But right now, we just we gapped down on the open. We took another leg down, in fact, 2 legs down. And you can see we're pretty close to the bottom end of the session range, down 1.5% for the NASDAQ. I also want to point out that in the S&P 500, on a longer term basis, I'm going to pull up this 2-month candlestick chart that I've been kind of holding out here for the last several weeks. We're still in no man's land right now. It looks like we broke down. We came right back up yesterday into the breakdown area, and we're selling off today. But really, these are pretty low volatile moves given the moves that we've seen relative to this year. And here's the sector action today. We see staples. That's the only sector in the green, followed by utilities, real estate. So pretty defensive setup when you take a look at the sector action. Tech really taking on the chin here, down 1.7%. Then we have financials and consumer discretionary. Consumer discretionary has really been leading lately. And speaking of some of our leaders, we want to take a look at our leader screen. ARK Invest components, those are suffering. I'll take a look at that screen in a second, but ARK Fund, that is down 4%. MJ, that's a cannabis fund, that's down 3%. So a lot of the hot money flows that we've seen intermittently over the last few days, not really showing up here. By the way, KWEB is a Chinese internet ETF. Actually, the Chinese internet ETF and its components here really not doing that poorly today. BABA's up about 1%, perhaps off of some of those Charlie Munger comments we got yesterday, said kind of tongue-in-cheek just now, but take a look at ARK Innovation. We're seeing Coinbase, that's down 5%, Shopify off its earnings down 5%, Zoom down 3%. So a lot of these names, and just take a look at what's happened year to date here, a lot of carnage on the screen, a lot of things to work through. Also want to take a look at the EV space. On an intraday basis, we're seeing a lot of red here. Rivian up 5% though, Xpeng up 2%. So some of the fringer names getting some love, but really not the big guys. You see Tesla's in the red for about 3.5%, and then Toyota down 1%, Ford 2%, and GM 2.5%. Finally, want to take a look at our crypto screen. We see Bitcoin off about 3.75%. And the thing I don't like about the technicals here, we sold off from a key inflection point, which is about 45,000. So have to watch and see what happens to Bitcoin. in the coming hours. Guys?
Yeah, Jared, and interesting to note that gold's up despite Bitcoin being down. A bit of an interesting correlation there. And also 10-year bond down, I'm watching 9 basis points. So classic risk-off activity, stocks down, yields down. Thanks so much for breaking all that down for us. Let's get a little bit more market perspective on what's going on with James Liu, Clearnomics founder and CEO. James, great to have you on the program today. I wanted to ask you very quickly just kind of about what's going on with the markets. Obviously, when we talk about what's happening with Russia and Ukraine, it's weighing a lot on markets. Just kind of wondering how you view the volatility here. It seems like the news headlines have really been the big ups and downs for the markets over at least the past few trading sessions.
Yeah, well, that's right, Brian, and it's good to chat with you. Really, it's about Russia and Ukraine, and it's about the Fed. And on the geopolitical side, I think the challenge for investors is that geopolitical risk is just really hard to weigh. And our view is that we're not yet in a situation where it makes sense to make any real portfolio moves based on this. I mean, first of all, diplomatic channels are still open, so the situation is still evolving on a regular basis. And I think the challenge is that even if the worst case scenario were to happen, it's hard to gauge exactly what the impact long-term would be on the markets. When you look at historical examples of this over the last 30 years, certainly since the end of the Cold War, you have Crimea in 2014, you have wars in Iraq and Afghanistan, in the mid to early 2000s. Generally speaking, although there are humanitarian consequences and obviously large geopolitical consequences, the impact to markets and the overall domestic economy is fairly limited. So while this is an important situation to watch, we don't believe it's yet at a scenario where individuals and investors should be making big moves in their portfolios just yet.
James, where do you go right now, though? I mean, it sounds like if you don't make a move right now, though, you still kind of want to figure out what might be a possible hedge here. I was seeing in previous days where we were also seeing right across the board in light of the rising tension, people going into oil, people going into energy. But what's interesting is that today, on the backs of that remark that we heard earlier from President Joe Biden, energy is down today as well. In fact, the only XL that I'm seeing that's up right now is consumer staples. So where do you go right now?
Yeah, I mean, that's the challenge. You don't just have the Russia-Ukraine and geopolitical situation happening. You have everything else happening in the wake of the pandemic and with the backdrop of the Fed happening at the same time. And so really the question is what's more important. And so oil prices having risen over the last year, 90, potentially approaching $100 later this year, that's really not because of geopolitical tensions at all. And so to the extent that you have this energy position on, it's important to keep in mind that that's really a pandemic play. It's really an economic recovery play rather than a potential geopolitical play. And to put a finer point on that, if you think about the Crimean Peninsula situation back in 2014, the fears were that that would basically cause oil prices and natural gas prices to spike dramatically over a long period of time. And that's generally not what happened. Oil prices basically stayed fairly firm. Natural gas prices did rise a bit, but then they came back down. And so you have this short-term shock and then basically a long-term stabilization. So our view is that it's really about the Fed. It's really about the continued economic recovery. That's really what most investors should be focused on today, although they should also keep an eye on the headlines just in case things do get worse.
James, you went there. You mentioned the Fed, so I got to ask about it now. We got the minutes from the January meeting yesterday. The notes in there noted that the rate hike would likely come soon, the first post-rate hike since the COVID crisis really began. But what was interesting was that you had some members of the FOMC in that meeting, which again was a number of weeks ago, worried about financial conditions actually tightening too fast as the Fed embarks on this unpredictable path. So what do you see as the dovish, hawkish balance on the Fed right now?
Yeah, well, Brian, I don't want to preach to the choir on the Fed here, but our view is generally that the Fed is clearly justified in raising rates. Of course, the debate right now is whether it's going to be every single meeting the rest of this year, 6 to 7 rate hikes, or if it'll be 50-point rate hikes at every other meeting. To us, it's kind of a coin toss right now. The next meeting is about a month away when they're expected to lift off. So obviously we'll get more economic data then, and that could tip the scales between the 50 basis point rate hike and the 25 basis point rate hike. But to your point on financial stability, our view is that these types of rate hikes should not jeopardize financial stability. We understand that the Fed has, mandates, around inflation and unemployment, but more importantly, they also have an implicit mandate right now in financial stability and basically, inequality across financial conditions across the country. They want a broad-based economic recovery. The type of rate hikes we're talking about should really not jeopardize that. I think it's important to keep in mind that before the pandemic, the Fed funds rate was above 2% at one point before they brought it down. So when you're looking at Fed rate hikes, not only are they justified, even if inflation does come down, but the size that we're talking about, although there'll be a shift from what we've seen the last couple of years, that really should not jeopardize that scenario.
Well, and that's kind of a fair point that you bring up about their immediate next move. But I think that the larger macro concern here, based off of people that I've spoken with, has been the next recession will be a Fed-induced one. If the Fed moves too quick, I mean, maybe that's as soon as the next 12 months. So are you worried about the Fed perhaps getting too aggressive, perhaps more aggressive than the market would expect, which could invert the yield curve and then spell a little bit of trouble for the economy?
At the moment, we're not quite worried about that just yet. Not only is the overall economy on solid footing, which means that even if they did, over the course of the year, get the Fed funds rate up to 1.5% to 2%, in terms of real rates, that's still in zero to negative territory once you adjust for inflation. So really, the real key issue is the economy going to continue to grow at this pace? It should slow down, but the Fed funds rate very naturally should be much higher anyway. And also just the temperament of the Fed, based on the experience over the last two cycles, is that they're probably going to lean more conservative. They're forced to act right now because the latest CPI print was 7.5%. But it's important to keep in mind that that's a 1 month number. And although it's been high for over the last year, those numbers really should come down. Right? So 7.5% for a month is different than 7.5% over the full year or over next year. And so the Fed is reacting to that, but it's unlikely that the Fed will try to tighten too much unless we get into a 1970s, early 80s type of scenario, which we really don't see on the table right now.
Yeah, and of course, all that hinging on how the data comes in. Keep in mind, there's going to be one more consumer price index report before the Fed's next meeting in March. So we'll have that to look forward to as we try to get the crystal ball on Fed policy. James Liu, Clearnomics founder and CEO, thanks so much for stopping by this morning. Well, as economic data again remains in the highlights, let's bring in Yahoo Finance's Emily McCormick, who was watching the print on jobless claims that came out this morning at 8:30. Emily, what did they show us about the labor market?
Well, Brian, a little bit of a disappointing print here on jobless claims this morning for the latest week, but do keep in mind that the weekly data does tend to be choppy, so potentially more noise than signal here, but nevertheless, a little bit of a disappointment. But diving into these numbers, we had weekly jobless claims for the week ended February 12th coming in at 248,000. Consensus economists were looking for 218,000, so a bit higher than consensus for this week. And also should note that we saw a revised 225,000 new jobless claims for the previous week. So an increase for the first time after 3 straight weeks of declines in this latest data. Now, in terms of the continuing claims, so that is the total number of individuals claiming benefits across regular state programs, those did come in better than expected for the week ended February 5th. So those are reported on a 1-week delay as usual. Those coming in at 1.593 million versus the 1.605 million expected, and also coming down from the revised 1.619 million during the previous week. But taken together, all things considered, we do have to keep in mind here with that headline increase in jobless claims that we are still hovering right around pre-pandemic levels, since throughout 2019, we did have weekly jobless claims averaging around 220,000. We've also come down sharply from the highs of the pandemic era, because in February last year, weekly jobless claims were coming in at a rate of about 800,000 per week. So, Brian, certainly a little bit of a disappointment here in terms of this headline number on weekly jobless claims. We should also note that this weekly report does coincide with the survey week for the Labor Department's monthly jobs report. So we'll see if that does end up affecting the number that we get in that monthly jobs report in early March for February. We didn't necessarily see that be the case in January with that better than expected monthly print, but certainly something to keep an eye on here for the labor market data. Brian.
Take a look at Walmart earnings, as they reported estimates that actually beat the street's expectations, and they boosted their dividend. We'll take a deep dive into the economics of one of the nation's largest employers and get some perspective on how the company is navigating inflation. But before we go, we do want to highlight very quickly some big stocks that are on the move today in trading. Take a look at Fastly, which is down quite a lot, actually almost 30%, and also Altice also on the move. That's a cable provider that also posted earnings. Obviously, a lot of these Dow Jones industrial laggards that we're watching as well. Salesforce down over 3%, 3M down 3%, IBM down 2.5%. We'll be right back. Welcome back to Yahoo Finance Live. Want to highlight shares of large mega retailer Walmart, which is up 2% today. Pretty remarkable given the market down day that we have. They reported fourth quarter earnings that beat expectations on both the top and bottom lines. The retailer also reiterating its long-term forecast. That's despite concerns surrounding inflation. So joining us now to discuss further, we've got CFRA analyst Arun Sundaram. Thanks for joining us, Arun. Really appreciate it. You know, Walmart, again, a very interesting company to watch because it's such a substantial part of the U.S. economy. It kind of is a glimpse to the macro picture. Give us your big takeaways on their earnings beat.
Yeah, hey, Brian. Thanks for having me. Yeah, overall, it was a really great quarter, you know, especially considering the very challenging macro backdrop this Q4 for them. You know, that you had heavy inflation, you had supply chain challenges, and you had Omicron-related challenges. And Omicron peaked in January, which is January was the end of their quarter. So, despite all these challenges, Walmart still was able to grow the top and bottom line, and more importantly, they were able to grow their margins, which is something that many retailers haven't been able to do. And you know, I think that's really a testament to Walmart's ability to execute regardless of economic conditions. You know, basically they tend to do well during good times and bad times, and in fact, during bad times, they tend to outperform competition, which is, I think, what we're seeing right now.
Arun, I was looking at your note, which you had put out before the earnings, and you were saying that you were expecting net sales to rise somewhere in the 2.33% range for the fiscal year 22. Based off of the guidance that you got from Walmart, are you optimistic that they can hit that? I mean, what was interesting was if it is a 2.3% in terms of net sales growth, that's basically in line with what they had reported over the course of 21, right?
Yeah, so today we actually increased our sales target for their upcoming fiscal year. We're expecting a little bit over 3% sales growth. And that's really because they're moving with really strong momentum in all three segments of their business. That's Walmart US, Walmart International, and also their Sam's Club club store business is doing really well as well. I mean, our expectation is, this year in 2022, inflation's at a 40-year high. We're expecting more consumers to become price conscious, which in turn should result in increased traffic trends for Walmart. And during periods of high inflation, Walmart's price gaps relative to competition tends to widen, which I think will bode really well for them this upcoming year. So the sales momentum is there, and we're not really worried on the sales side. It's more on the bottom line that investors have a little more concern because of all the cost pressures that they're seeing. But we're expecting them to generate some pretty good bottom line growth as well this upcoming year.
Arun, you mentioned inflation. That's the biggest kind of macro story, and obviously Walmart's dealing with it as well. Want to take a listen to CEO Doug McMillon on the earnings call earlier this morning, talking about the subject of inflation. Take a listen.
We think about things like opening price points and protecting for a lower income family some of the things that they need from a staples point of view. And then, as John mentioned, we use rollbacks to communicate not only the reality of prices are coming down in some places, but the emotion or perception we want customers to have about us being there for them and earning their trust during a period of time like this. So I wouldn't say that we're unique in having to work through that. Of course, everybody is.
So, Arun, you heard Doug McMillon there talking about inflation. I mean, this is a low-cost company. They're supposed to be keeping prices as low as possible to their customers. That's a point of emphasis that he was trying to make there. Are you seeing any sort of margin pressure as they try to keep those prices low? How well are they mitigating these rising costs across the board?
Yeah, great question. Walmart's no different than other retailers in the sense that they are experiencing significant cost pressures. But in our view, Walmart's cost pressures are somewhat subdued by the fact that they have so much economies of scale, being the largest retailer in the United States, and they have so much purchasing power over their suppliers. And if you think about it, no individual supplier is that significant for Walmart, but just about every one of Walmart's suppliers relies on Walmart because many of their suppliers generate 20, 30, 40% of their annual sales with Walmart. So Walmart has much more purchasing power over their suppliers than the other way around. And because of that, they can still raise prices, but make sure that their price gaps relative to competition is solid, and that way they can maintain their value proposition. So Walmart is raising prices, but at the same time, as their price gaps relative to competition is widening, which is what I think we'll see from them in 2022.
Right. It's not just about price. It's about price gaps relative to competitors. Arun Sundaram, CFRA analyst, thanks so much for stopping by. We'll have you on for the next earnings round. I want to highlight one trending ticker. Palantir Technologies is on the move, down over 10% as the big data and analytics company reported earnings that beat estimates on the top line, but missed on the bottom line. You can see the street was expecting 3 cents. They only logged about 2 cents per share adjusted. Analysts are probing a deceleration in the government contracts that make up a huge part of their business. And Alexander Karp, the head of the company, said on the earnings call that the focus will be on commercial contracts instead of government, particularly in Europe. Coming up on the other side of this break, Crocs cracks the $2 billion mark. The footwear company's CEO joins us to discuss annual sales hitting a record $2.31 billion and its latest shoe acquisition. We'll have more details on that ahead. folks, people who watch this show know that I have two loves, the Fed and, of course, shoes, which is why I'm really excited to talk about the big business of shoes. Crocs reported solid fourth quarter earnings. They beat on both the top and bottom lines. The shoemaker is seeing record high revenues in 2021 following a strong holiday season. But despite all of that, shares are under pressure. Joining us now, we'll have a little bit more color on the earnings themselves. The Crocs CEO, Andrew Reese, and our very own Yahoo Finance's Brian Sozzi joins for this conversation from the NASDAQ as well. Andrew, great to have you on the program today. Give us a walkthrough on the earnings season, which, as I understand, covered the very important holiday time period as well.
Yeah, so we just reported fourth quarter, which obviously did cover the holiday that takes us through to the end of December. We had a great fourth quarter. As we look at the full year of 2021, we grew the business 67%. It's an extraordinary amount, right, to $2.3 billion in revenue. And on top of that, achieved 30% operating margins, and which again is best in class for our industry by a significant margin, and $8.32 in terms of earnings per share. So, a really outstanding year for us. As we look forward, we're also super confident and excited about 22 and the longer term. We guided to 20% plus growth for 2022, and we're acquiring. We made an acquisition in the back end of last year, Hey Dude, which is a scale casual comfort footwear brand that we think will produce between $700 and $750 million of pro forma revenues for 22. So it's another really big growth year for Crocs.
Andrew, you're the only person that has more shoes in their background than our very own Brian Chung here. That's quite the feat. But I'm not surprised. You are the CEO of Crocs. Look, you mentioned in the quarter your average selling price was up 18.9%. Lots of inflationary pressure out there. Do consumers have to worry that affordable Crocs purchase may not be as affordable as it once was this year?
Yeah, look, so that's a balancing act, right? So we were proactive in 2021. We took prices up, right? And we took prices up because we saw inflation, and we saw inflation coming. But we also have a very, very strong brand. And when we think about pricing, we're really trying to balance two things. One is a very affordable price point for our consumers, a big part of our value proposition. I know Walmart reported today, and they're very focused on value. A big part of our value proposition is giving our customers incredible value. We give them a shoe that is fashionable, it's lightweight, it's comfortable, and frankly lasts forever for $50, which is an incredible price point. But at the same time, as a company and as a public company, we need to make sure we capture the appropriate value for our shareholders. So we're really thinking we're walking that fine line well at this stage, and able to do both.
One way I imagine, Andrew, you can overcome inflation is just re-engineer the product itself. Now, I went through your annual report, and you talk a lot about the shoe of the future. Talk to us about what this shoe is made out of, and does it also support any of your ESG efforts?
Yes. So look, we have some opportunities to re-engineer. One of the great things about our shoe, think about our classic clog, it has exactly three pieces, right? It's a molded shoe with a molded backstrap and rivets that attach it. So that makes it easier to manufacture. That makes it easier to rebound from kind of supply chain shocks. What we're doing in terms of ESG is we're changing the source of that material, that compound that goes into making that shoe, and we're getting that from sustainable sources. So today, the shoe is probably one of the lowest carbon footprint shoes on the market. And by sourcing that raw material from sustainable sources, we actually can make it much less, lower its carbon footprint even further. And that's allowing us as a company to commit to net zero carbon by 2030.
Andrew, I want to drill down a little bit more into that Hey Dude acquisition, which you had mentioned earlier. In our morning meeting today, some of our producers were saying Hey Dude is a huge brand right now. A lot of people are talking about this brand. You announced that acquisition back in December. It's not a cheap deal. Tell us a little bit more about what you hope to gain from Hey Dude. Is there a certain demo that you hope to bring into the Crocs brand as well from that?
Yeah, I think. Look, there's actually a lot of overlap in our consumer base. So I think one thing I would say is that the consumer base that we have for the Crocs brand, which is obviously significant both here in the US and globally, we think are Hey Dude customers. We think the Hey Dude brand and style actually goes further than Crocs. So we think we can leverage our customer base to sell them Hey Dude shoes, both here and internationally. We can also go further than that. So it is a brand that's trending very strongly. They've had a tremendous run, but we can see huge opportunities. We can see huge opportunities to enhance their digital presence and digital capabilities. We can see huge opportunities to further penetrate the very strong relationships we have with U.S. wholesale. And they're only 95% of their sales are in the U.S. today. We're an international company, right? So we can take the Hey Dude brand to Europe and Asia. So, while I think we paid a fair price, I think we have a lot of opportunities to create shareholder value from this acquisition.
Yeah, and I know international has been a key area of growth for Crocs, Andrew. Two things on that topic. First, you do have some stores in Russia, and it's a very tenuous time to say the very least, 26 stores. Is it your understanding those stores are still open? And then secondarily, what does growth look like in China right now?
Yeah, so let's address Russia first. So yes, those stores are still open and actually trading well, right? So as we kind of talk to our team in Russia, the news and the angst that's taking place in the West is a little bit less in that environment. So consumers are shopping, the stores are open, that business is proceeding as usual. Obviously, we're taking appropriate measures to make sure that if there were sanctions put in place or something in response to an invasion in Ukraine, that we can manage that. So, and it's not a huge part of our business, but we do have a business there. The second part of your question is around China. We've been in a sort of a 2-year turnaround for China. That plan, I think, is going really well, and we're excited about. We grew China double digits last year. We plan to grow at double digits again. We are seeing impacts of COVID lockdowns. So we're seeing, particular cities where they may be shut down for a period of time. The duration is not that long. It's typically, 1, 2, maybe 3 weeks. So we're anticipating that we continue to see those lockdowns through the year. But our ability to transact digitally with our consumer, our ability to kind of bounce back is, I think, very strong. And so we're optimistic about China in the long term, but managing it carefully.
And then, Andrew, last question here. Tell us a little bit about the Crocs brand, because it seems like a lot of the renaissance that has happened with people wanting to get into Crocs during the pandemic was a lot of these partnerships. You've teamed up with Post Malone, Justin Bieber, Bad Bunny. I personally tried to buy the Hidden Valley Ranch collaboration that you had. I mean, so it's not just people, it's other brands as well. How important is that to the strategy?
Well, Brian, we can probably help you out with that. I'm sure we have a plan here behind us. So, look, that's been super important. The brand is in exceptional shape. It's in a really great position. We see rising brand consideration. We see rising brand relevance in almost all of our markets around the world. And that is due to, one, product innovation, and those collaborations that you talked about. We just actually did a collaboration that launched this week with Karol G. So it's a wide variety of celebrities, artists, other brands, interesting retailers, and some very high profile brands. Like also last year we did 4 collaborations with Balenciaga. So the heat that we're able to bring to the brand through innovation and through those marketing efforts is incredible, and the consumer is responding.
The heat, so important. Yeah, have your people reach out to my people. I'm a big ranch fan. Andrew Rees, right. CEO of Crocs, alongside Yahoo Finance's Brian Stassi. Thanks so much for that conversation. Coming up on the other side of this break, Elon Musk speaking out against who else? The Securities and Exchange Commission. The details as the Tesla CEO accuses the agency of trying to chill his speech with, quote, endless, unfounded investigations. We'll have that ahead. Well, it's a tussle that we know all too well. Elon Musk and the Securities and Exchange Commission, the latest development that the company's attorneys actually sent a letter to the SEC accusing them of perhaps harassing the head of Tesla in relation to that 2018 agreement that settled civil securities charges against the billionaire for some tweets that he had. Let's bring in Yahoo Finance's Alexis Keenan, who's got the details on the latest developments. Alexis.
Hey, Brian. So Musk and Tesla, their lawyers are saying that the SEC engaged in unrelenting investigation targeting him and Tesla, targeting both Musk and Tesla, and that the SEC is essentially chilling Musk's First Amendment rights to free speech. The accusations were made today in a letter that was sent by these attorneys for Musk and the company. It was filed in the federal district court in Manhattan, saying that the SEC is ignoring the court's order by withholding $40 million in settlement funds from Tesla shareholders that Musk and Tesla paid as penalties for Musk's 2018 tweet, saying that he had secured funds to take Tesla private. Now, that tweet is just one in a string of tweets about Tesla that has caused, as you say, Musk to tussle with the SEC for a number of years now, at least back to 2018. In 2019, the SEC asked the judge to hold Musk in contempt for another tweet, and that one was about Tesla saying that it had a production outlook that it necessarily couldn't or hadn't backed up at the time. So in addition to that, we have just last week, we had learned in filing by the company on November 16th, that the company said on November 16th that the SEC had served yet another subpoena on Musk and Tesla, asking for compliance information with that 2018 settlement. Now, that came just 10 days after Musk had tweeted asking if he should sell 10% of his stake in the company. And so I want to read a little bit of that letter from these lawyers. They wrote, simply stated, the SEC has failed to comply with its promise to pay Tesla's shareholders the $40 million it collected as part of the settlement, and that it purports to be holding for them. Instead, it has been devoting its formidable resources to endless, unfounded investigations into Musk and Tesla. Now, the lawyers go on to ask the court for a conference that will hear them out to focus on why the SEC has failed to distribute these funds so far, and also why the SEC has permitted has been permitted to issue subpoenas asking for information from Tesla and from Musk without court approval. These lawyers think that the court should be involved here because the court was involved in this original settlement and consent decree for this $40 million. So they also say that the SEC has taken 1,200 plus days to distribute these funds to the company's shareholders. So they want to be heard on that. Brian?
Yeah, good reminder maybe just in general to never tweet. But Yahoo Finance's Alexis Keenan, thanks so much for breaking all that down for us. Coming up on the other side of this break, bringing crypto into the regulatory fold, former Commodity Futures Trading Commission Chairman Chris Giancarlo joins Yahoo Finance to discuss the future of crypto spot markets. You won't want to miss that after the break. In the crypto space, Commodity Futures Trading Commission Chair Rostin Benham looking to make a fresh appeal to lawmakers that the agency, the CFTC, should be the one supervising crypto spot markets. And some voices from the CFTC of former's past are now chiming in on the debate as well. Yahoo Finance's David Hollerith spoke with the former head of the agency, Chris Giancarlo, about the best way forward on crypto. A little bit of an alphabet soup of regulators trying to get into the space, David. What did Giancarlo say about the matter?
Yeah, Brian, so the Commodities and Futures Commission trades or regulates commodities and futures contracts. Now, there's a little bit of question with cryptocurrency as it has a lot of derivatives in the market that it influences the price. But the actual spot market, it sort of remains in question depending on what the cryptocurrency's classification is. And I spoke with Giancarlo, and he sort of made the case for why it would make sense for the CFTC to sort of oversee the crypto commodities spot trading market, if that makes sense. So I'll toss to the clip.
We have a couple of sort of fundamental divides in our federal regulatory system for financial markets. One of those divides is that the SEC, the Securities Exchange Commission, regulates securities, which are capital formation instruments. And the CFTC regulates derivatives, which are risk transfer, risk allocation instruments, the risks of commodity prices going up and down, for example. That's one of the fundamental divides. In the SEC's jurisdiction, they have traditionally had oversight over both derivative markets on securities, but also what we call spot markets. That's the physical delivery market of a security. You want to buy a share of Microsoft, you buy it, it arrives in a day or so, or at least it goes to your holding agency. That is a spot transaction. Now, for historical reasons, the CFTC has overseen only futures markets, that's forward or future delivery of commodities, but not the spot market. And the reason, it may sound strange, but if you think about it, it makes sense. The CFTC oversees gold futures, but not the trading every day of gold. Otherwise, it would have to oversee jewelry shops across the country. It oversees oil futures, but it doesn't oversee gas stations across the country. It oversees wheat futures, but doesn't oversee grain elevators across the country. Those retail markets have traditionally been overseen by state agencies, state laws, and state commerce. That's a traditional divide. Now, what's unique here is along comes crypto, and it trades both in derivatives and it trades in spot markets. And if it's a security-based crypto, then the SEC has jurisdiction over both the spot and the derivative market. But if it's a commodity-based crypto, which is both the two biggest ones, Bitcoin and Ethereum, almost 60% of the crypto market falls under CFTC jurisdiction. The CFTC only has authority in the derivative markets, the futures markets, but not in the spot markets. And so there's a gap, there's a regulatory gap. 60% of the crypto market, when it trades in spot, is not overseen by a federal regulator. And that's one of the points in my 8-point program that I propose for Congress to address by giving the CFTC authority over spot transactions in commodity cryptos, which is effectively Bitcoin and Ethereum, the two most widely traded crypto instruments here in the United States.
And yeah, to get into that more, can you just sort of explain how would this create more efficiency in the market?
Well, it would bring federal regulation to that marketplace. And we have found that there's one of the reasons why American securities, American derivatives, American financial markets are the world's deepest, most liquid, most well-used, most patronized, is because of effective federal regulation, smart regulation. I'm very proud of the work done by the CFTC, an agency I had the honor to serve as chairman, of its smart approach to regulation. In fact, it was the CFTC, amongst all the world's financial regulators, that first green-lighted the creation of a regulated derivative market for Bitcoin and Ethereum, markets that function very well. So bring in the CFTC's smart oversight to the spot market, I believe would actually enable that market to accommodate a broader range of participants and therefore make it a deeper and more liquid market.
Yeah, and I'm curious about how this would be enacted. It sounds like it would be Congress, but could you sort of talk more also about how this would sort of open the market to more participants?
Yeah, so many American institutional participants cannot engage in markets that don't have effective regulation, and we see in the Bitcoin and Ethereum spot markets primarily retail investors. There's not a large component of institutional investors alongside them, traditional institutions, American insurance companies and pension funds, hedge funds, and the like. This would allow those participants to engage in those retail markets because those markets would have a well-established federal regulator overseeing those markets and looking after things like consumer protection and adequate funding and protections against fraud and manipulation of those markets.
Right, and also in your proposal, you mentioned SROs or self-regulating organizations. This is sort of like a private sector regulating body. Could you sort of explain what that would mean? Coinbase, the cryptocurrency exchange, has made a similar proposal, but what would something like that actually look like? Has that ever happened before in U.S. financial markets?
Well, in fact, all of our U.S. existing legacy financial markets have self-regulation. In the futures markets that I know well from my time at the CFTC, self-regulation goes back to the 1850s, long before federal regulation came about in the 1930s, and continues to this day. And our futures markets are the world standard. They are the deepest and most liquid. And I think there's a connection between effective self-regulation alongside effective federal regulation that makes our markets so dominant globally. The same applies in our equities markets. People think about the SEC, but they also need to think about FINRA, the financial industry self-regulatory organization that oversees a lot of activities in the equities markets and in the bond market. So we have a long successful history in the United States of having self-regulation alongside federal and in some cases alongside state regulation that works very effectively, and the proof is in the pudding. No other country, not Europe, not Britain, not in Asia, have securities and futures markets of the size, the magnitude, the depth, the liquidity, the creativity of our American financial markets. And I believe firmly that there's a relationship, there's a cause and effect between self-regulation and the success of those markets. And we'd want to have the same impact in crypto as well.
So Brian, a little more color there in terms of how the CFTC could fit into this mix of federal agencies sort of looking to get involved or more tightly regulate the sector. Obviously, there's a lot of question here, especially given the fact that the Securities and Exchange Commission is sort of want to control most of the asset class in terms of how it's regulated, given that, periodically through written testimonies and hearings, we've heard members of the SEC commissioners just bring up the fact that most cryptocurrencies are deemed securities. But again, Bitcoin and Ethereum seemingly, they make up about 60% of cryptocurrencies, of the total cryptocurrency market. So this would be a pretty big move.
Yeah, a pretty substantial move for sure. I mean, David, this is really interesting because this is effectively an intra argument within the regulators in DC over who has jurisdiction over regulating what. So it sounds like regardless of where you land on whether or not you want it to be the SEC or the CFTC, the real answer is going to come from Congress. So is there any kind of suggestion that Congress is leaning one way or the other in terms of who to, in the law, delegate these responsibilities to?
Brian, I do not have a clear idea of what's happening in Congress. There's a lot of jockeying that's going on. I think one thing that's worth pointing out is, there's been talk about like a very strong move to cryptocurrency industry lobbying efforts. And over the past year in 2021, those efforts amounted to $4.9 million. But I'll point out that that's still very small compared to how more mature sectors put lobbying expenditures towards Washington. I think especially given the fact that, what was it, back in November, we saw a DAO, decentralized autonomous organization, essentially raise almost $50 million overnight. I mean, so I don't really know what's going on here, but I think that I think there's a lot of question about what will be decided in Congress, and that's going to really going to play out this year.
A lobbying DAO, perhaps. I'm sure that probably exists somewhere. I'm sure someone's already started something up like that.
It's gonna happen.
Yeah, we'll see about that. Yahoo Finance's David Holler, thanks so much for bringing us that conversation. On the other side of this break, a union battle for Starbucks workers is brewing. The latest developments as an Arizona store becomes the latest turf war. We'll be right back. Starbucks workers across the country pushing to unionize, and the latest battleground is in Mesa, Arizona. Yahoo Finance's Danny Romero joins us to explain. Danny, that union vote is apparently delayed. Tell us why, and what does this mean for the broader movement nationally at some of these Starbucks locations?
Yeah, Brian, Starbucks baristas at an Arizona store will now have to wait on whether or not they will unionize. The vote count was postponed due to the fact that the National Labor Relations Board did not make a decision on Starbucks' request for review on who would be eligible for union representation. So until the board makes that decision, those vote counts will not be tallied. But a day that would have been really frustrating for these Starbucks baristas actually in turn really unfazed them. During a press conference, they were fired up, confident that they will win this vote count despite Starbucks' pressure. And they're also calling this a union busting tactic, but they're not taking the heat. Take a listen.
Initially today, we had this set up and we were planning to go celebrate after, but now we are kind of free. So I say we go out and start organizing some more stores in this time, right? And also too, like, what are next steps? We're out there, we're talking to other partners. It's a really partner focused movement. And that's our goal, is just to keep partners going and support them the best that we can.
And you can hear it right there that they are not backing down. And this store would have been the first store in Arizona to unionize and the third in the country following the stores in Buffalo. But according to the union's attorney, Ian Hayes, they said that their Starbucks request was filed on January 24th. So it's still unclear when the board will make that decision or when this vote count will actually happen. There are, according to filings, there are 43 workers eligible to vote, but the Starbucks baristas at this press conference say that Starbucks actually inflated that number by adding 16 to 18 new workers to their store. Now, I reached out to Starbucks to get clarification on exactly what they're asking for, and a spokesperson told me that they believe in a district or market-wide vote is the most appropriate way to count the votes, not just one store. They also believe that every worker, also known as partner, should have a voice. That is something that they have been pushing since the beginning of this unionization effort. Now, the unionization effort has expanded to 97 stores across 26 states. Now, if every employee in this election votes in favor of this measure, that only represents a fraction of the Starbucks stores. Now, according to the company filings, Starbucks has 235,000 workers across nearly 9,000 U.S. company-operated stores, and that's as of October of last year. Now, as of late of August, workers at more than 80 stores have filed for a union petition. That's according to the National Labor Relations Board. Now, again, next week is another big week as 3 stores are also set to vote count in Buffalo. Brian?
Yahoo Finance's Danny Romero, only 80 stores, but again, that number continually growing. Thanks so much for bringing us that story. Coming up on the other side of this break, we'll have more market coverage as we look at all the major indexes in the red. That's after President Biden earlier this morning signaled the likelihood of a Russian attack on Ukraine, describing those odds as high. We'll have those developments after the break. Welcome back to Yahoo Finance Live. We just crossed the 12 p.m. hour here on the East Coast. You can see that markets across the board are red. The Dow down almost 400 points. That's still only about 1%, but notable after we got those news headlines earlier this morning. President Joe Biden signaling that the likelihood of a Russian attack on Ukraine is high. He made those remarks in passing on the White House lawn. Again, that's squaring with some of the commentary that we had gotten earlier in the week that Russia was perhaps standing down on the troops that they had amassed on the Ukrainian border, although the United States and NATO officials saying they really haven't seen the physical proof of them actually doing so. S&P 500 down 1% and the NASDAQ down about 1.6% in a noisy day that also included a lot of earnings. But we got a lot on dock for the hour, but let's get right into all the market action with Amy Kong, Barrett Asset Management Chief Investment Officer, who is our first guest for the hour. Amy, thank you so much for hopping on the show this afternoon. You know, a lot of market ups and downs over the last few trading sessions, all appearing to be off the whims of these new developments that we continue to get on the Russian-Ukraine front. How sensitive do you think investors are right now?
Hi, Brian. Thanks for having me. You know, when you have a risk-off environment that we've been seeing all year, adding on Ukraine is certainly not going to help the situation. So I'm not surprised to see heightened sensitivity. In general, we have seen through time and through stock market history that geopolitical events like Ukraine and others have stress tested the market. And in general, when we look at how the markets react to such news, there's a general protocol that we see happening. And of course, initially, there's that shock, there's that panic. And I think in due time, investors start to digest whether such an event will really impact the fundamentals of the market. And if the answer is really no over the long run, you start to see some of that anxiety dissipate to a degree. And so right now we're in that initial shock phase, if you would. And I do think that, you know, as Ukraine's situation unfolds, there could be some short-term reactions. For example, oil prices could move higher if sanctions were to be imposed. At the same time, you might see investors seeking safety, whether it's towards the US dollar or perhaps towards US treasuries. And that's certainly important, especially as we're dealing with higher inflation. So energy prices moving higher is certainly not going to help that. And then, of course, as yields potentially could move lower because of that seeking safety aspect, the Fed's kind of caught in a tough spot in terms of trying to raise rates on the front end of the yield curve.
Well, and that's an interesting point that you bring up on bond yields, because there's kind of this push and pull dynamic where investors are also looking at the Federal Reserve's eventual moves to actually shrink its balance sheet, which will have an effect, they hope, on raising rates on the longer end of the curve. So, but there's also that demand pressure on it if people are trying to run to safe haven assets that are US dollar denominated. So when you take a look at the 10-year flirting, kind of hovering up and below the 200 basis point level, does that really tell you anything, or is it too noisy to look at where bond yields are going and say, all right, you know what, we got to go risk on, risk off?
Yeah, it's a great question, Brian. And I think that that push and pull, rather, to your point, is likely to happen, especially as geopolitical events continue to transpire. As I've mentioned before, I think the Fed is caught in a little bit of a tough spot because we all know that they need to raise rates. And moving back to that pre-pandemic level of 2.25% is necessary in our view because of so much liquidity in the system. But the pace at which they get to it, whether it all happens this year or perhaps spanned over 2 years, that's, I think, the tricky part, because as you're seeing the back end of that yield curve come under pressure, I think, you know, again, the risk of creating an inverted yield curve is something to continue to watch. The spread between the 2-year part of the yield curve versus the 10-year today, to your point, is only about 50 basis points. So it really only takes 2 rate hikes on the front end to create a flat yield curve. And again, if pressure is on the back end, you can risk creating an inverted yield curve, which can create more questions rather than answers in terms of, you know, creating all that anxiety around whether or not the U.S. can be pushed back into a recession. So I certainly think it's a valid question, and it's unfortunately wait and see at this point in terms of how the situation unfolds.
Amy, broad picture question here, regardless of, you know, the specific headlines on Russia, Ukraine in the short term, and even Fed policy, just at least for the March meeting. Do you reposition right now?
For the moment, no. I think we continue to feel constructive on the equity markets despite the volatility relative to other asset classes such as cash and bonds. Certainly, as we're looking under the hood within the stock markets, we're very, very keen on trying to find individual companies that can weather the storm. And when I say weather the storm, I'm talking about being able to really operate in a very high inflationary environment. We just are coming off the and later innings, if you would, of this fourth quarter earnings season. And while numbers looked pretty good when you looked at how they fared in the last quarter, I think companies are starting to express that expenses as a group is growing at a much faster clip. And lots of companies have expressed that input costs have just gotten to a point where, unfortunately, it impacted earnings. So I'm not repositioning in the sense of creating a lot of major shifts in our asset allocation, but certainly when we think about the companies we own, pricing power and operating leverage is very critical at this stage.
Yeah, inflation remaining the big story there. Amy Kong, Barrett Asset Management Chief Investment Officer. Thanks for stopping by this afternoon. I want to shift gears to the big trending tickers, and obviously a lot of focus on DoorDash. In fact, after their earnings yesterday, shares were up about 20% at the beginning of the day, now down. Well, actually, they lost some of those gains, but they're still up about 6%. So let's bring in Yahoo Finance's Inez Ferre for some updates on the roller coaster action, not just in DoorDash, but in some other earnings estimates as well. Inez?
Yeah, Brian, the food delivery service, as you said, paring some of its gains from earlier today, but still up more than 6% right now after a solid quarter for DoorDash, with analysts really liking what they heard, especially as far as order frequency. That came in strong. The food delivery platform posting upbeat guidance. And also, DoorDash doesn't expect momentum to slow this year. The share price, by the way, is right now hovering just below its IPO price from last year of $102 a share. Taking a look also at Cisco Systems after that company reported its quarterly results. The computer networking giant beat on the top end. The bottom line gave a bullish forecast and also boosted its share buyback program. Year to date, though, this stock is still down about 10%. I also want to mention Hasbro. You guys have the chart on that one, and Hasbro is up today. This is after a report that an activist investor is pushing for new board members and also a spin-off of the unit that houses Dungeons and Dragons. Altifox Capital has about 2.5% stake in the company and has nominated 5 directors to the board. And the activist investor says that share prices are lower than what they were 5 years ago, and Hasbro could double its valuation if it did the spin-off that it's suggesting. Brian?
And I also want to follow on Tesla. We talked about Elon Musk and the SEC earlier, but as far as the business themselves, apparently another issue and a run-in with the National Highway Traffic Safety Association regarding their brakes. Tell us a little bit more.
Yeah, that's right. With the agency now starting a preliminary investigation into the braking system when the autopilot assist is on. The agency is saying that they have received more than 350 complaints from drivers saying that while they were driving at high speeds, that their braking system unexpectedly was activated without warning at random. No crashes or injuries were reported with these complaints, but this involved cars with the autopilot feature on. And we know that the regulator also has initiated a couple of autopilot probes since August. You can see shares are down almost 4% now. Brian?
Yahoo Finance's Inez Ferre. Thanks so much for the breakdown. I want to shift gears to another company that's in the highlights today. NVIDIA, the chip maker, reported earnings after the close on Wednesday. You can see shares down right now about 7%. That is despite the fact that they beat fourth quarter estimates on the power of their data center. So let's get a little bit more on this with Christopher Rowland, Susquehanna International Group Senior Equity Analyst of Semiconductors. Christopher, great to have you on the show this afternoon. You know, your note that I saw said that these earnings were another beat and raised quarter. So I guess the simple question here is, why is the stock down this morning?
That's a great question, and we are still searching for answers this morning. You know, if we were to nitpick, perhaps gross margin, the guidance was a tad bit lighter than one would have expected. Additionally, OpEx might have been a tad bit more elevated. But other than that, this was a spectacular report.
Christopher, give us a little bit more commentary on what you heard from the company regarding the supply chain issues. This has been not just something within the industry that's been very important, but around the macro economy as well. We heard AMD talk about optimism of the supply chain issues kind of abating in 2022. Did you hear anything from NVIDIA?
NVIDIA and AMD, particularly on the GPU side, have been constrained for over a year now. And in fact, if you look at the channel, if you look at add-in boards or graphics cards that are in the channel, they trade for premiums above MSRP of about 80%. So NVIDIA and AMD cannot put out enough cards quick enough. And both of these guys have been very vigilant at adding new supply in terms of new contracts, in terms of prepayments. And NVIDIA did just that last night. They increased both prepayments and also financed, we believe, the supply chain, certain subcomponents that go into these graphics cards that have been holding up shipments overall. So as we move through 22, we think they will become less constrained, but we would not be surprised, particularly for GPUs, to see this constraint going into next year.
Let's talk about individual lines of revenue here. When we talk about data center, when we talk about automotive, where are you seeing the points of strength and the points of weaknesses for NVIDIA?
Yeah, sure. Data center is the area of most attention, investor attention, because it holds the most value. Overall, I would say that it's probably given a 25 or 30 times sales multiple. So it is very important, each incremental dollar to the story here coming from data center. And data center was exceptional. It was the leader for guidance in terms of the growth addition. And finally, we think next quarter, we're thinking that data center can finally surpass gaming in terms of quarterly revenue. So this is a very big milestone for NVIDIA overall. For automotive missed our number. This has been a disappointing sector over the past 2 years. This is primarily as NVIDIA today is powering computers in cars that do things like consoles or infotainment. And increasingly, they're going to be moving to applications like ADAS or autonomous, which is higher value, but that has yet to hit. But we're fairly confident that their automotive, even though they disappointed, is close or have hit bottom and should inflect in the back half of this year.
Yeah, and their optimism underscored by that partnership they announced with Jaguar and Land Rover. But a lot to watch for in the chip space in the quarters to come. Christopher Rowland, Susquehanna International Group Senior Equity Analyst of Semiconductors. Thanks so much. Coming up on the other side of this break, Charlie Munger is bashing Bitcoin. If you were on Twitter, you knew this already. We'll discuss the Berkshire Hathaway Vice Chairman's latest criticisms and why he blames the United States for failing to ban cryptocurrency trading outright. We'll be right back. The crypto community has been holding its breath on the details of President Biden's forthcoming executive order, which has not come out yet on the subject matter. But Yahoo Finance reporter Jennifer Schonberger got the details of that forthcoming order. Jennifer, give us a lowdown on what's going on.
Good afternoon, Brian. That's right. President Biden set to issue a wide-ranging executive order on regulating cryptocurrencies next week. The president will direct agencies across the government to study cryptocurrencies as well as a central bank digital currency and come up with a wide-ranging government strategy to regulate digital assets, according to an administration official familiar with the matter. Now, the order reads like an alphabet soup of agencies here in Washington that will be tasked with looking into crypto. Specifically, the order will commission a study of a CBDC and ask Treasury, along with the Department of State, the Attorney General, the Department of Commerce and Homeland Security, and other agencies to develop a report on the future of money and payment systems. Now, the director of the Office of Science and Technology Policy will do a technical evaluation of what might be needed to support a CBD system. FSOC will be asked to study financial stability issues that arise from digital assets. And the Attorney General, along with the FTC and the CFPB, will be asked to consider what the impact of growth in digital assets could be on markets, while the SEC and CFTC will consider market protection measures within their own jurisdictions. Now, the order will also look at measures to protect consumers, businesses, and investors. It will also delve into privacy issues concerning digital assets, as well as distributed ledger technology and the potential impact on the environment there. These studies will be anywhere between 90 to 180 days, and these agencies will expected to report back to the president on this. So, Brian, a very wide-ranging effort by the White House to thoughtfully think through how to regulate crypto. The administration clearly understands crypto is here to stay and appears to be embracing that. Again, this order finally expected next week. Brian?
Yeah, wide-ranging for sure, and we'll definitely be sure to follow up when that does come out next week. Great information there. Yahoo Finance's Jennifer Schonberger. Appreciate it. Well, let's get a little bit more color on everything that's going on in the crypto world with Michelle Bond over at the Association for Digital Assets Markets. Great to have you on the program, Michelle. You know, you're the CEO of an agency or an organization that really has front row seats to all of this going on. I just wondering if you could kind of quickly respond to that news. Obviously, a lot of interest from the White House in getting a closer look to crypto. I mean, when you see names like the State Department perhaps getting involved, do you feel like this is a productive way to be approaching a possible framework for regulation?
Yeah, so I do. And there has been talk of this executive order since last November. It was actually supposed to be issued back then. And it was, I think at that time, rumored to actually have even a broader sort of mandate where there was supposed to be a crypto czar appointed, and they were actually going to propose some more regulatory measures as opposed to just having a study. Over the past few months, the Biden administration has seemingly sort of walked back from where their initial position was. And what they are doing is this whole of government approach, and essentially now, requesting several studies. These studies will be conducted, as you noted, by several different members, all across the government. So yes, it will include the intelligence agencies, the State Department, the markets regulators, the bank regulators will all be involved, and they'll make recommendations. I think it's also important just to note that a lot of these things, even when there's a study and recommendations made, a lot of these things do require an act of Congress. And Chairman Powell of the Fed has given his commitment to Congress that before a CBDC moves forward in the United States, that he will make sure that he gets the congressional buy-in before that's done. There is a Fed open proposal right now that the industry is working on providing public comment on. So there's, I think, a lot of moving parts going, but I think this is a positive step. And I think, having the federal government study where the risks are, where the benefits are, what the opportunities are, and, in a whole of government way, I think that's a good thing for crypto.
Michelle, when we talk about how the regulators in DC work, it's important to note that everything moves very slowly. And even this EO is just beginning studies at the various agencies to kind of embark on a possible regulatory framework. But do you feel like the trade group and your members have a seat at the table? Because as all of this is happening, kind of the voices that these regulators solicit as they try to figure out what the best approach here is pretty important, is it not?
Yeah. So what I absolutely love about Adam is we created our own seat at the table. So in 2018, when our group was formed, we actually proposed our own code of conduct, and that's what has been regulating the crypto spot market. So all of our members agree to adhere to our code of conduct, and it creates the, all of the guiding principles for custody, settlement, trading in markets, conflicts of interest, you name it. I think it's really important to note that, because what the industry has done here is actually has raised the bar for market integrity higher than what any federal regulator has done to date. So I think obviously, from that respect, yes, the industry has had a voice in the regulation of the industry. And then secondly, I would just say, look, we have been very, very busy with the comment letter process, and we will continue to engage productively via the comment letter process with, the Fed, the SEC, all of the open proposals. And then in addition, we've been very actively engaged with Capitol Hill and working on different legislative solutions for the space to make sure that innovation is not hampered in any way in the United States, but also in a way where consumers can be protected.
Michelle, there are a lot of voices out there, and one of the big voices that got a lot of attention specifically yesterday was Berkshire Hathaway's Charlie Munger, who made some remarks about cryptocurrency at large. I want to play a clip of what he said yesterday. Take a listen.
You let a bad genie out of a bottle, God knows what happens. I think it was a huge mistake to allow it at all. And the truth of the matter is, our regulatory establishment, when they quit the government, they go out into this heavily promotional capitalism. And so it's very hard to get the government to make good, wise decisions about something like Bitcoin.
And then Munger, after the fact, mentioned that he feels like China handled cryptocurrency better by just outright banning it. Just wondering if you had any response to that type of commentary that's obviously out there in the ether.
Yeah, absolutely. Look, I think digital assets are here. They're here to stay, and they are the natural evolution of finance. And when you look at digital assets and cryptocurrencies, look, it's more than just an investment opportunity. We see payment rails that are being simplified. These secure blockchains have uses from gaming to medical records. It's much farther reaching than just in finance. The space, especially in finance, is full of good actors who want comprehensive regulation that works, to protect both consumers and also foster innovation. These are the conversations that Adam is having, every day with the Hill, with regulators, with the industry, and international bodies. We've been very, very busy at work on that front. I saw a recent tweet from Elon Musk that addressed some of these statements by Munger, and I thought it was funny and worth mentioning. Elon said he was at a lunch with Munger in 2009, where he told the whole table all the ways in which Tesla would fail. And Elon said it made him quite sad, but he told him that he agreed with all of those reasons and that maybe, they would probably die, but it was worth trying anyway. And I thought that was a really sort of cute remark, but it just goes to show you that, I do think that we're seeing sort of a change, and, some people are not as quick to adopt change, especially when, they've been working in a different field for such a long time. However, I do think that the wave for the future is going to be via the blockchain and digital assets.
I mean, Michelle, a lot of people saying some really mean things about Charlie Munger. I would actually say that for an Elon tweet, that wasn't as bad as maybe we would have expected from the head of Tesla there. But it does kind of show that there's perhaps an institutional gap in the way that people understand the use cases, but also the risks of cryptocurrency. When you talk about the membership of Adam, I understand you have some new members. I don't know if you want to tell us about that, but how important is just kind of getting the institutional knowledge up out there?
Yeah. So one of the things that I love about our membership roster is that the vast majority of our members came from traditional finance. So that's an awesome thing because these members are used to seeing how the financial markets are regulated. And that provides a very thoughtful pathway towards getting digital asset markets regulated. And that's why we've been working very hard on our code of conduct and potentially working towards building a self-regulatory organization and really trying to just advance market integrity for our space. So we are very excited, breaking news, to announce that we have grown our membership roster very substantially. And we've also added some brand new board members. So FTX and FTX US are now on Adam's board. Robinhood Crypto is now on Adam's board. Multicoin Capital is now on Adam's board. These are really some of the best firms in the industry. We're extremely excited to have them on our board. And then more broadly and more deeply, we've also just expanded our membership roster in addition. So we've added Coin Fund, the Digital Asset Council of Financial Professionals, the Hero Foundation, Solidus Capital, Symphony. Those are all new members, and as well as some new law firms, such as like Anderson Kill, Mayer Brown, McGonigal, and as strategic legal partners. So we're expanding our membership pretty substantially and with some really great actors in the industry. And it's very, very important to us to work with good actors who are interested in, advancing the regulation for this space.
Yeah, no, and very important as that dialogue does ramp up. Michelle Bond, Association for Digital Assets Market CEO, thank you so much for stopping by. And we'll be right back. In this week's episode of Influencers, Yahoo Finance Editor-in-Chief Andy Serwer sits down with Facebook whistleblower Frances Haugen. The two discuss Meta's business practices, the ethics of social media, and why antitrust regulation would only address one piece of a much larger problem. Take a listen.
Facebook knows that as long as we think the argument is about censorship, You know, is it too much censorship? Is it not enough censorship? As long as we focus on that as the conflict, we will never resolve it. But what Facebook knows is that there's lots of solutions that don't involve content, right? They involve the dynamics of the algorithm. They involve product choices. Like, should you have a multi-picker that lets you spam out to 10 groups at the same time, the same piece of content? Facebook knows they have all these solutions that aren't about content. And as long as we're arguing about censorship, we're not going to hold them accountable on these other things. And so the main thing that I think there's a point of common ground is, you know, people on the left, on the right, believe that people have the right to make informed choices, right? That you only really can consent or like voluntarily choose to do something if you have enough information to make that choice. And so I've been pushing for what I call like nutrition labels. So like, you know, the government doesn't tell us what to put in our mouths, but it does say, hey, if you claim this is in your food, it needs to be in your food. And you need to list how much trans fats is in it. And if you'll notice, the government never banned trans fats, but as soon as consumers had that information, it disappeared from all of our products. We don't have a nutritional label for TikTok. We don't have a nutritional label for Facebook. But the public has a right to have real data, not Facebook artistic data, but like real data on how these platforms work so they can make choices.
We're calling it Facebook, but the company's renamed itself Meta. So should we be calling it Meta or Facebook, Frances?
I am trying to train myself to say Meta because I know a big part about why they made this shift is they want to run away from the conflict. And the reality is that people are dying. Children are dying, right? There are going to be women walking around this country with brittle bones in 60 years because Facebook made choices to not stop its algorithms from driving women towards anorexia content, right? This is a crisis, and Facebook thinks it can change its name and just focus on video games, and that it'll all go away. And so that's one of my goals in 2022, is to be able to say Meta and Facebook in the same sentence, because we can't let them run away from the damage that they're doing.
How would you say that in the same sentence?
Like you could say Meta's Facebook, or you could say Meta Facebook. But we need to make sure that, you know, one of the reasons they did it was they know their employees feel ashamed to admit they work at Facebook. And now they can say they work at Meta. I have a backpack from when I worked there. And in tech, tech companies love giving you swag. You know, a t-shirt that says Google, a backpack that says, you know, Snapchat. My Facebook backpack had the Facebook logo on the inside. I never received a single shirt, hoodie, whatever at Facebook that said Facebook.
You mean they were concerned even at that point about their branding and the backlash that it might produce if you were wearing it in public?
Exactly.
Wow.
And I think that's a giant red flag, right? Like I part of my mission and like what motivates me every day is I know that people are suffering inside the company, right? Like not being willing to admit reality in the present is really hard. That cognitive dissonance is really hard. And I know that Mark Zuckerberg is suffering, and that like every time you go into a restaurant and having people give you dirty looks, that has to be hard. And so we need to hold the company accountable and help it grow towards long-term success, because the current impasse we're in hurts everyone.
So what about Mark Zuckerberg, Frances? Is he a bad guy? Does he have evil intentions? How would you characterize him?
So I never am willing to call Mark evil. It's funny, when I appeared in front of the UK Parliament, there was a member of Parliament that was very insistent. They're like, but is this evil? Is this evil? And I think it's really important to remember that Facebook is full of very well-intentioned people. And I think it is a problem about incentives. And some of those incentives, you know, Facebook has a fiduciary duty to act in the interests of shareholders. And I think it's a lot harder to prove long-term harms than short-term harms. And so Facebook has been stuck in this cycle where when they are faced with these conflicts where it's like, you know, you could be 0.1% less profitable, or you have 10% less misinformation. Because there is no mandated transparency, it's very hard to make the business case that you don't choose that 0.1% of profit. So mandating transparency gives another center of mass that gives space for people inside the company to do the right thing.
How close were you to Mark Zuckerberg and Sheryl Sandberg? Did you have any direct contact with them?
Nope. As they like to say, I was a low-level employee that I never sat in a C-suite meeting. I'm a data scientist. You know, I worked on civic misinformation and later counter-espionage. You don't become an algorithmic expert if you like being the center of attention. You know, it's an invisible thing behind the scenes. But the reality is, in Facebook's own documents, I saw the magnitude of the problem, and just surveying operationally and organizationally how Facebook worked. Like I have an MBA from Harvard, right? There's a lot of things where in Silicon Valley, we undervalue the role of leadership and we undervalue the role of organizational health. And I think I had an opportunity to assess like what was the feasibility of change in a way that was different than a lot of people because I had had that opportunity for that education. And I don't think there's a path to change inside of Facebook without the help of the public.
Well, folks, it is tax filing season, and even if you think you might have a grasp on all of the credits and the tips and tricks to maximize your returns, the tax code, of course, is big. And we want to highlight one tax credit that apparently fewer than half of U.S. workers are aware of. Catherine Collison from Transamerica Institute, CEO and president, joins us as part of our Taxes Made Simple series presented by TaxAct. Catherine, this is called the Savers Credit, right? Tell us a little bit more about exactly what it is and why so many Americans appear to miss it.
Well, the Savers Credit is a tax credit. It's also referred to as the Retirement Savings Contributions Credit, and it is available to taxpayers who are saving for retirement in a 401k, 403b, or similar plan, or IRA. But as you mentioned, fewer than half of workers are aware that it exists.
Catherine, tell us a little bit more about exactly how to be mindful of this tax credit when filing it. Is it something that we should expect a document from our employer and we just plug it into the software? What have you? How do you make sure that you actually claim the credit once you get around to those filings this year?
So that's a great question. And there are some income eligibility requirements to be mindful of. It's available for savers with an adjusted gross income of up to $33,000. That's single filers, $49,500 for heads of households, and $66,000 for married filing jointly. You have to be 18 or older, not a full-time student, and not claimed as a dependent on somebody else's returns. If you've been saving for retirement and meet those eligibility requirements and you're doing your taxes, one of the most important things you can do is take advantage of the IRS Free File program. This is another well-kept secret. The IRS makes available tax preparation software for free on its website for those with an adjusted gross income up to $73,000. So if you're eligible for the Savers Credit, by definition, you're eligible for the IRS Free File program. If you're using that program or another commercially available software package or a tax preparer, be sure to be on the lookout for it and to ask about it. And then if you have any other questions, the IRS actually has an online tool on its website that you can check and see if you're eligible.
Yeah, reminder, you don't have to dole out that big money for that premium software. But just to get back on the Savers Credit, again, as you mentioned, this applies to voluntary contributions that you make to a retirement account. But does this cover all of the types of retirement accounts? Because we know there's 401ks, there's traditional Roth IRAs, 403bs. I mean, is it across the board?
Great question. A qualified retirement account, so a 401k, a 403b, a traditional or Roth IRA, the other types of retirement accounts. The one type of retirement account it doesn't apply to is rollover IRAs. So for example, you have a balance in your 401k, you leave your employer, you roll it over into an IRA. That type of IRA is not eligible. But everything else, qualified retirement account, make a contribution, and you could be eligible if you meet the requirements.
All right, Catherine Collison, Transamerica Institute CEO and President, thanks so much for stopping by Yahoo Finance this afternoon. And we'll be right back. 10 minutes to the 1 p.m. hour here on the East Coast. We're still watching markets across the board, which are continuing the drift sideways after some of the losses following remarks from President Joe Biden earlier this morning about the high odds of Russia still invading Ukraine, despite the more optimistic headlines we had gotten earlier in the week. When you take a look at the Dow Jones, down over 1%, so same with the S&P 500, the NASDAQ, those tech stocks getting a little bit deeper of a red day, down 1.7%. If you take a look at U.S. Treasuries as well, the 10-year on the longer end of the curve getting some interesting fall in yield, down about 7 basis points. Same story with the 30-year, down 7 basis points to 2.3%. Traditional risk-off behavior here when you consider people going out of equities, buying bonds, bond price up, yield goes down. But again, we'll be monitoring all of the market action. More here on Yahoo Finance right after this quick 2.5-minute break. Welcome back to Yahoo Finance Live. You know, among other things, Charlie Munger's still making waves in FinTwit and Reddit and what have you regarding commentary he made at yesterday's Daily Journal annual meeting, talking about a number of issues, but want to cast a specific spotlight on his remarks about inflation. Take a listen.
Inflation is a very serious subject. You can argue it's the way democracies die. When democracy dies in Latin America, inflation is a big part of it. So it's a huge danger once you've got a populace that learns it can vote itself money. If you overdo it too much, you ruin your civilization a lot. And so, of course, it's a big long-range danger.
The 98-year-old investor later invoked Weimar Germany and also Hitler in talking about inflation later on in those remarks. Let's bring in Yahoo Finance's Jared Blickery. We're not going to go quite there, but Jared, obviously some very interesting, spicy remarks from the legendary name of Berkshire Hathaway. Any thoughts you have about that?
Yes, I think it's important to realize that for most investors who are under the age of, let's say, 40, that would include the millennials, they've never experienced a period of high inflation. In fact, I can remember a very short one when I was a little kid because I was growing up at the time, but I remember hour-long gasoline lines, and it's something that kind of sticks with you. Charlie Munger's 98, so 1924, he was a kid growing up in the boom times of the 1920s and also the bust of the 1930s. He's seen how bad it can get. Now, it doesn't mean that it's going to happen this time around, and I don't think he was going there either. But as Chair Powell, likes to say, the long-term trajectory of the fiscal policy of the United States is not sustainable, and I think that rings true. So, is it an imminent problem? Well, we're having to deal with 7.5% inflation right now. So I would say, yes, it's kind of an inherent problem right now, but it's not out of control. But do democracies die because of inflation? They die because of hyperinflation. That can be the case. And I think it's prudent to start thinking about these things while we still have the chance.
I mean, I guess one argument would be, though, democracy didn't die in 1980 when the Federal Reserve got around to inflation, right? I mean, if anything, it increased the Keynesian argument that it is on government to quell these types of economic risks.
Well, if it's a government that created them in the first place, of course it is. I mean, people talk about market manipulation in the Federal Reserve, but that's their mandate. They have to control prices through monetary policy, and that's a form of manipulation. So that's their mandate. Back to the 1980s, it was Paul Volcker. They finally brought an adult into the room whose sole purpose was to hammer down inflation. And he did that by raising the federal fund rate to almost 20%. That's almost inconceivable. Now we're talking about a 25 versus a 50 basis point rate hike at the next meeting. Well, he was doing, I think, 100 beeps at a time. That beats even Bullard to the punch here. So, you put it all in perspective. I don't think markets are expecting much here, but if this gets out of hand, if the Fed really gets behind the 8 ball later in the year or a year from now, I think they're going to have to start really putting the hammer down. That's when we could see 50 basis points.
Yeah, and I'm going to make the last remark here and just kind of noting that when it comes to the inflation that we're living right now, I mean, yes, Federal Reserve officials are intent on wanting to raise the interest rates, but I don't think people are arguing we're going to see some of those double-digit short-term costs like we saw in the Volcker shock of the early 1980s. Right. And a reminder that even though that did a number to quell inflation, it also did a number on a lot of emerging market economies where interest rate differentials really sucked money out of there and then into the United States. But we will leave it at that. Yahoo Finance's Jared Blickery, thanks so much. And again, markets in the red across the board. NASDAQ getting a little bit more of an accelerated loss than the Dow and the S&P 500. But also want to highlight very quickly our promo for our Yahoo Finance Twitter poll with the week's question. Did the Super Bowl commercials persuade you to buy into crypto? We'll reveal the results tomorrow. But that does it for me on the 11-1. Alexis Christoforous and Karina Mitchell have you for the next 2 hours. We'll see you tomorrow.
Worlds apart, claims and counterclaims from the U.S., Russia, and NATO over Ukraine tensions are keeping investors on edge. What does it mean for markets here at home, Fed policy, and your portfolio? Corporations across the country have been pushing for more diversity, equity, and inclusion, but are they meeting their targets? We speak with Starbucks for insight on how it's progressing with its goal of a fairer work culture. And expanded child tax credits have been a lifeline to millions of Americans. We speak with a nonprofit that tracked for 6 months how that money helped improve the lives of countless families, and its call to make them permanent. Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christophorous. Thanks so much for stopping by this Thursday afternoon. And Alexis, with all of the concern over geopolitical tensions really sucking the air out of the room, it's really easy to forget that we're actually in the middle of earnings season as well. Walmart and DoorDash, the latest to really hit things out of the park, but that is going against the grain of market action today.
Yeah, Karina, for sure. I mean, you pointed to those two companies in particular, their strong earnings helping those particular stocks, but not exactly lending support to the broader market right now. Investors, of course, bracing for the possibility of military action between Russia and Ukraine. Right now, we have got all three major indexes deep in the red, with the Dow near its worst level of the day, off now more than 365 points. The S&P 500 down 53, and tech once again the biggest loser. This has become very familiar theme on Wall Street this year. The NASDAQ now down 235 points. Of course, investors also digesting more economic news today. Another 248,000 Americans filed claims for unemployment benefits last week. That is more than expected, and it does reverse a 3-week decline. We also found out that construction of new homes in the U.S. fell in January after rising the previous 3 months. A lot of that is due to material and labor shortages. In fact, we're going to talk a little bit later on about lumber prices, how high they are, and how that's impacting the housing market right now. Let's get a check of the winners and losers in the S&P 500 sectors, because there are only 2 winners out of the 11 in the S&P 500. That is energy. It is higher, even though we're seeing the price of crude fall back about 2.5% today. And we've also got consumer staples on the plus side. Now, on the downside, leading the decline, as I said, technology, financials also chalking up some big losses today, along with consumer discretionary. And before we turn things over to Jared Blickery, want to get you a check of the bond market, where we do have yields pulling back from their recent highs. The yield on the 10-year at 1.98%. And the S&P, rather the 30-year, is now down to 2.3%. All right, let's check in now with Inez Ferre. It's not Jared Blickery, it's Inez Ferre live at the NASDAQ. Inez, what do you have your eye on today?
Thanks, Alexis. We're taking a look at WTI and Brent crude futures. Take a look at our Wi-Fi interactive board. We're watching WTI down more than 2% right now. We're also watching Brent crude down 2.3%. And also, if you take a look at the price action throughout the morning, you can see WTI trimming its losses earlier this morning, but then back down. And this was around those headlines about the threat of a Russian invasion and imminent invasion. You've got a lot of news, a lot of geopolitical tensions that are creating some volatility with the markets. Part of why you're seeing this decline in oil is because of the Iranian talks on a nuclear deal and the prospects of Iranian supply. So there's that push-pull between the prospects of Iranian supply and then the geopolitical tensions that's creating some of this volatility. Looking also at gold prices, gold futures up 1.5%. In fact, gold just above $1,900 an ounce. If we take a look at a year-to-date chart, we're seeing gold up more than 5.5%. A lot of those gains over the last 12 sessions, you can see here. Silver futures also higher. This is a 12-day chart, but silver today up around 1%. And of course, we also have earnings, as you guys were just mentioning, and I do want to mention some of our trending tickers on our Yahoo Finance platform. We're watching Palantir shares just tanking its biggest declines since March of 2021. And this is the data analytics software company. after it reported its quarterly results. Citigroup saying that the results and outlook showed slowing growth. That's why you're seeing some pressure on the stock. Analysts not too pleased with those results. Looking also at Fastly, that's down 31%, absolutely tanking after the company's outlook missed expectations. Numerous analysts have cut their price target on the stock. And DoorDash up 8%, pairing some of its gains from earlier. It had been up double-digit percentages earlier after better than expected revenue. In fact, DoorDash right now trading above its IPO price of $102 back when it went public in December of 2020. Alexis, Karina?
Okay, Inez, thanks so much for kicking us off. We're going to stay on the markets, which have had really little conviction, rising and falling on headlines over Russia-Ukraine tensions and mixed signals. Here's what President Biden had to say just a short time ago about an escalation. Take a listen.
Mr. President, how high is the threat of a Russian invasion right now?
It's very high. It's very high because they have not moved any of their troops out. They've moved more troops in.
Is your sense that this is going to happen now?
Yes. My sense this will happen within the next several days.
And of course, Russia denying flat out that its plans to attack. Okay, for more, let's bring in our market guest, Jim Warden, Chief Investment Officer, Wealth Consulting Group. Jim, thanks so much for being here. Just your reaction. I mean, nobody really knows what's going on. It's a question of he said, she said, but what is the reaction, market sentiment, and then what do you think it does, more importantly, to Fed policy come the March meeting?
It's a good question. So there's a lot of factors that are affecting volatility right now. I think right now, number one is Russia, Ukraine. Certainly, this isn't a major issue when it comes to GDP growth and earnings growth for most companies, but it does something, I think, to investors in terms of their sentiment and investor psychology. So I think that this is something that we're going to continue to monitor. But also earnings are slowing in some cases, and in some cases the reports have been great reports, but the outlooks have not been that great, and we've seen some of these companies pull back because of that.
Yeah, and Jim, I want to talk about earnings more in just a minute, but first just want to get your, before this geopolitical tensions, we were firmly looking at, inflation and Fed policy. So I'm wondering, after that CPI number that we got, and then PPI, 9.7% gain year over year, has inflation, in your opinion, peaked? When does it start to moderate, and where does it end the year, vis-a-vis what the Fed's target is?
Yeah, as it relates to Fed policy, I believe that the Fed is actually, the markets are pricing in a more hawkish Fed than what we'll see. The yield curve has flattened dramatically when we look at 2s and 10s. This is not a great sign as it relates to future growth. We still believe we're going to see mid to high single-digit growth in equities this year. But I think a positive would be if we can bring inflation down to 4 by the end of the year. Now, what the Fed is doing, that's going to help quite a bit in terms of raising short-term interest rates off of 0. But there's some natural things that can help reduce the inflationary pressures. The supply chain issues, as they moderate, as they get back to normal, as COVID, hopefully we don't get another strain here, knock on wood, but as that does kind of get removed from the picture, that will alleviate some of the pressures. One of the challenges is we have a lot of consumers that are flush with cash, and as we see with the Walmart report, they're still spending. But as oil prices continue to stay high, as other commodity prices are high, eventually we do believe we're going to see inflation come down.
So let's talk a little bit more about earnings. As you said, Walmart basically hit it out of the park. NVIDIA, in my opinion, had a really strong quarter. Demand is strong. Their outlook was good, but yet investors are punishing them. Are we expecting too much? Or is this more about a margin story?
Yeah, I think it could be more the latter. There's a lot of speculative money that has gone into the markets over the last couple years. I don't think we're in this moment. This is not a back up the truck on stocks moment. But when you do look at companies like NVIDIA and AMD and Intel that are down, in some cases 30, 40% or more. I think selectively you can look at these companies and say, hey, these companies will be around here 5 to 10 years. They have good, solid growth. And so for some of those companies, I think it makes sense to have exposure if you don't already. Some of the other names that have just gotten too rich in valuation, they're being repriced along with this higher inflation and higher anticipation of rates.
And Jim, I want to ask you about hotels. They've been reporting this week and some hits and misses. So Hyatt and Hilton having some issues, but saying RevPAR is up. Marriott saying they're seeing growth in both business and leisure travel, but they're still about 12% down from pre-pandemic levels. So is this a sector that you advise staying away from right now, or is it a good time to jump in and get some deals?
Yeah, I think it comes down to price, and we like growth, but we want it to be quality growth. We want it to be at the right price. To the extent that we're seeing consumers move away from the economic activity by consumers move away from products and more into services. Services was the area that got hit the most during this pandemic, and it's still ongoing. But things are getting better. I'm optimistic that we're going to see more travel. We're going to see more, staying in hotels and things like that. When people feel comfortable, that will increase. It just takes time to get back to where they were prior to the pandemic.
And then, Jim, a lot of liquidity has left the markets, but I want to get your thoughts on allocation, particularly cyclicals and energy.
Yeah, so we continue to like energy. We like industrials. We like financials. If we have a situation where growth becomes a challenge and this yield curve is getting flatter and flatter, and there's a potential that it inverts, we will continue to monitor that very, very closely. But to the extent that this is more short term and we do see more of a shift higher and longer term rates, yeah, these are still areas that we like. The thing with energy is, this is probably not going to be a longer term trade, just because we're going to see more production come online. Consumers are going to start feeling it more when they go to the pump. And so that may not be like a long-term trade, but we still like it. We're still overweight. And it's certainly helped from a diversification standpoint when other names, like information technology have gone down. Energy has certainly helped.
All right, Jim, tons more questions for you, but we're out of time. We'll have to leave it there and hope to see you back again. Jim Warden, Chief Investment Officer, Wealth Consulting Group. Thanks so much for your perspective today. And we want to help you step up your own portfolio and strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. Just check it out today at yahoofinance.com/plus. And I know there's much more coming up. I will turn it over to Alexis.
Thanks, Karina. With new COVID cases falling 19% globally, just how close are we to the end of the pandemic? We have a medical expert weighing in next. Welcome back. COVID-19 deaths are starting to decline in the U.S. following a sharp drop in hospitalizations. It's the latest sign that the surge fueled by the Omicron variant is fading. So just how close are we to the end of the pandemic? Joining me now is Dr. Jay Schnitzer, Chief Medical Officer and Chief Technology Officer at MITRE. Doctor, thanks so much for being with us. In just the past few weeks, we've heard from Dr. Anthony Fauci, who said that the U.S. is exiting what he called the full-blown phase of the pandemic. And just this week, Moderna's CEO said it is, quote, reasonable to assume that we may be approaching the final stages of the pandemic. To your mind, how close are we to the other side here?
Well, I think nobody knows for sure. By the way, great to be with you, and thank you for having me. Nobody knows for sure, but I too am cautiously optimistic that we are getting close to the end of the pandemic phase and hopefully entering the endemic phase. The numbers are certainly coming down dramatically, particularly with Omicron over the past few weeks, and hopefully will continue to do so. My word of caution, however, is that this virus is teaching us humility every single turn of events over the past 2 years. And we've got to be a little bit humble about our projections again today. It could mutate or create a new variant that could create problems for us in the not too distant future. We just don't know.
So to that end, I just want to bring up Denmark as an example, because earlier this month, it became the first major country to lift the last of its COVID-19 restrictions, in essence, declaring this pandemic over. And since then, Denmark has continued to record more COVID-19 cases per capita than anywhere else in the world. Both COVID hospitalizations and deaths have now shot up by about a third in Denmark. So what's the takeaway there for us here in this country and elsewhere as we look to lift these COVID restrictions?
The takeaway is not to reduce the restrictions too prematurely. We really need the total number of cases per day, the hospitalization rate, and the death rate to be way down low into a trough so that community spread is really under control. The issue was for Denmark and still is for the US that even though we've come down a great deal on the Omicron new cases per day and hospitalizations, we aren't all the way down to a trough where we need to be and would like to be. And if we relax on these restrictions too prematurely, we'll see exactly what's happening here in the US. We'll see exactly what's happening in Denmark. By the way, we've seen this before. This has happened in previous surges as well, when some of the non-pharmaceutical interventions were relaxed and removed prematurely in various locations.
So then should we be rethinking lifting things like mask mandates, even in areas where numbers are trending lower?
Well, it's hard to say because the politicians are going to do what the politicians are going to do for a variety of reasons, which cover all kinds of inputs. But I would say that as individuals, we should practice good and safe behavior. So if you are going into an area that is crowded and indoors and you don't know the vaccination status around you and you can't maintain social distancing, even if there's no mask mandate at that location at that time, it is prudent to wear a mask. And same thing with social distancing, same thing with avoiding crowds, and the same thing with practicing good hygiene. We can all continue those things. I would hope that our leaders would suggest very strongly that we continue doing those things until we hit a real trough. But if they don't, or if they relax prematurely, I think the rest of us need to practice wise behaviors.
I know that more studies are coming out about what's called long COVID as we all continue to learn about this virus. There are some reports saying it could have long-term impact on your heart and how it functions. Some people are having difficulty sleeping after having had COVID. What have we learned lately, and what is the best path forward?
Well, so long COVID continues to we learn continuously as we go forward, and I'm sure we don't know much more than we do know about it, although we know more than we did a year ago. But it is an ongoing issue, and you're absolutely right. The range of symptoms vary from heart symptoms to neurologic symptoms to sleep disturbances to muscular issues, and probably more. And we're going to learn more going forward. I think the key is, if you can possibly avoid it, don't get COVID. I mean, the only way to get long COVID is to actually have had a COVID infection. So to all those who say, Omicron's not so bad, I'm just going to get the infection and move on, putting you at risk for long COVID, the consequences of which we don't fully understand yet. And I think we're going to learn over time that some of these long-term effects last a long time and are pretty debilitating and cause severe long-term disabilities. We got to keep people from getting the infection to begin with.
Right. And some people were even seeing that as a defense, saying, well, let me get COVID so I have the antibodies to fight it. You're saying that that's not the path forward. Before we let you go, Doctor, want to ask about a possible new variant, because we're seeing these global cases drop, yet the World Health Organization says a subvariant is spreading. Do we know about another variant out there right now, and what does it look like?
We don't have very much in the way of details, and so we really don't know. We'll have to watch and monitor very carefully and very closely. We don't know which of the future variants are going to cause the most trouble. What I would say is the next one could or could not be an issue, but there'll be one after that, and then one after that, and then another one after that over time, over months, and perhaps even years. This is something we're going to have to get good at in terms of tracking these things and figuring out which ones are the ones to worry about and then what to do about them going forward.
All right, Dr. Jay Schnitzer, Chief Medical Officer, Chief Technology Officer at MITRE. Thanks so much for your insights today. Karina, we'll toss it back over to you.
Okay, and coming up, a conversation with the CEO of Restaurant Brands International and a partnership with, I'll admit it, one of my favorite entertainers. Stick around. Welcome back. Well, Restaurant Brands released earnings earlier this week that beat estimates. CEO Jose Sil joined Yahoo Finance Live to discuss the report and the company's partnership with Justin Bieber. Take a listen.
We were really excited about the performance at the end of the year. We saw, I'll come back to Tim's in a second, but we saw a sequential acceleration in our comp sales for all brands. We saw good momentum from a development standpoint. We had more commitments for new development and new markets for Popeyes and Tim's than ever before in 2021. We saw good growth in system-wide sales in the neighborhood of 14%, and we saw really good momentum from a digital sales standpoint. So we grew almost 70% year over year in digital sales and got to 10 billion for the full year of 2021, and that cut across all brands, actually, internationally as well as domestically. And then we had a really good capital return to shareholders in the quarter and for the full year. So it was an exciting finish to 2021. Lots of work to do still. And Tim's was a really important part of it. We saw really good sales momentum in the quarter. Obviously, I shared during the call on Tuesday that the Bieber promotion, the Tim Biebs promotion, was really quite powerful and helped us engage with a younger audience. But what was exciting about the performance is that it was really based on kind of the underlying core business growing. So we had an espresso-based relaunch in the quarter, and that did really well, reintroducing Canadians to our great lattes. We had our breakfast offering continue to do well. Our lunch offering and dinner offering beginning to gain some momentum. We've made a lot of progress on innovating for growth around the core with beverages as well as food. So, and our digital business has become really powerful. It's a third of our sales in Canada going through our loyalty program. So a lot of good momentum, and the Tim Biebs promotion was basically icing on the cake, and that's why I was happy to share that I'm a believer and really looking forward to to additional collaborations with Justin in the coming year.
Well, Jose, the world is indeed filled with believers, and I'm going to contain myself not to ask you another one here, but I want to know what you talked about on the call regarding reclaiming the flame. What is going on with the Whopper? Is it still going to be put in plaster all over coupons? What's your strategy to revive that burger?
Yeah, look, we have a new leader in the business. Tom Curtis joined. He's been with the company for a bit of time, but he joined as president for Burger King, and he was on the earnings call on Tuesday. So he had a chance to introduce himself to investors and analysts all around the world. Lots of experience, comes with nearly 35 years of experience in the space. As a franchisee, in addition to being a senior leader in the QSR space, and tons of operational experience, which is really critical. And the view, and Tom and I have worked together with the Burger King leadership team as well as the franchisees. The focus, there's a lot of excitement. The focus is all around the customer and making sure that we do a great job delivering our great tasting products, our flagship being the Whopper, doing it exceptionally well, and doing it through the different channels that we've been expanding upon over the last couple of years. Digital becoming more important. Drive-through obviously has been an important part of our business for a long time, but it's gotten even stronger over the last 2 years. We're investing behind it. We have outdoor digital menu boards and technology that's enhancing that experience. And so the team is really focused on the guest experience, and Whopper being at the center of that. We felt it was important to invest behind it, to elevate an already flagship and iconic product, and make sure that it becomes the centerpiece of our game plan going forward.
Jose, why isn't there a Whopper chicken sandwich? When I think Whopper, I just think huge. I would sign up for buying a Whopper chicken sandwich with 3 pieces of chicken on it. I'm okay with paying a little bit more, but it makes sense to me.
Look, I think if you weren't so good at what you do, you'd probably be in marketing or in product innovation, Brian. But look, we have a very strong chicken business. We've been in the chicken business for since the late 70s with the original chicken sandwich. And we think it's an important part of our business. We've got the chicken fries as well, which is a very unique and innovative handheld chicken product. We've got the nuggets. And so we believe in chicken at Burger King. We think it's going to be an important part of the business going forward. And the team is taking time to evaluate the entire portfolio, make sure we've got the best products, the best offering for the customers, and make sure we can deliver that exceptionally well through our drive-thrus, through digital and other platforms and service modes as well.
Oh, Brian Sozzi, come on now. A Whopper's a burger. Everybody knows a Whopper's a burger.
Whopper's big. You can still flame grill anything. Come on.
You can. True enough. Jose, I want to ask you about pricing. You talked a little bit about on the call. You raised prices last year, and your franchisees did. You expect some more price increases to come through this year. Now, of course, it's a very diverse set of different types of restaurants, but what kind of insight can you give us into a magnitude here? How big are price increases going to be? Where potentially are those increases going to be?
Look, our focus is making sure we manage the difficulties and challenges that you may face from time to time with these commodity inflation, and we're certainly in a very unique moment. But at this and making sure we've got the right margins for the franchisees, but at the same time ensuring that we address consumer demands and we don't get too far ahead of the consumer from a pricing standpoint. So we work closely with the franchisees. They have access to third-party consultants, so they can really analyze locally what's happening, make sure they understand the impact on their P&L, but understand as well what's happening with the competition, as well as what's happening on the consumer side. And then we take a very cautious and measured approach in terms of taking pricing at the right levels to ensure we manage both sides of the equation and don't get too far ahead of the consumers.
Okay, that was Restaurant Brands International CEO Jose Sil talking about pricing, the chicken sandwich wars, and the Beebs. What else is there, Alexis? Over to you.
We got a lot in there. I think I'm hungry now. All right, thanks, Karina. Coming up, how Starbucks is planning a more diverse workforce when we speak with the coffee retailer's Chief Inclusion and Diversity Officer next. Welcome back. As part of Yahoo Finance's coverage of Black History Month, we're shining a light on Starbucks and its efforts to hire and promote people of color. I'm pleased to welcome to the show Dennis Brockman, Starbucks' Chief Inclusion and Diversity Officer. We're also joined by Yahoo Finance's Brooke DePalma. So Dennis, welcome to Yahoo Finance and good to have you on the show. I want to start with Starbucks' lofty goals in this area, because a couple of years ago, you all said that by the year 2025, you wanted to have people of color in at least 30% of all corporate jobs and at least 40% of all retail and manufacturing jobs. So I'm curious, how close are you, Dennis, to achieving those goals? And are there some areas that are stronger than others?
Well, thanks. It's great to be with you. Let me share, you're right. Starbucks has always set out to be a different type of company, and we set some aggressive goals because we do believe diversity attracts diversity. And so as you look at those representation, those goals that we've set, I shared with our partners in an open letter last month, we've made great progress in just about every category. However, I also shared that we will need to move faster and accelerate the growth of representation. Our partners are telling us I think throughout all America, that they want to be able to look up and see individuals in leadership that looks like them. And that's why we set those hefty goals. So I'm very pleased with our progress, but there's more to do.
I want to know, what is the biggest lesson that you've learned so far?
Wow. I've been a partner for 14 years. I've been in this role for 1 year. And what I've learned is that it's important for us at Starbucks to continue to live our mission and values. It's what's made us successful for the first 50 years. With that, I've also begun to really understand the importance of our third place, what we create in our stores. We know that our partners are the heartbeat of this organization. And there is a need for a human connection. We hear it from our partners, from our customers. What I've learned is that third place, not home, not work, it is so critical. And we want to ensure that we are sharing with our partners and we're listening and we're learning from our partners, because they are creating that third place for every customer in every community that we serve in. And so the work that I get to lead here is ensuring that we're creating an environment for our partners to feel welcome and a sense of belonging.
Dennis, I just wanted to follow up on some of those numbers regarding your goals. So I know that people of color rose to 48% of the workforce last year. That was up slightly, about 1% from the prior year. Definitely some progress. But when we look a little deeper, I know that in manufacturing, people of color there slipped a little bit. Can you tell us why, and what are you doing to sort of catch up, if you will, to reach those ambitious goals?
Yeah, I've had the opportunity to meet with our leadership in manufacturing. And I think like every other company, that's an opportunity for us. And so we are going to be very intentional. We set out, when we think about this work of inclusion and diversity, to be very intentional, to be transparent, and be accountable. And we're going to hold ourselves accountable to those numbers. And so our leadership in manufacturing is working extremely hard. We're looking at other initiatives, such as our Accelerator Development Program, and how can we add some of those individual contributors in our manufacturing into those programs to make sure that we're creating a pipeline so that we can see those numbers increase in our manufacturing plants.
Dennis, I want to pivot the conversation a bit here to the store level. Across the U.S., we're seeing these unionization efforts pop up at local stores. Now, as you noted, you really rose up in the ranks at Starbucks, coming from a district manager to the current role that you're in, 14 years. Do you think more needs to be done?
Well, let me be clear. I want to be very clear here. Starbucks is pro-partner. We're not anti-union. We want every single partner who works for Starbucks to love working for this organization. Our mission and our values is what has guided us for the first 50 years, and it will continue to guide us. And so to answer your question, we will continue to listen and learn from our partners. We will continue to live our mission and our values, and we will continue to make sure that every single partner that works in our stores feels valued and feels a sense of belonging.
Dennis, I know before your current role, back in 2018, Starbucks grabbed the headlines when it closed all of its stores to train its employees in this race bias sensitivity training. That was 2018. I'm wondering if you're still doing that bias training, and how are you measuring progress in that area?
We are. So we have ongoing training for all of our partners, even our partners in our stores. And we measure it in different ways. We get to measure it in surveys that we do at every level of the organization. And what we know that our partners are telling us that they see us improving in the area of inclusion and also in our representation here at Starbucks. And so that training is ongoing, and we will continue to train. Here's what I believe, and I've shared this. Inclusion, and it's important to understand inclusion, but you can't understand inclusion unless you have been excluded. And I've been part of that. I've been excluded. And so I take this work personal because I know that to be excluded, it hurts. And we want to make sure that every single partner, all 400,000 partners here at Starbucks, feels a sense of inclusion and self-belonging in every customer who walks into our stores.
All right, Dennis Brockman, Starbucks' Chief Inclusion and Diversity Officer. Thanks for being with us, and good luck with reaching those goals.
Thank you.
Karina, over to you.
Yeah, that was a really great, valuable conversation, guys. Okay, coming up after the break, the results of a 6-month study by one nonprofit to see how expanded child tax credits extended to millions of families have helped them stay solvent and save. Welcome back. Last summer, the Biden administration launched an anti-poverty initiative as part of its American Rescue Plan. Our next guest says those expanded child tax credits of up to $300 per child for a period of 6 months were instrumental in the lives of her nonprofit's members. Joining us to discuss is Radha Seshagiri. Thank you so much, from the Saver Life Director of Public Policy and Systems Change. Radha, thanks for being here today. So you conducted a study that lasted 6 months, and you say the results show that these payments weren't a luxury, but more of a lifeline. 92% say the money made a difference. 59% said it made a huge difference. So what sort of financial stability do they offer, particularly as costs are going up for everything?
Thank you for asking, and thank you for having me on today. Here at Saver Life, we work with 600,000 people all across the country to help them in their journeys to build financial stability for themselves and their families. So we monitor the impacts of the child tax credit very closely. We expect that almost 80% of our members use and benefit from the child tax credit to build that base of financial stability by saving and by meeting basic needs. And when we conducted the study across the last 6 months of child tax credit payments, we found that 61% of families were using the child tax credit payments for basic needs. This is keeping food on the table, keeping the lights on, keeping roof over their heads. And that was in July. And by December, that number had started to creep up. In December, we saw that number went up to 74%. So this is really helping families stay afloat. And we're also noticing that the child tax credit payments are keeping savings balances stable so that families have that cushion in case that emergency comes up, which is always around the corner for any of us.
And then, Radha, what are some of the other things that the money was used for? I know utility bills is a big issue for some families.
That's exactly right. We saw that folks who received the child tax credit payments were able to pay their utility bills in full. And with the rising cost of heating, getting ready for the winter, people were able to literally heat their homes and keep the lights on. And so this signals to us that families are able to provide for their children, provide for their families. And the child tax credit is really helping to give that strong start, strong foundation to all families. And I have to tell you, I'm a parent myself. I saw my electric bills and my gas bills these last few months. And I have to tell you, it gave me a lot of peace of mind to know that I could provide a comfortable home for my kids and my family.
And then I wanted to ask you, you touched on it, but how vital are these CDC payments to really help shoring up, the accounts for some of these families, and not just being able to have a little bit money in the bank, but actually building up a savings that will help them in the future?
Thank you for asking that question. It's something we think about every day here at Savor Life. We know that even before the pandemic, 40% of families across the country did not have $400 for a flat tire, for a child's broken arm, or any other unexpected expense. So we look at savings really carefully. We think about it really deeply, and we were monitoring how the child tax credit would make an impact on families, if it would help build that nest egg and build for the future. One of the members that we work with, she lives in Las Vegas. She told me with her child tax credit payment, she puts in $100 every month into her daughter's bank account. Her daughter is about 1.5 years old. And when her daughter grows up, she wants her daughter to have the opportunities to take that extra class, to sign up for tutoring, to go to college, or whatever her dreams that her daughter may have. And we see how the child tax credit is essential to helping families build that base of financial security and wealth for generations to come.
And then really quickly want to just touch on, it's tax time. What does that look like for families this year as those credits have now ended? How do they sort of look to tax season and try and build wealth from that?
Yeah, thank you for asking. It's normally a time when one would receive a tax refund and can put money away towards savings, to revisit finances, to re-examine debt. This year, it's a lot more complicated. The cost of basic needs has gone up. People are driving to work and the cost of gas has gone up. So while many are trying to put away and re-examine their finances at tax time, we know that it's more complicated this year with the child tax credit payments ending.
Okay, many people would like to see that credit become a permanent feature. All right, we will have to leave it there. Thank you so much, Radha Sheshagiri, Savor Life Director of Public Policy and Systems Change. Thanks for your time and your perspective today. And Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Alexis, I'll throw it over to you.
Thanks, Karina. Lawmakers considering a gas tax holiday to ease inflation pressures. We've got details coming up. Welcome back, everybody. Stocks continuing to come under pressure here today. As you can see, all three majors sharply lower as President Biden said that the threat of a Russian invasion of Ukraine is high and that it could happen in the next several days. The broader market being led lower by financials and technology. All right, with gas prices at an 8-year high and midterm elections on the horizon, some Democrats are considering suspending the federal gas tax to give Americans some badly needed relief at the pump. Yahoo Finance's senior columnist Rick Newman joining us now with more. And Rick, you wrote an article for our website on this, calling it silly. It's a silly idea, you say, that has no chance of passing in Congress. Why do you say that?
There aren't even enough Democratic votes to pass it, and there are no Republicans who want to do this either. What's going on here is American drivers obviously feeling pain at the pump. Gas prices are not at they're not at historic record highs, but they're pretty high, averaging around $3.55 a gallon. They've been higher than that, but nonetheless, that's a big increase in energy costs for people. So some Democrats in Congress say, oh, well, just to give drivers a break for a little while, let's suspend the federal gas tax, which is 18.4 cents a gallon. And if we did that, well, in theory, for every 10-gallon fill up, you'd save $1.84. But they don't have the votes to pass it. Joe Manchin and others, he's the senator from West Virginia who seems to be stomping on all the Democrats' legislation. He said, no, this is not a good idea. We're not going to do it. There's some liberal Democrats who don't want to do it either because they're pushing for green energy investments and a green energy transformation. And if you make carbon energy cheaper, well, it makes it harder to transfer over to green energy. And even if this did happen, Alexis, it's not likely that gas prices would automatically drop by 18.4 cents a gallon because everybody in the supply chain would want to capture that suspension of the tax for themselves. That goes from producers to refiners down to retailers. So if it even happened, it would probably be a while before consumers saw any relief at all. And if it did, it probably wouldn't be 18.4 cents. It'd be probably something less than that.
And hey, Rick, it's Karina here. Great story on the website. So you say the likelihood of Congress passing anything is very unlikely at the moment. But what sort of wrench does Russia-Ukraine tensions throw in the mix? God forbid there is an escalation. Let's say Russia does invade. Gas prices will likely go higher. Does Congress have to reevaluate then? And then could we see a cut?
I don't think Congress is going to reevaluate because I just don't have the votes to do this. I suppose if something really dramatic happened, such as gas got over $5, maybe they would start to consider something. But President Biden himself has said, look, Americans need to be ready for higher gas prices in the short term. Energy analysts say the current standoff between Russia and Ukraine and the threat of an invasion is probably imposing around a $5 per gallon fear premium on a barrel of oil. Oil is now over 90, it's around $92. It's pretty high. So this could go a couple of different ways. If if there's a stand down and some kind of diplomatic breakthrough, we're going to see oil prices fall, not dramatically, but they could fall $5, $7, $8 a barrel, and that will eventually mean gas prices will fall. But if there's an invasion, gas prices and oil prices are going to go higher for sure because Russia's a big oil and natural gas exporter, and there would suddenly be a risk of sanctions that could interrupt those exports and all kinds of other things that could happen, including military damage to energy infrastructure. So this is a big uncertainty for energy markets right now. And unless Russia backs down, it's going to remain an uncertainty for weeks or months.
Yeah, so oil continuing to be this political football too, Rick, with the midterm elections, right around the corner. All right, thanks so much, Rick Newman. Karina, back over to you.
Okay, and we want to get you a quick check of the markets before we head out. If we can pull them up and take a quick look. They are at or near session lows. The Dow down by 407 points. The S&P is lower by 63 points. And the NASDAQ, the big lagger, down by 1.99%, 281 points at the moment. All right, we have got much more market news ahead as we continue to monitor Russia-Ukraine tensions. We also take a look at the lumber industry and how sky-high prices are exacerbating what many call a housing crisis. Stay with us.
Through the roof. After a short reprieve, prices for lumber are back on the rise, adding about $20,000 to the cost of a new home. What's behind the surge, and when can home buyers expect some relief? Going into debt to get out of debt. We speak with one company helping millions of Americans navigate their way through personal bankruptcy. And Olympic medals are worth more than just glory. They can lead to lucrative sponsorships and business opportunities. We look at how Olympic athletes are leveraging gold medal fame into a financially secure future. Welcome back to Yahoo Finance Live, everyone, where it is 2 p.m. here on the East Coast. I'm Alexis Christophers, along with my co-host Karina Mitchell. It's another risk-off day for the markets, where stocks are sharply lower across the board. Strong earnings today from Walmart and DoorDash being upstaged by the growing threat of a Russian invasion of Ukraine. Let's get right to Jared Blickery, who's keeping his eye on some trending tickers today. And we're going to hone in on the semiconductor space here, Jared, and NVIDIA in particular, out with earnings that on their face looked really good, but the stock getting punished. I guess it's those margin pressures that have investors disappointed.
You bet. The supply chain affecting everybody, and now NVIDIA. The revenue numbers were just incredible. The revenue guidance incredible, but if you're priced to perfection, you might see some downside action. That's what we're seeing today. In fact, you can see the entire semiconductor class that we have up here largely in the red. Here's today's price action, down 7.5%. Over the last 3 months. Now, a lot of these technology stocks peaked in the fourth quarter last year and are now trying to recover. You can see still down about 16% from that three-month trailing mark. Now, Summit Insights Group, they're concerned about margins as well. They're downgrading the stock to a hold, and this comes as they're saying that gross margin is now close to the peak, and they see the higher possibility of downside risk from the crypto mining market. And we know that crypto prices have been depressed recently, falling about 50-60% from their recent highs. Citi, which rates the stock a buy with a price target of $350, that's about $100 above the current price, saying the stock's negative reaction likely reflects a recent run-up in line gross margins and a modest beat for the data center. However, the outlook implies accelerating data center growth, and Citi would go ahead and buy ahead of a strong second half of the year. Also, a quick note from Bernstein, outperformed, that is what they rate the stock, with a price target of $360, even higher than the last. The report gives investors what they presumably are asking for, namely strong secular growth and continued reason to dream. The revenue guidance once again crushed consensus. So there you have it, some great numbers, but again, as we've seen during this earnings season, investors can be very fickle. A lot of stocks getting punished today.
Yeah, absolutely. I don't see any reason why NVIDIA got punished because, as you say, the numbers were really good. On the flip side, DoorDash doing very well today. Thank you very much. Revenue soared and orders soared as well, although it posted a loss for the quarter, but outlook being called better than feared.
That is right. And Evercore is weighing in on this. They're saying the quarter one and fiscal year 2022 gross order volume, guides bracketed the street at the low end of the midpoint, respectively, much better than recent market fears that Dash's gross order value growth outlook would disappoint. And so they're removing Dash from the firm's tactical action and positioning list after the company delivered better than feared results and guidance. Now, here's a 3-month chart of DoorDash. Let me just put this to a max because they are a recent IPO. About 1 year ago is when they came to market. You can see they have well undercut the lows of last year that they had in May and sitting by those record lows right now. So given the volatility in the stock recently, maybe 10% up today isn't the best thing to celebrate, but I think investors will take it after this big slide here. Also wanted to quote Barclays here. They're saying the combination of strong GOV growth and lower sales and marketing expenses speaks to the strength of Dash's business model in contrast to other players in the industry with higher retention, higher subscriber order mix, better driver supply, and overall better unit economics. And we know this is a very, very fickle and competitive space. As you can see, one of the few outperformers today.
All right, and Jared, I want to get to our Yahoo Finance Plus investment idea of the day. It is a bullish call on MGM Resorts. I know they posted some pretty strong fourth quarter numbers after those Nevada casinos fully reopened after being shut down during the pandemic.
Yeah, that big news there. They've been waiting for that for some time. Let's get to Argus Research reasoning on their bullish call on MGM. Now, they do have a long-term price target of $52. That's about $8 above, and they're saying that this is a strong quarter. They're reiterating their buy. We expect MGM to benefit from the full reopening of Nevada casinos and look for a rebound in the company's convention business. Management's efforts to drive growth at BetMGM, the company's sports betting and iGaming segment, also bode well for the future results. They're upping their price targets, as we can see. And this is a stock that has largely gone sideways over the last few months, but still up 26% for the year, guys.
All right, thanks a lot, Jared Blickery. We'll see you a little later on for the recap in oil. Let's stay with the markets now and bring in John Lynch, CIO at Comerica Wealth Management. John, good to have you here. I know you just heard that segment there with Jared, and we started off talking about margin pressures at NVIDIA. We're seeing it across the board of a lot of companies out with earnings right now. Do you think that these companies are going to see any margin relief in the second half of the year?
Good afternoon, Alexis. Delighted to be back on. Yes, I think margins are the big story for the quarter. Quite frankly, I'm not convinced how many investors are really concerned about the fourth quarter. I think they're all forward-looking at this point, right? They want to know about, to your question, the second half of the year. And while some of the longer duration stocks that you just mentioned, long duration, lower margin, or declining margin type stocks, high valuation, may struggle, we do think cyclicality will lead in some of the margins. For example, in the S&P 500, we're looking for at least 12% margins to sustain through 2022. So we may have some variability between margins even within sectors, but we think overall as a whole for the index, margin should be sustained in that 12% range.
Of course, the main event in March, at least, is going to be the Federal Reserve meeting. And yesterday we got those Fed minutes from their last meeting. We didn't seem to get a lot of clarity, though, John, in terms of, what policy makers are thinking in terms of a 50 basis point hike versus a quarter basis point hike in March. What would you like to see happen? What do you think is the right thing for the Fed to do if they're listening and you want to give them some advice?
Absolutely. I'd love to. The new March Madness will be the Fed. You're absolutely right. And I think that 50 basis points is appropriate in March. The Fed wants to reestablish their inflation fighting credentials. I think that's going to be difficult for them to do with 9% wholesale prices, 7% consumer prices, yet they're still buying $20 billion a month in treasuries over the next 4 weeks. So we have to be very mindful of that. So I think it'll be very important for the Fed to really show the global markets that they're serious about this, do 50 basis points this time, quarter basis point the ensuing 3 meetings. And at that point, I think we'll get a good assessment on really the year-over-year base effect changes, and we'll get a handle on supply chains. And I'm still not convinced we're going to see a lengthy, call it 3-year tightening cycle. They could be done at 1.5–2% on the short end of the curve.
What do you think? I mean, when they finally start to run off the balance sheet, what will the impact be on yields? Because we've seen the 10-year yield pull back a little bit from 2%. There are some who are calling for that yield to hit 3% later this year. And we all know that in the past, when we see that flattening yield curve, it sometimes portends a recession on the horizon. So what are your thoughts in terms of the yield curve? And are you worried at all about a recession? Is that part of the conversation for you?
Absolutely. I get paid to worry, so I look at it all the time. But when I look at the yield curve currently, as I mentioned earlier, the Fed is still buying $20 billion in treasuries over the next month. Okay, it's an out-of-body experience thinking about, again, 9% wholesale prices, 7% consumer prices, and they're still buying, but that's the plan they set out. I do think that the yield curve right now, the long end is under pressure because of geopolitical tensions. I think to some extent we had the Omicron scare over the holidays into January. As the Fed begins to unwind the balance sheet, say we do 50 basis points and a 2 or 3 quarter basis points thereafter at ensuing meetings, as they start to unwind the balance sheet, call it by mid-year, say they do 50 billion a month, you suddenly are at 300 billion less on the Fed balance sheet. By year end, it's still an $8 trillion balance sheet at that point, but nonetheless, you don't have an $8 trillion balance sheet supporting the long end of the curve. So I think this flattening is just unique factors relative to Omicron, geopolitical tensions with Russia, and the fact that the Fed is still buying. Once the Fed starts raising, and once the Fed starts allowing, call it $300 billion off the balance sheet by year end, I think the yield curve will steepen, and I think that steepening of the yield curve will be more reflective of the global cyclical recovery.
So what I'm hearing here, John, is that you're pretty bullish on the market. And so where do you expect us to end the year? Do you have a projection for the S&P 500?
Well, for the next 3 or 4 weeks, we're standing at the precipice, right, looking down. But I do think once the Fed gets started, at that point, we can have the global cyclical recovery. I think that will be supportive of, again, I talked about 12% margins. I think that's consistent with, call it 8 to 10% profit growth for the S&P 500. And I think we're fairly valued at 5,000 on the S&P 500 by year end. So call it, a market that would move in line with earnings and income. I'm not looking at PE multiple expansion, but still, that 8 to 10% range on a total return.
And which sectors of the market do you think are going to get us there, John?
Thank you. We're still looking cyclically. We believe that shorter duration value type stocks, those companies with nearer term earnings and a rising rate environment, rising inflationary environment, you're going to see less demand for some of those longer duration names, some of those growth names that led for so long. And we've seen, value firming, we've seen cyclicality firming, we've seen profitable small caps firming. So within the sector space specifically, still like the momentum behind the energy space. I think financials will run commensurate with the yield curve and with higher interest rates. Industrials have been a bit disappointing, but I still think as the dollar backs off a little bit, once we get hopefully clarity on the geopolitical tensions, I think industrials will start to take off again with the global cyclical recovery. And the fourth sector that we like is materials, and they've been pretty much running commensurate with the energy sector as the market, and commodities as the market is pricing in renewed global demand.
For sure, that they have. All right, John Lynch, Comerica Wealth Management CIO. Thanks for your insights on the market today. We appreciate it. Karina, back over to you.
Okay, thank you so much, Alexis. Coming up, a look at the impact of convenience and getting those one-day deliveries to your door. Stick around. Welcome back. In a world where one-day delivery is considered on time, getting those goods into stores is becoming more expensive to do by the month, suggesting shoppers will find little relief from high inflation. For more on this, let's turn to our next guest, Brian Burke, Seco Logistics Chief Growth Officer, along with our very own Yahoo Finance's Danny Romero. Danny, take it away.
Thanks so much. And thank you so much, Brian, for joining us. Let's dive into supply chain. So Seco Logistics is a freight forwarding company. What are the advantages for businesses to work with a freight forwarder?
Yeah, thanks again for having me. The advantages of working with a freight forwarder is all about capacity. We provide optionality for shippers that are looking to both import and export products all around the world. Optionality has been so critical during these past 2 years due to disruption in the global supply chain. We've seen increased volatility, uncertainty, complexity, and ambiguity, which makes it very difficult to navigate which ports to send your product through, when to switch from ocean to air, when to expedite. It's been a challenge. What freight forwarders do is we provide optionality and choices that can create the best solutions for keeping cargo moving around the world.
And to that point, Brian, we've heard from businesses, small and large, that they continue to deal with the supply chain disruptions. Will this year be once again the year of air cargo flights, chartered flights?
Absolutely. 2022 is going to be a continuation, unfortunately, of much of the congestion and supply chain issues that we saw last year. So air freight and air cargo are going to remain to be very important levers for companies looking to keep their products moving, to keep the products on the shelves or ready to order in warehouses for e-commerce. This is going to be a critical year where we're also seeing the rise in an increased number of air charters. For example, Seco Logistics, we did about 70 charters in the year 2020. In the year 2021, we increased that to almost 400. And we expect to do 20 to 30% more this year, finding capacity for our clients. So these range anywhere between e-commerce, pharmaceuticals, defense, anything even including flowers for Valentine's Day. These are the products that are moving via air freight. And a lot of times, especially with consumer electronics, we're seeing that ocean is not really an option with the delays, not just at the ports on the West Coast, but now we're seeing congestion increase in the ports on the East Coast. And so typically this is a time of a lull period where not as much cargo is supposed to be moving internationally, especially on the import side, but that's not providing much relief for the congestion that we're seeing. So air cargo remains an important tool or weapon for companies that are looking to keep product moving in their supply chain.
Yeah, and Brian, I wanted to shift gears a little bit in regards to with the Russian-Ukraine tensions looming. What will be the impacts on air cargo demand, capacity, and rates?
Well, they won't be good because anytime you have geopolitical tension, it does create a lot of, it actually takes up a lot of demand for a lot of these air charters that exist. So when you're talking about defense goods that can be moved around the world, but the impacts that it has to the prices for oil and gas, that also has a negative impact on rates. Because you do see a lot of more activity from the oil and gas sector as well, that would be taking advantage of elevated rate levels to continue and expand their exploration of additional wells and drilling capacity throughout their network. So it has a double whammy effect on really increasing rates throughout the world. And with that, there's a number of other geopolitical implications and labor implications that we're looking at here around the world that could have negative impacts. The one green shoot that we're seeing, obviously, is the sharp reduction in cases around the world, especially in the United States. So we're a little bit more optimistic on the return of passenger capacity on the international side, starting in the spring of this year. Unfortunately, will not be anywhere near enough to keep up with the increased demand for air cargo, but that is one green shoot that we see as a positive sign that eventually we will return to normal, but that normal of the same amount of capacity of belly space on passenger flights as we're seeing cargo flights meeting pre-pandemic levels, we may not see that until the year 2024 or beyond. So it may be a drop in the bucket, but it's at least a green shoot that we're seeing that may alleviate some of the pressure, but there's enough issues out there in the global supply chains, from congestion to geopolitical issues to potential labor action, that may negate any of that additional capacity that we may be seeing introduced in April and May of this year.
And Brian, really quick, just to wrap this up, why is it that businesses like Amazon are looking to ramp up its charter operations?
Well, they're certainly not the only ones. There's a number of companies in the fashion apparel space and the pharmaceutical space that have looked to control their own destiny as much as possible, controlling their own capacity. It's really all about capacity. When the pandemic started, we have to remember that 60% of global air cargo flew on the belly of passenger aircraft, especially on the international side. So when the pandemic started and 95% of all international flights were simply grounded, and this was not just for a day or a week or months, this was well over a year that we saw reduced capacity of significant levels and proportions, it had an immediate impact on companies finding available capacity, because after March of 2020, when a lot of these flights were grounded, by the summer of 2020, we started to see that increase in demand, especially for e-commerce. And as we all know, that increase in demand has not let up at all. We may not see the year-over-year growth levels that we saw, but they're certainly continuing to grow. And so companies in any space that are looking to find dedicated, secure capacity, whether that's through themselves chartering their own aircraft or whether they're working through a freight forwarder, we're going to see more of that this year, because it's all about capacity, and the capacity challenges are going to remain in the year 2022.
And thank you so much, Brian, for all of that information. I'm going to toss it back to Karina.
Okay, great conversation, guys. Thank you so much, Brian Burke, Seco Logistics Chief Growth Officer, along with our very own Danny Romero. We've got much more coming up. Stick around.
Welcome back, everybody. While we were away, the three major stock indexes hit session lows. In fact, the Dow Jones Industrial Average now down more than 500 points, being led lower by losses in Salesforce and Goldman Sachs. The broader market also taking a hit here, with financials and tech leading the decline, now down about 75 points. You've got the NASDAQ composite once again taking the brunt of the losses, off more than 318 points. In this week's episode of Influencers, Yahoo Finance's editor-in-chief Andy Serwer sat down with data scientist and Facebook whistleblower Frances Hogan for a look inside Meta headquarters.
You know, the Facebook campus is so fascinating to me as like an architectural object. So most people aren't aware, but Facebook has the largest open floor plan office in the world. It is 1/4 of a mile long. It sits 5,000 people. It is such an amazing, you know, medieval societies built cathedrals because they were societies that were oriented around God, right? Like you had these Gothic arches that lead your eye upwards, like to the heavens, right? Facebook's campus is a physical manifestation of their obsession with flatness. Like the idea that we are all on the same level, that, you know, their leadership style is we have metrics and people can do whatever they want to move those metrics. Like we embrace the freedom of like individual employees. But when you don't acknowledge that power differentials exist, you actually reinforce those power dynamics. And I think there are things around, you know, a situation where flatness is obsessed over means there's actually not a lot of space for single leaders to come forward to say there is a problem, or we need to make a short-term sacrifice for a long-term gain.
I think it was Orwell who said everyone's equal except some are more equal than others. And then that's not even acknowledged.
Yeah.
That's a fascinating point. I want to ask you about this question about whether Facebook...
Actually, can I give you one more little
detail?
Sure,
please.
This one,
yeah.
To give you a sense of how absurd this space is. So Facebook is obsessed with 15 and 30-minute meetings. So like they're very efficient. They're obsessed with the word crisp. Like, are your documents crisp? Is your explanation crisp? The space is so large that I would regularly walk 15 minutes, 10, 15 minutes to go to a 30-minute meeting. And so even that level of absurdity, that is more important for the building to be flat than to be functional for us to go to our meetings, it just kind of shows you the blindness of that religion.
And you've worked at other big tech companies. You've mentioned Google, for instance. How is Facebook different from these other companies, and is it better or worse?
Yeah. So I feel like there was more of an acknowledgement of users as equal stakeholders at other companies I worked at. So like Google, I don't know if people are aware of this, but Google is able to support, you know, thousands of languages, partially because they built tools that allowed individual communities to move Google into their language. They said linguistic diversity matters at that level. And, you know, even back in the mid-2000s, like I worked on internationalization on Google Books, and like there was a real authentic commitment to how do we get into the most languages and adequately support them. You know, imagine if Facebook took the same attitude on safety, right? If they came in and said, we live in a linguistically diverse world, let's make sure all of the dialects in Ethiopia are covered. You know, there's 100 million people in Ethiopia. They're having a civil war right now that is being amplified by Facebook. They have 100 dialects, 6 major language families. Imagine if Facebook, instead of being so closed, right? So Facebook has full control of their platform. They're the only ones that can see inside. It's full closed. Imagine if they said, we're going to take a page from the Google playbook and make tools that allow Ethiopians to actually make sure that all the safety systems work in all their languages. It'd be a very different world. And so there's little details like that where I think there's an opportunity to open up Facebook and say, you are the internet in most countries. You know, 80 or 90% of the content in most languages in the world is on Facebook. Imagine if they came in and said, we actually acknowledge that power that we have, and we invite you to collaborate with us. We'd have a very different conversation right now.
You mentioned a remedy for Facebook, the problems that you perceive at Facebook being labeling. Alexandria Ocasio-Cortez recently told Yahoo Finance she thinks Facebook should be broken up, and she gave a few reasons why.
Okay.
I'm wondering if you agree with that assessment of a solution for the problem.
So I think there's definitely an opportunity in that it gives, say, Instagram the ability to have different choices than Facebook. I think there's a big opportunity there. At the same time, some of the core problems that I've flagged, which are around something called engagement-based ranking. So engagement-based ranking is where Facebook has to decide every day what to show you. There's tens of thousands of options, or Instagram does, same thing. And they have to pick 10, 100 objects to show you first. Right now, they prioritize those pieces of content by what can elicit a reaction from you. And unfortunately, even Mark Zuckerberg identified as early as 2018, he did a public white paper, and he said, engagement-based ranking is dangerous because people are drawn to extreme content. Even though when we ask them afterwards, they say they don't like it. Breaking up, it's very sad. It seems so clean and simple. Just let's break up Facebook, that'll solve the problem. Those problems with engagement-based ranking, like the idea that we give the most reach to the most extreme content, it will just get repeated instead of Instagram and Facebook.
But potentially, couldn't you have other executives like Kevin Systrom, for instance, I think suggested that he wouldn't have followed the same path necessarily that Mark would have. Right?
I totally believe that. But I think it's one of these things where if we think there's a magic bullet there, unless we have mandated transparency, like unless we find that way to change the incentives, to pull them away from just profit and loss and expenses towards, no, you have to be transparent about all these other things, you're just going to see the problems repeated again.
Right, so mandated transparency to your mind is more important than breaking up the structure.
Unless we have mandated transparency, the incentives will stay the same.
Welcome back. Well, oil prices dipping today despite the heightened rhetoric between Russia, Ukraine, NATO, and the U.S. President Biden saying the probability of invasion is very high. Some of the dip tied to progress on Iran nuclear talks. With more on all of that and the energy sector and how crude settled, let's bring in our Yahoo Finance's Jared Blickery. Jared.
Hi there. Mixed board for our commodities heat map today. At the bottom row, we got Brent and crude oil, WTI crude oil settling lower by about 2%. $91.76 is the official price for March delivery here. Now let's take a look at the last 10 days of price action. Pretty choppy in here. Really haven't covered much ground, even despite this loss that we suffered yesterday and in some of the prior periods. If you take a look at a 2-month chart, you can see really haven't come down much at all. And of course, front and center among the oil talks or the oil discussion here is what's going on with Ukraine as well as Iran. Those talks have, it looks like, picked up a little bit of steam, and there's some anticipation that we could have Iranian oil supply back in the market. Of course, that would take some time. So nevertheless, we are seeing energy in the forefront today. You take a look at our sector leadership, and you can see energy, well, it was in the green, it's sunk into the red right now. We're going to check our energy heat map before we go here, and there we go. We can see Exxon just down slightly, Chevron down about 0.9%. But over here, some of the smaller players getting some love. We got Pioneer, that's up 3%. Devon Energy, that's up 2%. But overall, kind of a mixed day for energy. Curious not to see it leading or lagging today.
All right, Jared Blickery, thanks for that roundup. We're going to turn our attention now to the lumber market and its impact on sky-high housing costs as housing starts slipped by more than 4% in January. For more, let's bring in our next guest, John Duncanson, timber analyst at Corden Capital. John, thanks so much for being here. So the housing market's being pulled in all kinds of directions, right? Housing starts are down. Mortgage rates are up, mortgage applications are lower, all because demand is so tight, there is so little supply, and prices are sky high. And now lumber prices are exacerbating the situation because they've been on a roller coaster all pandemic long. They were super high, they did dip, now they're sort of creeping higher again, although slightly off some of those highs today.
Yep, it's been very interesting. We've had some good new positive news, actually. If you just getting back to your housing start figures, yes, they were down in January, but I think that's largely probably supply chain and also weather. I can't think of any part in North America, or particularly in the States, where they didn't have some pretty severe winter weather. Nobody's looking at the building permits, so you didn't mention it either, but they hit a 17-year high in January. And so that's the precursor of future. So we're still in a red hot housing market. Freddie Mac came out about a couple of weeks ago saying that the shortage of houses in the United States is 3.8 million. So we're well behind where we should be. So on the demand side for lumber, I don't see any real slowing up. If we do get interest rates picking up a bit, which I think everybody thinks, all that's going to do is probably squeeze more people that are on the fence into buying houses. So it's an interesting point. The other thing you mentioned, we talked about earlier, was just and you mentioned it, the record high lumber price, or the record high housing costs. And, the National Association of Home Builders published just Tuesday that just the jump we've seen in lumber prices since they bottomed out last fall has added about $19,000 to the cost of a new home. One thing I always like to point out is that the Canadian lumber is a major supply for U.S. housing, and the duties, the ongoing trade war between Canada and the U.S. on lumber imports, 30% of that $19,000 additional cost of house, 30% of that I calculate to be just the Canadian lumber duties, or the duties on Canadian lumber going into the States. It's close to $200 to $300 a 1,000 board feet. So it's significant. And those the duty rates went up actually in November, first week in December. They went up to 18%. So one big solution, if they want to drop the cost of a new house in the United States, is negotiate with the Canadians and get rid of this tax, because it's just a tax on the U.S. consumer.
Yeah, and I was going to talk to you about some of those regulatory issues and wondering, what is the U.S. doing to alleviate some of them? Because I understand from what you're saying that, the Canadian tariffs have been exorbitant and really sort of pressured the lumber market. So what's being done?
Well, nothing right now, because the Canadian producers are making so much money. I don't know if you saw the earnings. They're off the peaks, of course, from last spring, but they're still very, very, very much up there, the earnings wise. The other thing you got to remember too is that the duties aren't going into the U.S. Treasury; they're being held in trust. So if there is a settlement, the money will come back to the Canadian companies. And the other thing, with all the very positive cash flows that they've generated over the past 2 years, despite the pandemic. A lot of the companies have absolutely no debt, so they don't have. There's not a lot of pressure on them to reach a negotiated settlement like they did back in 2006. They're just going to wait it out. And the other thing too is that the formula for lumber duties, which is calculated by the U.S. Commerce Department every year, is one of the key inputs is the price of lumber. And as the price of lumber goes up, the duties actually come down. There's about a 2-year lag. So the 18% they're paying right now will come down to about 11% come this summer. So there'll be some relief there. But and this is the other macro that there was news on yesterday, and I've been following this for quite a while. And I think when I was on your show last July, I mentioned it. There's a real squeeze on lumber capacity happening in Canada, particularly in British Columbia and the West Coast, because you got some. We've had the beetle-killed timber, and now we're getting regulatory reforms coming in that are actually going to reduce the annual allowable cut. So. And we saw the first real indication of that yesterday when Canfor, the second largest lumber producer in North America, they've announced that they're shutting down one of their sawmills in the BC interior. Not completely, but they're going to remove one of 3 production lines. I estimate there's probably, because of the regulatory changes and the tightness in timber supply in British Columbia, there'll probably be 10 or 12 more permanent closures. So just as people think that things might be getting back into supply demand balance, you're going to see the supply really start to come off, and that will hold prices up. We're at $1,300 right now. That's at the mill, and I see a bit of pullback as we get into the summer months, but we probably won't see the $1,600 level we saw last May, but we're at $1,300 right now. So
yeah,
I'm looking at some pullback, but nothing more than maybe 15%. And then these mill shutdowns in Canada are going to keep the market extremely tight well into 2023.
Yeah, it looks like it. And climate change and wildfires as well, exacerbating things there. Great discussion. Thank you so much for your time. We will have to leave it there. John Duncanson, timber analyst at Corden Capital. Thanks so much for your time today. Alexis, over to you.
Thanks, Karina. Coming up, an app that touts itself as the TurboTax for bankruptcy. We're going to talk to the founder and CEO on the other side of the break. Welcome back. Looks like the stock market has now hit fresh lows for the day. The Dow off more than 1.5% right now. The NASDAQ composite tumbling more than 2%. Just a short time ago, Secretary of State Anthony Blinken warning members of the UN Security Council that the early stages of a Russian invasion of Ukraine were, quote, unfolding after Moscow bolstered its forces along the border between the two nations in recent days. So it's definitely a fluid situation, and investors seem to be reacting to every headline we're getting out of Washington. All right, switching gears now and going into debt to get out of debt. It's a problem millions of Americans face when navigating bankruptcy, but one company, Upsolve, found a way to work around that. Here to talk about it is Yahoo Finance Senior Editor Adriana Belmonte and Upsolve CEO Rohan Pavuluri. Over to you, Adriana.
Thanks, Alexis. Rohan, thank you so much for joining us today. I guess to start off, why don't you tell us a little bit about how this app works and how it came about?
Of course. So I started Upsolve when I was an undergrad in college. I was helping people who couldn't afford lawyers access their rights. There's this huge problem in America, which is if you fall into a lot of debt, you have this tool that's available to you in bankruptcy, but it actually costs a lot of money, an average of $1,500 to hire a lawyer in order to file for Chapter 7 bankruptcy so that you can relieve your debt and re-enter the economy. And a lot of people are just too broke to file for bankruptcy. It's this cruel irony that we make you pay so much. So I learned about that problem and set out to help low-income families who couldn't afford lawyers access the bankruptcy system so they could get back on their feet, start working again, build their credit. And that was the genesis of Upsolve.
So I know that you guys aren't limited to just one specific type of debt. It varies credit card debt, student loans, but what are the most common types that you see among your users?
So most people in America need to file for bankruptcy after facing a financial shock, like losing their job, medical emergency, or a family breakup. Those account for over 90% of bankruptcies. So most people who come to Upsolve come to us because they face one of these financial shocks. And the most common type of debt that people relieve using Upsolve is medical debt and credit card debt.
Yeah, medical debt we've been seeing is becoming more and more common among Americans. What is your success rate? Or I guess, how successful have you been at getting these people to file for bankruptcy without having to, go through these shocks like you've mentioned?
Yeah, so the people who come to Upsolve, they're already in 40, 50K in debt, and they're looking for a way to relieve their debt so they can re-enter the economy. And that's why they've come to Upsolve, because they can't afford a lawyer in order to access bankruptcy. So for people who use Upsolve, over 98% of people who have used Upsolve to file their forms have been able to get a discharge and relieve their debt. And we're now within about 3 years of launching nationally, we've relieved nearly $500 million in debt for low-income families across America. And over 2 million people per year visit Upsolve to consume a free education.
Now, I was looking into your organization a bit, and I saw that you guys are a nonprofit. So can you explain a little bit about how the funding works here, where you guys get the money to help all these people?
Yeah, so the vast majority of our money comes from philanthropic funding. We've raised about $10 million from some really amazing people, folks like Eric Schmidt, the CEO of Google, Jack Dorsey, the CEO of Twitter, Eric Schmidt, the former CEO of Google, Chris Sacca, Jim Breyer, the Hewlett Foundation, the Robin Hood Foundation, the Legal Services Corporation, which is the largest funder of civil legal aid in America and gets its money from Congress. So we've been really lucky to have some really great people across foundations, individuals, and the government help fund our work.
And my last question for you, where can people find this app? Where can they access it if they are in need?
Yeah, you can go to upsolve.org and consume the free education we have, see if we might be a good fit. And if you are, you can use the app to generate your form so that you can file for bankruptcy.
Well, thank you so much for taking the time to speak with us today, Rohan. I'm going to toss it back to Alexis.
All right, some great information there, guys. Thanks so much, Adriana Belmonte. We appreciate it. Karina?
Okay, and we are going to switch gears after a quick break. Picking up a gold medal at the Olympics is no small feat. Ahead, we look at how athletes are putting those medals to work for them financially. Stick around. Okay, welcome back to Yahoo Finance. We want to get you a quick check of the markets at the moment. The three major benchmarks at or near session lows. You can see the Dow is at a session low at the moment, down 544 points. The S&P down by 80 and the NASDAQ lower by 339 points. Some of the reason for that, we are getting reports from The Guardian that Russian forces are moving closer to Ukraine's border. And also earlier today, the U.S. ambassador to the UN saying the conflict has reached a crucial moment. So the situation certainly very fluid there, and we will keep you updated on that. But we're going to switch gears now and change to a different topic, something more fun. To end the show, the Winter Olympics are close to an end, and Americans have earned 21 medals so far, but the money behind that ultimate achievement isn't equal to what many other professional athletes earn. For more, let's bring in Yahoo Finance's Josh Schaefer. And Josh, how much do these athletes make per medal, and how different is that compared to people in other sports?
Yeah, Karina, it's vastly different compared to athletes in other sports and even other Olympians. So each country determines how payments work for their given team. And the U.S. Olympic Committee just doesn't spend that much money on these Olympians when they get a medal. So U.S. Olympians make $37,500 for a gold medal, $22,500 for a silver, and $15,000 for a bronze. Obviously, that's no small amount of money, but for these athletes, it's considered pro sports, and the Olympics are only come around every 4 years. These athletes are trying to fund a living, so it's not a significant portion of money. And so we have a list of several different countries and what they pay out for gold medals. And you'll see that the U.S. is kind of at the bottom of that list, trailing the likes of France and Russia that are slightly above them. And then Singapore leads all nations with a payout of $744,000 for a gold medal. I'd like to be from Singapore and win a gold medal, I'll say that. But if we compare it to bonuses that other athletes win for winning major sporting events, if you look at last weekend, we had the Super Bowl, obviously. Los Angeles Rams receiver Odell Beckham earned $1 million for being a part of that Super Bowl victory. That was in his contract bonus. So a big difference there between what we see for the Olympics. So I reached out to Octagon, which is an agency that represents athletes, and helps connect them to brands. And their managing director of Olympic sports, Peter Carlisle, said nearly all Olympic athletes' money comes from marketing deals. So after they win these gold medals is really where their earning potential starts. They then have to come back to the States. They have to pitch themselves to different media companies, get their story out there, and hopefully that story sells to brands. And so we see that kind of gamut happens within 24 to 48 hours after them winning. And then hopefully, basically, they want to build that story up in those 24 to 48 hours, make America fall in love with that character. And then maybe they can get sponsorships. The athletes that are lucky enough to get sponsorships that span the next couple years can fund their own training. Some of the other athletes end up working 2 jobs and have to train while balancing another job to kind of get that income. A little bit different than what we see in other sports, when athletes usually just take their salary from their big paying sport and they just go home and train and they don't have to worry about a second job.
Yeah, Josh, I don't think a lot of people realize that, right? You see all the glory and them up on the podium and you think, are these people really holding down 2 jobs, to make ends meet? But back to that point of marketing, I mean, given the lack of in-person media, you've got COVID concerns in Beijing right now. How has this year been different for athletes, I guess, from that marketing perspective?
Yeah, Alexis, it's really a lot different because in order to be marketable, you kind of have to build your brand first. And that's been a challenge for athletes this year because there's less people in person, less media in person. Back in 2008, Carlisle told me that the athletes would stay on site. That Olympics was in Beijing as well, the Summer Olympics. They'd stay on site for about 5 days because there were so many different media companies there. You could do appearances. You could pop on this TV show and then go to another TV show in 15 minutes. That doesn't exist this year. So athletes pretty much have to come back to the States or do video calls to get exposure. And then they're going to have to see how it builds. One added thing that has been fun with it being so remote and kind of different this year has been a little bit more social media involvement. We've seen that over the past few Olympics, of course, but one that stuck out to me this year was Shaun White had been kind of chronicling his year in the Olympics and what it's like day to day. And he had a hashtag of TikTok partnership. So I think he probably was getting some money from TikTok for that. And it seemed to work out pretty well for him.
All right, Josh Schaefer, thank you so much. It'll be interesting to see in the future how college athletes now getting endorsements shakes things up as well. We'll leave it there again. Josh Schaefer, thank you so much. Alexis?
All right, that's going to do it for Karina Mitchell and myself, Alexis Christoforous. But stay tuned, more Yahoo Finance Live to come after this.
Major averages declining, and that is accelerating as the White House believes that the possibility Russia invades Ukraine is now very high as U.S. intelligence reveals Russia has not pulled troops from the Ukraine border, but has actually added 7,000 to the existing presence. The Guardian reporting its UK sources have indicated that Russian forces are moving closer to Ukraine's border, and major averages down across the board as we've been tracking here today. As international conflict stokes today's volatility, the VIX also up by more than 7% at certain points today. Oil markets, they're continuing to react reflexively as well to defensive diplomatic developments. We're going to have the latest prices by the barrel for you coming up. And earnings season, it rolls on. Walmart reported its quarterly results this morning and topped expectations on both the top and bottom line. We're going to break down more of the results during the hour. Plus, we've got Roku, Shake Shack, and DropBox all set to report quarterly results after the close. Live analysis of the report cards from those companies following the closing bell. And Nissan's 2030 targets call for 23 electric vehicle models. But to make that happen, assembly plants, they need to be activated. The company aims to build 2 new facilities dedicated to electric vehicle production via a $500 million investment on top of what's already been earmarked. The chief operating officer of Nissan joins us with the details. You're watching Yahoo Finance Live. Today is February 17th, 2022. We've got 59 minutes left until the closing bell. I'm Brad Smith here with Rochelle Akufo and Emily McCormick. And Emily, another volatile session on our hands, winding down here.
Absolutely, Brad. Great to be with you both, Brad and Rochelle. Let's take a look at where markets are trading this afternoon as stocks get battered yet again by concerns over tensions in Russia and Ukraine. Now, taking a look at the 3 major stock indexes, the Dow Jones Industrial Average down by more than 540 points, or about 1.6%. The S&P 500 down about 1.8%, and the Nasdaq Composite down 2.4%. Those growth and technology names coming under renewed pressure this afternoon. Now, taking a look at the sector action in the S&P 500, information technology, communication services, and financials are the laggards. Finance's Jared Blickery on The Interactive. Jared?
That's right, Emily. And just looking at the board here, not a pretty picture. Let's pull up a chart of the NASDAQ. It's down almost 2.5%. And you can see it's been a slow, steady bleed down since about 11:30 a.m. And we just got those Guardian headlines about Ukraine and Russian forces edging up to the border. Didn't really see a heavy bout of selling, but nevertheless, we have lower prices. Let's keep in mind, too, that this is really about the Fed and interest rates as well. These geopolitical concerns, they tend to get resolved quickly in the markets, not necessarily in real life. But we had James Bullard doubling down on his call for 100 basis points increase in the Fed funds rate by July 1st. So looking at this board, it's getting a little bit uglier. Tesla down 5%, Facebook off 3%, Nvidia off 7%. That's an earnings story. We've been talking about that all day, but you can see Microsoft and Alphabet each down more than 2%. Looking at the sector leadership here, we do have staples and utilities. They are in the green, but that's not really what you want to see here. That's a defensive setup. Tech, consumer discretionary, financials, communication services, all of those sectors off by more than 2%. I mentioned Nvidia, nasty day for the semiconductors, great numbers out of them, but maybe just priced a little bit too priced too much to perfection here. That's what I was trying to say. And also taking a look at the software space, we got Cisco, that's up 3%, but that's really an earnings story. And kind of bucking the trend here. We got Twilio, Okta down 8%. Some of these names down even more. Shopify, there's another earnings name, another earnings story down about 11%. Also want to check out the ARK components because ARK has been having a nasty time here. Cathie Wood defending her investment strategy over an interview over at CNBC a few hours ago. Some interesting comments out of there. I'm not going to get into it, but nevertheless, we have these components suffering as well. Also taking a look at Chinese stocks. Now, Alibaba had been in the green earlier. This had been a bastion of some green, but you can see just really selling off right now. DD off 5% and some of these names off just a bit more, guys.
All right, thank you, Jared, there. Now, as Russia-Ukraine tensions continue to swing the markets with each new development, President Biden weighed in as he spoke to reporters today about the very high probability of a Russian invasion. Take a listen.
Mr. President, what
How high is the threat of a Russian invasion right now?
It's very high.
Why?
It's very high because they have not moved any of their troops out. They've moved more troops in.
Is your sense that this is going to happen now?
Yes. My sense this will happen within the next several days.
Well, with that warning and other data-moving markets today, let's bring in Art Hogan, National Chief Market Strategist. Thank you so much for joining us. Now, hearing President Biden talk about this very high probability of a Russian attack after a week of mixed messages on Russia, how much of this is already priced into the market versus other things weighing on it, like inflation?
Yeah, such a great question. It's really hard to separate those two things because clearly the two things we're most concerned about right now in terms of headwinds for the market and causes of volatility are clearly tensions in the Russia-Ukraine. And that, as you said, we've seen headlines go in both directions that, perhaps things are getting better, perhaps Russia will move some troops back. And now it feels like that narrative has slipped into they're not, and it's getting worse, not better. And then clearly our concern over not just inflation, but what the monetary policy response to that inflation will be. And those headlines have changed quite a bit too. We've gone from thinking the Fed would be very, very deliberate in their actions starting in March and telegraph everything well for us to having some outliers on the committee just talking about being very aggressive, a lot more aggressive than what's priced into the market. So we have a couple of headwinds that we're really facing right now, and every day the story changes a bit.
So then in terms of strategy, some of the analysts that we've spoken to are taking this barbell approach to volatility, balancing some of these high risk and no risk assets. But for bonds, which are highly dependent on interest rates, what's the strategy there as the Fed does prepare to hike rates?
Yeah, so if we have a pretty clear notion that interest rates are going higher, you want to keep your duration short. You certainly want to adjust your 60-40 portfolios and have less of an allocation in fixed income, and certainly find alternatives in fixed income that likely will ride out the rising interest rate environment a little bit better. Things like BDCs and baby bonds and REITs as a substitute for some of that bond exposure you have in the classic example. But in terms of the barbell, we'd certainly agree with that. You want to have access to growth, but that growth access needs to be manifested in expressions of companies that are actually measured by PEs and not price to sales or price to revenues. We've already seen degradation of multiples in the price to sales component, and we think that likely continues as interest rates go higher. On the other side, you really want to have exposure to things that do well in a rising interest rate environment, and that likely is the financials, energies, and industrials.
Art, when we think about the Fed, and of course they want to get their hands around inflation, but how does international conflict change the Fed's calculus, especially for what they've signaled thus far?
Yeah, it's interesting, Brad, and that's a great question. So we oftentimes talk about the things that the Fed will likely bring up at their FOMC meetings and what's talked about around the table. And clearly, what's difficult to draw a direct line to would be, a conflict with Russia and the Ukraine, directly back to the profitability of the S&P 500. But that second order effect, what's bad for the Eurozone, clearly higher energy prices and clearly economic slowdown in the Eurozone is going to have a direct impact on the U.S. economy. So that certainly plays into how they think about what they need to do for monetary policy. On one side, it cuts both ways, right? Higher energy prices are one of the problems in the inflation picture, but clearly a slowdown in Europe that we're very closely tied to is not going to help motivate them to be even more aggressive. So it's certainly part of the conversation, and we'll know more about that after they have their meeting in March.
Some investors would look at prices and equities right now where they can kind of pick their basket or their shopping list, if you will. Do you look at it as there's still room to the downside at this point in time with some of the volatility that we've seen play out over the course of this week? Or is this the time where you would expect investors, if there were those that were going to set their entry points, to do so now?
Yeah, I think that's a great way to think about this. You want to sharpen your pencil. You want to look at what's moved the most and yet has probably the least impact on both rising interest rates and or a conflict with Russia and Ukraine. And I think thinking about it that way sets you up to say, okay, look how much damage we've done to traditional technology companies that are trading at incredibly low multiples right now, multiples of PE. The other side of that equation is how much of energy companies run up in the defensives, like the staples, clearly gold, and make sure you don't get caught up in that swing higher right when that tends to crest and roll over. We tend to see much larger movement in the anticipation of events, whether it's the start of a rate hiking cycle or the beginning of a military conflict. And once they begin, and once we have the actual event, they tend to roll over. So I'd be careful on some of the defensives, and certainly be careful on some of the safety trades and the havens, because they can roll over just as quickly as they've risen.
Art, what's your expectation right now for what move, whether it's 25 basis points or 50 basis points, that we'll see from the Fed in March? And between now and then, what on the margin do you think could change this outlook, since we will be getting another jobs report and more inflation data between now and then?
Yeah, such a great point. There's a lot of information we get in between the now and the then, and clearly another CPI, another PPI, another jobs report. Clearly, all the regional Fed banks that have prices paid components baked into their reports. Certainly the industrial production capacity utilization, which has a pricing component baked into it. So all the things related to inflation. Clearly, if we see a peaking and a rolling over, that likely moderates the first move that they make. I would also argue that if the Fed were ready at this juncture to go ahead and front load this 50 basis points, we'd be hearing about that from a whole parade of Fed speakers, and not just one from St. Louis. So I think that the Fed hasn't gotten to the point where they really want to message to the street, get ready for 50 basis points.
And zeroing in on one company specifically, Walmart reported better than expected quarterly results.
Yeah, Walmart was certainly doing a good job of managing.
Yeah, Art, I'm just going to jump in here just very quickly, but I think the question that Emily was about to ask or get at was regarding Walmart. We saw some of those earnings. We've got a ton of retail data that came out over the course of this week as well. When you pair what you saw with Walmart, and essentially, of course, the largest brick and mortar retailer in the US, and extrapolate what we may about the state of the consumer right now, is there anything that investors should be hanging their hat on from that report that helps give a little bit more insight into what types of products have still staying power, even in light of some of the inflation that they are weathering right now?
Yeah, certainly. Great question. I think when we think about the consumer, we oftentimes wrap up our impression of how the consumer is doing around the last month that we've heard about. And the December retail sales were a bit of a disappointment. But if you look at the entire fourth quarter, it was much better. And I think we front end loaded Christmas shopping season because people were afraid of inventory shortages and not being able to get the products that they wanted. So I think the Christmas shopping season started very early. And then Omicron certainly hit at some of the most important times of December when the consumer would be out there. I think what's really important to take away from Walmart and the retail sales number that we got for January is the consumer is alive and well, has very rock solid balance sheets. The personal savings rate is about 2 times the historic rate that we've seen over the last 50 years. So I think you've got a well-employed, strong balance sheet in the consumer, and they continue to be strong here. So when we think about that, what we'd really like to see as we work our way into the springtime is that mix shift of consumers looking to buy more services than they are goods. And I think that naturally will happen. We'll see a flip-flop of that equation where demand for services picks up and demand for goods normalizes. I think that helps the inflationary pressure we're seeing for a lot of goods right now.
Certainly seeing that inflation continuing to persist. Thank you so much for your insights. Art Hogan there, National Chief Market Strategist. Thank you again. All right, coming up on Yahoo Finance, a look at what's sparking in the electric vehicle industry. Stay with us.
Welcome back to Yahoo Finance Live, everyone. We've got just inside of 45 minutes left in today's trading activity, and we're keeping a close eye on the major averages. The Dow Jones Industrial Average, right now, you're seeing that lower by more than 600 points, 1.9% in the red, and that represents a move lower on the day of about 653 points. You're also seeing in that bottom corner of your screen the NASDAQ and the S&P 500, both of those deeply in decline as well here on the day. There's a closer look at the S&P 500's losses. As of right now, down by about 2.1%, 94 points in the red there. The NASDAQ composite, tech-heavy average, you're seeing that down by about 386 points. The Dow only has 4 components in positive territory, as we're seeing a little bit of a flood towards consumer staples right now. That is the only major sector of the S&P 500 11 sectors that is in positive territory right now. We'll keep a close eye on this going into the closing bell. Still got some time left on the clock, but it's not looking good right now. For our next guest, I'll toss things on over to Rochelle.
All right, thank you, Brad. Yes, a tough day across the markets. Well, an industry that is looking up, though, is electric vehicles. To talk more about electric vehicles and what's next for the auto industry, I'd like to welcome Ashwani Gupta, Nissan's Chief Operating Officer. Thank you for joining me today. Now, as we saw a major announcement from Nissan today with investing $500 million to transform your Canton, Mississippi assembly plant to build all new Nissan and Infiniti EV models starting 2025. Talk about this investment and how it fits in with Nissan's longer-term vision under Nissan Ambition 2030.
Thank you, Rochelle, for having me in this show. This is absolutely in line with our long-term vision when we said that by 2030, 50% of our lineup will be electrified. And we are going to spend $18 billion in next 5 years to prepare this electrification. So the investment of $500 million in Canton is one of the several investments we will do in the United States for having a natural shift towards the electrification.
So then between now and 2030, how will your vehicles build on the existing momentum we're already seeing in things like electrification and vehicle intelligence?
There are 3 technologies which are going to drive the natural shift. The first is, of course, electrification as cleaner vehicles. The second is autonomous driving for more safer vehicles. And third one is connectivity for more inclusive car and society. And this is where we believe that customer will have a natural shift.
So it's interesting. A lot of people might be wondering why Mississippi? Why that location for this plant? What was the thinking behind that?
That's a great question. Number 1, the quality competitiveness. Number 2, the cost competitiveness. Number 3, with Accelerate Mississippi program, we are going to upscale 2,000 workforce here to adapt to the advanced technology which will be in these 2 cars which will be launching in 2025.
So then as you continue this expansion, then what sorts of partnerships or investment is Nissan really exploring as part of its 2030 goal?
So for us, at first, battery technology is the main differentiator, and we would like to have a vertical integration. That's why we decided to invest in the research and development of all solid-state battery. And for sure, America, United States will be part of it. First, we want to have it in-house, and as we move forward, we will be looking for the partnership if it makes business sense.
Now, I want to take a look at some things that you said in your Q3 earnings call. You highlighted that Nissan outperformed the industry in key markets, the US, Japan, China, and Europe, and that was in the face of a lot of steep declines for car makers. But with new car sale information coming out of Europe today saying sales are down 6% in January for Europe, how concerned are you about how challenging this year might be for the industry?
I think we have to take it as opportunity and risk both. I think the opportunity lies between the business transformation which we are doing from volume to value, and there is a high demand from the customers for Nissan products all around the world. Not only the current customers, but also the new customers which are getting into the Nissan. On the other side, the efficiency and effectiveness of the business operations because of the supply constraint has improved significantly, whether we talk about inventories at dealers, whether we talk about flexible supply chain. Having said that, if we get better in the supply chain, I think we are going to progress further. And this supply chain is definitely going to improve, but will not be perfect in the near future.
And as you mentioned, supply chain issues, obviously a lot of pressure coming on things like raw prices for materials like steel, aluminium, rhodium. And then, of course, you have the supply chain shortages for semiconductor chips. We've seen some car companies saying, look, this is going to be affecting our production. What are you seeing in terms of how this might impact your production output as well as the rollout of some of your new vehicles?
I would say in 2021, we had roughly an impact of 15%, which is significant when we talk about customers who wanted to buy Nissan cars. It is improving, but I think still 2022, we will see a gap between supply and demand. So for us, it's very important to align our operations in line with this gap between the supply and demand coming from the supply chain.
Now, I want to talk about something that's it's one of those sort of unspoken things. Like, we're seeing a lot of progress in electric vehicles being made, but what about adoption? We're seeing that still relatively low in the US compared to other countries. Norway, in fact, having the highest share of new EV passenger car registrations. So even with petrol prices soaring, though, people don't seem willing to give up their gas guzzlers. So what do you think will be the turning point for mass adoption, and how soon do you think it might be?
That's a great question, Rochelle. I think the tipping point will be decided by the customer. And this tipping point is when the electric vehicles will have a parity with the ICE vehicles. What parity means for me is, number one, the driving performance of the electric vehicle at par or better than ICE vehicles, and the total cost of ownership of the electric cars to be better than ICE vehicles. If the tipping point is coming, definitely it will be. United States, we have already seen customers approaching towards the tipping point, and I think more and more we provide those technologies with cost competitiveness, customer will naturally go for it.
All right, well, it's been an absolute pleasure getting your insights today. Ashwani Gupta there, Nissan's Chief Operating Officer. Thank you so much.
Coming up, everyone, we're going to stick with the electric vehicle conversation as Elon Musk says the SEC is attempting to curb his free speech. The details in the latest court filing from Musk after the break.
Welcome back to Yahoo Finance. Let's start off with a check of how the markets are moving right now. All red across the board. We're seeing the Dow down more than roughly around 600 points. We're seeing the Nasdaq hit new session lows with tech and financials leading the downward trend. Bond yields also dropping. We're going to see what that says about the Fed, and also commodities also weak, but metals doing well. We're seeing that gold is up about 1.5%. So we'll have to see how it does at the close just over half an hour from now.
Am considering taking Tesla private at 420, funding secured. That was the tweet that initiated a legal battle between Elon Musk and the SEC. And in the latest court filing years later, Elon Musk says the SEC is attempting to curb his free speech. Yahoo Finance's Alexis Keenan is standing by with the details here. Alexis, take us into the argument from the Musk side.
Hi, Brad. Yeah, so Tesla's lawyers have just a slew of accusations against the SEC today. They filed a letter in federal district court in New York and Manhattan today saying that the agency is withholding $40 million from Tesla shareholders. They also say that the SEC is engaged in what is an unrelenting investigation into Musk and into Tesla, and also chilling Musk's First Amendment right to free speech. Now, the lawyers say that the SEC broke a promise to distribute this $40 million in penalties, and that was paid by Musk and in part by Tesla to settle the dispute that Musk had in 2018 over a tweet saying that he had secured funding to take the company private. Now, that's just one in a string of tweets over the years that have caused Musk to tussle with the SEC. Last week, we learned that the SEC also served Tesla in November, a subpoena on Tesla, asking it for information about its compliance with the order from that 2018 case. Also in 2019, the SEC asked a judge to hold Musk in contempt over a tweet that was talking about Tesla's production levels. So in this letter, lawyers say this. They write, the SEC has failed to comply with its promise to pay Tesla shareholders the $40 million it collected. Instead, it has been devoting its formidable resources, they say, to endless unfounded investigations into Musk and Tesla. The lawyers go on then to say that they'd like the court to hold a conference to discuss why the SEC has not yet distributed the funds, what they say is over more than 1,200 days. They also want to know why this SEC has been permitted to issue subpoenas to Musk and to Tesla without the court intervening and having some say over that. So I did reach out to the SEC, haven't heard anything back from the agency yet, but I also took a look at the agency's own records on distribution of these types of funds that are paid by alleged wrongdoers in these types of actions. So in the SEC's own 2020 annual report, they do boast that they are getting about 90% of these available fair funds, is what they're called, distributed within 2 years of the settlement. So it looks like, at least as far as Tesla and Musk are concerned, that these funds are being held up a little bit longer than that. Of course, that doesn't end the disputes for Tesla today. There's a lot more ongoing with some investigations by the NTSB.
Well, and to that point, Alexis, as you mentioned, this is not the only news impacting Tesla today. The National Highway Traffic Safety Administration opening a second investigation relating to Tesla's autopilot. What can you tell us about this probe?
Yes, and I do believe that this is the fourth investigation that the agency has undertaken. There's one is a new wrongful death lawsuit. It was filed in Florida against Tesla over a crash that killed a driver and a passenger. The family of Nicholas Garcia, they alleged that there is defective suspension in a Model 3 that was involved in the crash. They say that that defective suspension may have caused loss of control of the car, and that a Tesla service manager also negligently inspected the vehicle just 4 days prior to the crash. Now, Reuters reports that that car was speeding. They say, a police report say the car was speeding before the crash, but it did prompt that NTSB investigation. And in October, Tesla did recall 3,000 vehicles having to do with suspension. Also, NTSB is investigating a braking issue on Model 3s and Model Ys. It's been described as a phantom braking that engages as part of the autopilot when drivers are using the vehicle and not sure why that braking is engaging. There are over 300 reports of that type of occurrence. Emily?
All right, we'll leave it there for now. Yahoo Finance's own Alexis Keenan, thank you so much for that breakdown. As stocks continue to sell off this afternoon, we'll look more closely into today's market route on the other side of this break. Stick with us.
Losses have been accelerating during this last hour trade. Take a look at the Dow Jones Industrial Average right now, down by more than 600 points, 620-ish to be exact there, 1.75% in negative territory. And then additionally, the S&P 500, just seeing that down by more than 2%. 91 points in the red. The NASDAQ composite, that's lower by about 392 points, 2.8% in negative territory. As we are continuing to track all of the major averages, we're also keeping a close eye on sectors. 10 now, now back to 9. 9 out of 11 S&P 500 sectors are in negative territory, and technology communication services leading the decline, as you're seeing there on your screen. Technology down more than 2.8% right now. Financials down by about 2.5%, as well as communication services. We're going to go to a quick break here. We've got just inside of 25 minutes left in today's trading session. Stay tuned. Welcome back to Yahoo Finance Live, everyone. Continuing to track today's market sell-off as the White House believes that the possibility Russia invades Ukraine is now very high. That coming from the president earlier today. You're taking a look at the market's reaction on your screen right now. Major averages with just about 20 minutes left in trading here on the day. Lower across the board. The Dow is down 1.6%, 560 points in the red there. S&P 500, you're seeing that down 1.9%. We'll round that off to. And the NASDAQ Composite, that's lower by more than 2.5% right now. 363 points in negative territory. Just very briefly, want to toss the fear gauge index on your radar. The VIX is up on the day by 14%, not quite the high level of the year. However, take a look at what we've seen over this past year, this past 52-week scale at least. It's up by 29% as of right now. Year to date, it's up 66%. Keep a close eye on this as we've been tracking this with the volatility that has been in play over the course of these last 2 weeks. Emily is standing by with our next guest. I'll toss it on over to her.
Thanks, Brad. As we continue to track moves into the metaverse, Matterport, the company that makes digital twins of properties from homes to stores and other businesses, reported fourth quarter and full year results yesterday. Total subscribers crossed the 500,000 mark at the end of last year, and annualized recurring revenue grew to $66 million. For more on these results and the business outlook, we have Matterport CEO RJ Pittman here with us now. RJ, thanks for joining us again this afternoon. Given the stock move that we're seeing this afternoon for Matterport, what do you think investors are reacting to from these results?
Well, first of all, I think we've entered 2022 with a very turbulent stock market that all companies are enduring, as you guys were just discussing earlier. For Matterport, this was a record year for Matterport, record year for the company on revenue, subscribers, and some. And Q4 was very strong. And as you can see, we beat consensus on the top line. We met consensus on EPS. So we feel really great about the quarter, but I can't help but ignore some of these macro effects that are weighing down the entire tech sector. And I think we all want to see more growth out of growth tech stocks like Matterport, and it's definitely coming for us in 22. We're very early into the quarter here and into the start of the year, but we're feeling great about it.
And where are you between your
I'm sorry, could you repeat that? There's a little bit of breakup on the communication.
Hi, AJ.
Sure, absolutely.
This is Rochelle. I'm going to hop in here. I just wanted to sort of take a look at your venture into the metaverse. Where do you see your company positioning itself as you see an increasing number of companies also coming into this space, but a lot of people still wondering how much potential it actually holds?
Right. The way that we think about the digital universe is the same way we thought about it 10 years ago when Matterport was started. We turn physical spaces, buildings, cruise ships, commercial airlines, you name it. If it is a physical space or vessel, we have likely digitized it and created a dimensionally accurate digital twin, which has proven over the years to have durable commercial value for our customers now in 177 countries, right? And as the world starts to shift and as technology platform companies move towards a digital first world, whether that's for meetings or entertainment, productivity, even maybe manufacturing and manufacturing simulations in a digital 3D simulated environment, we might call it the metaverse. Matterport is in fantastic position because this is the business we've been about since the very beginning. And what it's perhaps doing is helping broader industries think about how to embrace the digital realm as a way to run their organizations and certainly run their facilities more efficiently. And we think, with that, we've got great examples. Amazon has come into the space and introduced a service in partnership with Matterport called their IoT Twin Maker. And it is Matterport's digital twins that are really unlocking the potential of AWS customers who are managing facilities at scale, do it in a 3D environment. Same thing with our partnership with Meta, where here we're trying to basically connect the dots and tap into our spatial data library. It's the largest library of buildings and spaces that is a dimensionally accurate digital twin in the world. And these have great implications for any of these new environments. Our engine and our pipeline for creating spatial data fits in perfectly.
And as you mentioned, your collaboration with Meta, their AI research last year to help train AI models, what is the monetization opportunity there?
I look at it this way, to build the next big platform in technology, which is certainly what Matterport is off and running to do, we have to look a little bit further into the future, right? And this collection of researchers and academics from literally the top universities in the world have taken hold of Matterport's unique 3D spatial data. We have over 450 applications to get access to our 1,000 buildings and spaces that we have opened up to this community. And there are already hundreds of universities at work. And what are they doing? They're building intelligent systems that can function. So think of robots and even personal digital assistants that can operate autonomously inside any kind of space, a building, a hotel, a home, a restaurant, leading to the future of technology and leading to the big changes in the way that we interact with the physical world and how we might even be using, robots and intelligent agents to help us along the way. And those research outputs will turn into applications that we can easily make available in the Matterport marketplace, which is our commercial ecosystem where you can customize your digital twin, your virtual tour, whatever your property might be, using some of the most advanced technology that's going to be coming out of this research effort in partnership with Meta and all of these universities around the world. It's really quite exciting.
Now, obviously, you have the collaborative aspect, but then you also have perhaps the potential for mergers and acquisitions. In terms of that strategy, then, Matterport closed its deal to acquire OnView in January. How do you see that progressing, and are there any other sort of M&A opportunities that you see out there?
Yes, OnView is a very strategic addition to Matterport's strategy, and this is what we call datafication. And that is, what do you do with all of this spatial data once you have it? Our customers, whether it is a large global retailer with thousands of locations, or it happens to be a commercial real estate customer that has thousands of office buildings, they want to understand what's going on inside those spaces, and they want to do it at scale, right? And so think of OnView's technology is able to go in and analyze 100, 1,000, even 1 million buildings in a matter of minutes, and basically do an automated AI-powered building inspection. And you can program it to look for very specific things, right down to determining if a sprinkler head in a construction project is out of place. And if it's out of place even by a few centimeters, right? And to be able to do that, in software is extraordinary. And to think about the job that you would have to do across, let's say, 1,000 locations for a large retailer, that's like finding a needle in a haystack. But with OnView and Matterport and what we call datafication, that becomes easy like a Google search. And this is really important to the future of how we manage our buildings and think about facilities in the next decade ahead. But it's also something that can unlock really creative ideas right in your own living room, like unlocking the ability to virtually redesign your living room, lay out new furniture, even change the color of the paint on the walls in a point-and-click fashion. And this is where we're going to extend the value proposition of Matterport once you capture that digital twin.
I mean, certainly endless possibilities there. Thank you for sharing your insights. RJ Pittman there, Matterport's CEO. Thank you for your time. All right, stay with us. On the other side of this break, a markets check as we're just about 13 minutes away from the close. Stay with us.
Welcome back to Yahoo Finance Live, everyone. Inside of 10 minutes left in today's trading activity. There you're taking a look at the major averages. Yahoo Finance's Jared Blickery is standing by and evaluating some of the key areas and levels that you need to keep on your radar going into the close. Jared, perhaps we start with the NASDAQ and tech.
Yeah, so let's start with the NASDAQ and tech. You can see the NASDAQ down almost 3% here. Let me put a 4-day view so we can see what's happened this week. We are now in the red for the week, sitting on some decent gains just a couple days ago. But I also want to check out the S&P 500, which is now down just over 2%. I'm going to put up a 2-month chart with candlesticks just to review one more time. This was the key resistance area that we failed at a couple weeks ago, and this is the key support level that failed, and then that the market could not break through to the upside over the last 2 days. So I think we're seeing a sell-off right now, and if you're paying attention, a series of lower highs and lower lows, well, that's the definition of a downtrend, and that's what we're seeing not only on a short-term basis, but an intermediate-term basis. So we'll have to see what comes of this. But looking inside the market, defensive setup as we see in the sectors, staples and utilities, those are the only two sectors in the green. Energy not far behind, but it's really tech, consumer discretionary, and also communication services that house all the mega caps that are really getting sold the most. And then here's the NASDAQ. You can see a lot more dark red on the screen has appeared over the last hour as the market's pushed to new lows. Facebook down 4%, Tesla down 5%, Alphabet down 3%, and NVIDIA, that earnings story, down over 7.5%. And just taking a look at those ARC innovation components, kind of as a leading indicator of the market, we see Palantir, that's another earnings story, but that's down 15%, Twilio down 9%, Roku down 11%, and the list goes on. And then finally, taking a look at some of our leaders and sentiment indicators, ARC is the worst faring, that's down 6%, followed by IPOs, cannabis, software, chip stocks, internet stocks, momentum stocks. All of those are dark red here, also biotech and gambling. So really seeing the risk being sucked out of the market right now.
And Jared, we're also seeing bond yields dropping. What does that say about the Fed and how much faith people have in what's going to happen next?
Well, I think that's an important thing to remember. The market may be reacting to the geopolitical headlines a bit, but it's really about the Fed and interest rates. We're seeing the 10-year T-note yield down quite a bit. 8 basis points is a big move. And let's take a look at a 2-month chart of the 10-year. You can see it's been consolidating after breaking to new highs, and this is something that often happens in markets, especially with the 10-year, as it's been doing lately. It breaks to new highs, it consolidates, and that's what it appears to be doing right now. But the calculus over at the Fed is, are we going to get that aggressive front-loaded rate hike, 50 basis points in March? The market is betting no now. The market is saying 60% chance of only 25 basis points. So it looks like the market has somewhat digested those very hawkish comments from James Bullard, the St. Louis Fed president. But I think the market was simply structurally weak to begin with. I'll go back to this S&P 500 chart, and it simply wants to go down, and it's using the headlines as an excuse.
Amid the international conflict, Jared, energy has also been in focus. What are you seeing there? And then also particularly just broad strokes commodities wise?
Yeah, you can see it's a bifurcated board here. These are all our commodities. To the downside, natural gas as an energy component, that's down 4%. Crude oil off 2%. Heating oil down there, as is lumber. We were talking about that in the last hour. That's down about 2.5%. But really the precious metals have been, and I guess they're also industrials, have been picking up some steam here. Here's palladium, that's up 4%, platinum up over 2.5%, and then gold up 1.5%. Not the biggest mover of the day, but I want to show you a 1-year chart because gold has broken to the upside after a long consolidation period. So if you're looking at this November high, it had stuttered there, faltered there a couple times, finally managed to break through, and now we're testing these levels right in here. That's up to about 2000, 2010, if memory serves. But the real number to beat here is about 2,100 or just shy of that. And with the momentum here, and given the long consolidation period, I would expect at least a test of that, but probably going to see some more upside for several months as the Fed continues to fight inflation, or at least tries.
Yahoo Finance's Jared Blickery. We appreciate the updates going into the close. Everyone, we're keeping a close eye on all of the levels right now that you're seeing there on the screen to see if we're able to make up any of this ground, but we are near some of the session lows with just minutes left in today's trading session. The closing bell coming up next.
right, welcome back. You're watching Yahoo Finance. We're just minutes away from the closing bell. We do have our guest coming up, Anu Gagar, Commonwealth Financial Network Global Investment Strategist. So as we head into the close, Anu, what are you keeping an eye on as you see this continued pressure from the Ukraine-Russia fallout and inflation continuing to weigh on markets today?
Yeah, thank you for having me today. So between the Fed trying to normalize monetary policy and the heightened tensions on Ukrainian borders, it feels like the market's caught between a rock and a hard place. But if you really zoom out a bit, things don't look quite as dire as it appears. So, on the monetary policy front, even if the Fed starts to raise rates, we have to remember that they're raising rates from almost zero. And even if they go through with 4 or maybe a couple more rate hikes in 2022, we would still be below the 2019 pre-COVID levels when the Fed started to drop rates. And this is in response to an economy that is doing well. It has recovered from COVID, and now it is dealing with higher inflation. And then on the geopolitical front, war is not our base case scenario, but even if some kind of a face-off does happen, the most near-term impact would be on Russian assets. And we've already seen that. Russian equities are, in fact, the worst performing equities in the emerging market space for the year-to-date period. In fact, they're down 16% for the last 3 months. But if history repeats or if it triumphs, then for most other stock and bond indexes, geopolitical risk doesn't have much of a major impact.
I know. I'm going to have you hold that thought, save all that good stuff for after the bell. We're just seconds away from the closing bell. Wanted to do a quick check of the markets before we head in. All 3 indices in the red. We're still seeing the Dow down. We're seeing the Dow down more than 600 points. We're also seeing the S&P also near session lows, losing 2%. Closing bell.
All right, everyone, markets officially closed here on this Thursday, and it couldn't come quick enough for the Dow, the NASDAQ, and the S&P 500 as we closed near session lows. We'll see exactly where everything settled in just a moment. There you're taking a live look at the New York Stock Exchange and the closing bell being rung there. Dow Jones Industrial Average closes down a little bit more than 600 points, 623 points to be exact there, 1.8% in negative territory. And we're also seeing where the S&P 500 closed. That closed down on the day more than 2%, 2.1% in negative territory, 94, 95-ish points to the downside there. And the NASDAQ composite, that closes down 407 points, and the largest decline on a percentage basis, that moved lower by 2.9% here in today's activity. Of course, these markets extremely volatile and reactive to international conflict as the U.S. and the White House, particularly President Biden, saying it is a very high possibility that Russia will invade Ukraine. And so we are keeping close tabs on that and anything that comes out of the region. The market's balancing quite a bit. We want to bring back in our panel and Anu Gagar, who has been standing by, Commonwealth Financial Network Global Investment Strategist. I want to give you a chance to finish your thought, but then also add on to what we've seen in the volatility. What is the outsized impact clearly at this point in time? Is it the Fed or is it the international conflict that we're seeing, and how investors are trying to price that in to the best of their ability?
Yeah, so markets have been more volatile in 2022 year to date. But if you look under the hood, there's more to the story. So what you're really seeing is sort of a rotation from sectors that have better inflation, that are not so great with inflation and higher rates versus sectors that have better inflation combating capabilities. So what you're seeing is energy and financials have outperformed, or they are in the green year to date, whereas you have sectors such as consumer discretionaries, technology, consumer communication services, real estate. Those are the sectors that are down by a much wider margin.
We want to bring in one more member of our market panel this afternoon. Scott Shalady is RFD TV market specialist. And Scott, I'm wondering, as you take a look at today's market action, of course, really seeing a risk-off tone across markets, seeing treasury yields coming down as investors pile into these safe havens as well as gold. Do you expect this to continue as long as we have these Russia-Ukraine tensions, or do you think this is just a momentary move on some headlines from today?
Well, I mean, I think the Russian headlines cause a problem for inflation. Because if it does happen, you're going to see oil rally. You'll see some other things, food rally. That's the problem. Inflation is going to be the issue, and how the Fed then ultimately tackles that issue, which could be exacerbated by a Russia-Ukraine problem. So this is the end of the story, is the market is telling you today, this is what it is. I think simply put, the market's telling you today that they don't believe that the Fed can thread that needle. They don't believe that the Fed can surgically remove the inflation issue without hurting the rest of the economy. And I think that the market's going to be worried about that until they see the reactions after we get these first rate hikes. Now, whether it's 50, whether it's 25, who knows? But you know what? The Fed never acts as quickly as they do. And you know what? We've also heard some pretty good intel about a big trade that's been going through over the last 3 or 4 months about getting short oil and getting long the yields, or getting short bonds, right? And are getting long oil and short bonds. That's now starting to unwind. So you're starting to see people like this squeeze in the oil price higher. It gets exacerbated, obviously, by the Ukraine, but there's some shorts that need to leave that market. And a lot of folks got short the 10-year thinking that yields are going to rally, and it just hasn't worked out. So they might have to go buy them back. So we're seeing that unwind as well. So we've got a trade that's going through that's kind of being unwound. At the same time, we've got Ukraine adding to that misery, and the voters, which are the investors and the speculators, are telling us that they don't think that the Fed can thread that needle.
I'm wondering, as we take a look at the companies who have reported earnings so far, as inflation remains a key concern for investors, is there a common theme that you've been seeing between which companies or which sectors specifically have been able to most effectively offset rising prices and navigate through the inflationary pressures we've been seeing?
Is that to me?
That was to Anu. Thank you.
Oh, I'm so sorry. I missed the first part. There was some problem with the audio. So yeah, there's a lot of companies have been mentioning higher inflation and higher input costs. And of course, companies more in the consumer discretionary sectors, they have been, and more in the goods overall, they have been the ones that have
It's Anu, it sounds like we're having some audio issues, so we'll try and get that squared away. We're taking a look at the sectors on the screen to see exactly where things had ended on today's activity. Scott, as we were continuing to parse through not just the sector activity, but more broadly these declines, it sounded like you might have had a response as well to that same question, if you can hear us.
Well, I mean, yeah, I mean, the things that are not doing poorly are the things that you have to do, right? The problem is you have to eat. There are some things you have to heat your home with. You have to somehow get to work. So, I mean, those sectors in the short term are going to be okay. But we have an issue here where right now the argument's not about inflation and what the Fed does. It's about inflation is about the barn, and can we reel it back in? That's the biggest issue. And so I'm in the camp, believe it or not. There's not a lot of people in this camp around my island with me, but I don't think the Fed can afford to do as many rate hikes as they think they can do for a number of reasons. Number one is we're going to get closer and closer to the midterms, and it will become politicized whether you want to believe it or not. It just does. And number two is the Fed will do something with rates and want to wait to see how that reacts, how everything relaxes. Does inflation actually come down? What does the market do? So this idea that we're going to raise 1% by July, or maybe 7 quarter-point basis hikes by the end of the year, I think we're going to really, really struggle with that, because I think the economy is not as good as everybody thinks it is. I think the Fed is going to, given the choice of destroying the economy and the housing market, or letting inflation run a little hotter, a little longer.
Yeah,
I think the Fed will work with inflation a little hotter, a little longer.
Scott, we got to leave things there. Right. We appreciate the time here this afternoon. Emily, I'll toss it on over to you.
All right. Thank you so much to our market panel, Scott Shalady, RFD TV market specialist, as well as Anu Gaigar, Commonwealth Financial Network Global Investment Strategist. Well, coming up next on Yahoo Finance Live, we'll have much more on today's market action. Stick with us.
Welcome back to Yahoo Finance. We're going to be taking a look at what's happening with DropBox's earnings. For that, let's turn it over to Yahoo Finance's Jared Blickery. Jared?
That's right. For the fourth quarter, and I should say that DropBox is up 7% in after-hours trading, but for the fourth quarter, adjusted EPS coming in at 41 cents. That beats the street estimate by 4 cents, and it's up from 28 cents a year ago. That's GAAP EPS coming in at 32 cents, and revenue, nice beat here, coming in at $565.5 million. That's up 12% year over year, and that beats the street estimate of $558.3 million. Also, net cash provided by operating activities was $162.7 million, and the free cash flow of $161.4 million for the fourth quarter. They said in their earnings announcement, we improved our non-GAAP operating margin by nearly 9 points, grew free cash flow by over 40% year over year, and delivered our first full year of GAAP profitability. Looking ahead to 2022, I'm excited about the opportunity we have had to help our customers organize their digital lives and deliver value to our shareholders, says the CEO. Also want to make one note here. Bloomberg data says that there are 5 buys by the street, 3 holds, and 1 sell. So again, nice beats on both the top and bottom lines for DropBox. And let's get a chart of their performance since the IPO. You can see a nice spike there close to its IPO, but for the most part, really just filling in a rounded bottom here. Maybe a cup and handle in the making on a very long-term basis? Possibly, guys.
All right, Jared Blickery standing by with those earnings for us. And as earnings season continues to roll on, Jared will be keeping a close eye on shares of DBX here in after hours trading. Appreciate it, Jared. And everyone, switching gears here. For the first time in its 95-year history, the American College of Financial Services launched a financial wellness consumer program. 19 HBCUs are historically Black colleges and universities. They are part of the program, and the initiative seeks to add up to 25 HBCUs. Joining us now with more is George Nichols, who is the president and CEO of the American College of Financial Services. Great to have you here with us today. First and foremost, let's talk about where this initiative is beginning and how it's getting involved within the HBCU programs, and particularly what drummed this up. Why is college the right time for this program and financial wellness consumer program to be inserted into that college experience?
Sure. First of all, thank you for having me. When we developed this program almost 1.5 years ago, we created a new Center for Economic Empowerment and Equality. And the focus was, how do we help underserved communities on their journey for upward mobility and narrowing the wealth gap? We wanted to start with Black America, given where the country was, and we created a program called 4 Steps Forward. And in that, it was, how do we provide culturally relevant educational content for them to help them? And one of the things that we found is in our research is most people start with the financial transactions. Well, how much money do you have? Our focus was, let's go to college students who now have relevant financial decisions. Can I pay for my books? How am I going to eat? Am I going to go out and party over the weekend? What am I going to do when I get out of college and I have to pay off my student loans? So now we have a point where people have relevance, but more importantly, we wanted to help them understand who they are, how they think and feel about money. Then we can actually help them with those major financial decisions as they go.
And so I ask, why college being the right time to add that program into either a curriculum or as an add-on offering or service for so many collegiate students? Because college itself is one of the largest investments that people are going to make into their education. And so where do you see this also having a role in the future, even at earlier points in education?
Yeah, Brett, one of the things that you will find in this country is there is so much financial education and literacy material out there. I think the country's done a great job. The unfortunate thing is most people are not paying attention to it. You really have to stop and think about, when is it most relevant? And we have found that when you're getting ready to go to college or when you're in college, you do have to think about it. Am I going to be able to afford this? And whether I'm working with my parents or taking out loans on my own, now you're having to think about those decisions. Well, also when you get in college, you have to make other decisions. You're going to be bombarded with credit card applications. You're going to be bombarded with things that you want to buy just to fit in on campus. Every one of those are really important touch points for you to make decisions. If you don't know who you are, if you don't know how you think and feel about money, then you may make bad decisions that are only going to make a challenging situation worse. I'll tell you, in my family, I remember when I was growing up, you weren't allowed to ask my parents how much money they made. That was none of your business. Well, it took me a long time to figure out, how do I feel about money? How do I think about it? What do I even know? And that was really the impetus about us creating this program.
If you'd seen what I was wearing in college, I was hardly concerned about fitting in. I think you would just deduce from that. When we think about the numbers and the projections themselves, 15,000 juniors and seniors you're expecting to give out certificates to, and then what? How do we continue to track the narrowing of the wealth gap and the disparity?
Well, this is a self-paced virtual program. So what we do is we go to college campuses, HBCUs, we find ambassadors, people that are respected and trusted by their classmates. We train them, and then they go out and they train their classmates, their family members when they go back home. And so the goal is that when the individuals they're training, they too are coming in virtually. So we're actually going to be able to have information about them, and then we can push information back out to them so that we become that lifelong learning partner for them when they've got to make financial decisions, even about whether or not I even want an advisor at some point in time. But it's really about getting them in the system. And I want to share with you, there's a couple of information that we've already been getting. We launched this about 2 weeks ago, and we've already had a young lady that says, you know what, I smoke cigarettes and I've stopped, and now I want to get a savings account. I had borrowed and bought a lot of stuff on Amazon. I'm sending it back, and I'm going to make sure I want to start an investment account. Well, as they make those decisions, the American College is there to be their partner with them, to continue to answer questions and help them have a better feeling and understanding about their financial decisions and their values.
George, while we have you, thinking about where there needs to be a better relationship, it's not just on the consumer side and who's the recipient of the services, it's the service that's being offered itself. Where have we seen improvements from some of the financial services players that have to have a closer relationship with multicultural consumers?
Yeah. Well, I think that, as all of us were dealing with the national unrest, I really do think the financial services industry has been very, very focused on how can it be more responsive and deliver the important things that the Black community needs. So one, the awareness is there. They're putting forth efforts to do a lot more. Many of them are partnering with the American College. I want to share with you just a little bit about a study we did on 3,500 Black middle-class females across America. And what we learned is Black women play such a large role in financial decisions in the Black community. So we wanted to focus our research on that. And I want to share just a couple of points that I think are relevant to the question you just asked. One is Black females said, I want to trust the organization that I'm dealing with. Trust became a big issue, not whether you're financially stable or how many ads you run, but trust. The second component, though, was I want to see you in my community. I want to see you in my community advertising, partnering with Black-owned businesses and doing business with Black individuals. That is important. I want them to understand the linkage that in the Black community, it's important that not only I'm successful, my family has to be successful. I want my community to be a part of that. And we believe that now companies are listening. And they're trying to think about how do we recruit more? How do we retain more? How do we partner with Black-owned banks? That is now coming out in play.
Absolutely. We're going to continue to watch to see where the progress continues to move forward. Congratulations on this partnership with 19 HBCUs, getting up to 25. We'll check back in once you guys reach that figure as well. You guys, on the other side of this short break, we are going to continue to monitor the earnings coming out. On the other side, stay tuned. We've got Shake Shack and Roku coming in.
Welcome back to Yahoo Finance. We're going to now get another check on what's been happening with earnings after the bell with our own Jared Blickery. Jared?
Shake Shack down about 6% in after-hours trading, and that is because of a slightly disappointing forecast for the first quarter, the current quarter. They're seeing total revenue of $196 million to $201.4 million. The estimate was for higher, $211 million. And then also for the first quarter projection, same Shack sales, high single digits to low double digits versus 2021. The estimate was for about 15%. So those low double digits not cutting it for them. And then as far as the year forecast, they're seeing domestic co-operated Shacks increase by 45 to 50. Now here are the fourth quarter results. Comp sales beat the estimates of 20.8%. Excuse me, that was the number that came out, 20.8%. The estimate was for slightly lower, 20.4%. Revenue of $203.3 million. That's up 29% year over year. Estimate was for slightly lower, $202.6 million. And then Shack sales of $195.9 million, up 28% year over year. Estimate was for just slightly lower, 195.4. Average weekly sales, 74,000. The estimate was for 72,824. So besting that estimate. And then total location count, 369. The estimate was for 370, excuse me. And you can see the stock still down about 6.5% in after hours trading, based probably on that weaker than expected outlook, guys.
Yahoo Finance's Jared Blickery. Thank you so much for that breakdown on Shake Shack. Well, moments ago, Roku also reported quarterly earnings results, and they were weaker than expected across most major metrics, and that stock is falling in the after-hours session. Fourth quarter net revenue came in at about $865 million versus the $893 million expected, and Roku's outlook was also a miss. The company sees current quarter net revenue at $720 million. For a deeper dive into these numbers and the outlook for Roku, we have Tom Forte, D.A. Davidson Managing Director and Senior Research Analyst, with us now. Tom, taking a look at these results and guidance, is this another sign that expectations and valuations for the darlings of the stay-at-home trade may have gotten a little bit overstretched at this point?
Well, I think if you look at the pullback in shares, which even before today, shares have been cut in half, I think you could make that argument. But on first blush, when you look at the results for the fourth quarter and the outlook for the first quarter, it looks like two important problems have persisted for Roku. One, the negative impact on TV units being available from a supply chain standpoint. And number two, advertisers who have their own issues with supply chain scaling back their digital advertising spend. So yes, I think valuation is part of it, but it looks like two important challenges in the fourth quarter are going to persist in the first quarter.
And as you mentioned, there has been only a slight loosening in some of the bottlenecks in supply chains. Delays persist in delivering of smartphones to consumers. Also, the price, because of the shortage of semiconductor chips, now also making those larger TVs more expensive, up 30% compared to last summer. How do you see the ongoing delays, though, affecting Roku versus some of its streaming player competitors like Amazon, Apple, and Google?
Great question. So the challenge for Roku as the #1 operating system for smart TVs is how is this affecting its customer acquisition? And it does seem to be slowing growth in active accounts for Roku. By way of comparison, Amazon, Netflix, and others, they have multiple distribution points, not just Roku. So to the extent that consumers have smart televisions, they're less dependent on whether or not there's a Roku operating system. So I think this is less of a broader issue for others in the streaming space, such as Amazon.
So on the flip side of that, then, what is the bull case for Roku going forward? Because yes, the company is benefiting from this secular shift to streaming, but at the same time, as you mentioned, competition is rising in this space.
It's a great question. So the bull case for Roku remains, historically, their strategic partners are the biggest technology companies when you think about Google with YouTube or Apple or Amazon, et cetera, et cetera. Roku, though, is kind of the independent player in the space. And to the extent that a lot of these companies are looking for new subscribers, we still see that Roku has an amazing mousetrap for getting advertising revenue when these companies are looking to grow their subscription video on demand services. So certainly these supply chain issues are concerning on a near-term basis, but I think our long-term thesis holds that Roku is still well-positioned, also as more advertising dollars move to advertising video on demand services and away from linear television.
And Tom, as we look at two aspects of Roku's business, the commercialization of software products and monetization of user activity on the platform through things like advertising and subscriptions, where is it best positioned to see stronger growth, and what poses the biggest challenges to that growth?
I think it's amazingly well positioned on the advertising front. So if you think about Roku and you think about the changes Apple's made from a privacy standpoint, Roku has your credit card, therefore Roku knows who's watching what show. So Roku doesn't have the privacy issues Facebook/Meta has on the changes in Apple privacy. So I think Roku's amazingly well positioned for advertising. We just need to get through the short-term challenge from a supply chain standpoint as it pertains to smart televisions.
We do appreciate your insights. Thank you so much. Tom Forte there, D.A. Davidson, Managing Director and Senior Research Analyst. Thank you so much. Well, that's it from all of us here. I'm Rochelle Akufo, Brad Smith, and Emily McCormick. Also, thank you. Stay with us on Yahoo Finance.
In this episode of Influencers, data scientist and Facebook whistleblower Frances Haugen.
I think unless Facebook changes, a lot of people are going to die. And the reality is a lot of people do get wiped out by the stock slide. You know, Facebook has a series of whistleblowers. Like, I am not the only whistleblower. There's like a new one every 2 weeks. When Facebook misleads people about the value of the company, and when you lie about material issues, you are lying about the value of the company.
Hello everyone and welcome to Influencers. I'm Andy Serwer and welcome to our guest Frances Haugen, former product manager at Facebook Meta, who recently blew the whistle about the company's practices by leaking thousands of internal documents. Frances, great to see you.
Thank you for inviting me.
So first of all, why did you do it and what is your life like now?
I came forward because I saw that the information that Facebook was withholding from the public was critical to the public safety, that people needed to know in order to make responsible choices, and that Facebook was consistently resolving trade-offs in a way that was in their own interests and not in the interests of public safety. They were putting profits over people.
More so than, say, any other company, like an oil company or a retailer?
I think an oil company is a great company to contrast Facebook with, which is oil companies are radically more transparent because we can literally go and put sensors around an oil field. We can measure the pollution. They use satellites to see, are they capping the methane leaks? There are all these things where we can be accountable, or that company knows it is accountable in some way. Facebook knows that no matter what activists bring forward, they can just deny that it exists. And one of the things that happened over and over again after I came out was activists would reach out to me and say, I brought this up 5 years ago. You know, I've been giving them evidence of human trafficking on the platform for years, and they always tell me this is just anecdotal. It's not a real trend. It's not actually a big problem. But the documents showed they knew it was a big problem.
Was that what the difference was, because people have been complaining and pointing fingers at this company for a long time, but it was the actual physical proof of those documents, right?
Exactly. That's what changed. We now have evidence that these things that have been raised for years, like people have been laying the groundwork, activists have been doing tons of work, and now we have the proof that Facebook knew and didn't resolve these problems.
And what about this point of your life and how that's changed? I was in Portugal at the Web Summit, and there were thousands of people there hanging on your every word.
I have to say, so my life in general has not changed that much. So one of the few blessings of COVID is we didn't go out and socialize a lot before. And after I came out, we didn't go out and socialize again. I have celiacs, so we eat most of our meals at home. And so the day-to-day life has not really changed. But things like Web Summit, I really don't like being the center of attention. It gives me a huge amount of anxiety. And I remember going into Web Summit and thinking to myself, I am so grateful that I am not someone who gets buzzed off of being the center of attention. Because I could totally imagine that experience being addictive. And instead, it was just terrifying. Because there's 12,000 people there. It's a lot of people.
What about Washington, D.C., Francis? This is a big question.
Sure.
And you've got both sides of the aisle that are concerned about big tech and Facebook in particular. And yet they disagree about what the problem is, never mind what the solution is.
Yeah. One of the things I've been trying to do is kind of shift the conversation, because Facebook knows that as long as we think the argument is about censorship, is it too much censorship? Is it not enough censorship? As long as we focus on that as the conflict, we will never resolve it. But what Facebook knows is that there's lots of solutions that don't involve content, right? They involve the dynamics of the algorithm. They involve product choices. Should you have a multi-picker that lets you spam out to 10 groups at the same time, the same piece of content? Facebook knows they have all these solutions that aren't about content. And as long as we're arguing about censorship, we're not going to hold them accountable on these other things. And so the main thing that I think there's a point of common ground is, people on the left, on the right, believe that people have the right to make informed choices, right? That you only really can consent or voluntarily choose to do something if you have enough information to make that choice. And so I've been pushing for what I call nutrition labels. So the government doesn't tell us what to put in our mouths, but it does say, hey, if you claim this is in your food, it needs to be in your food. And you need to list how much trans fats is in it. And if you'll notice, the government never banned trans fats, but as soon as consumers had that information, it disappeared from all of our products. We don't have a nutritional label for TikTok. We don't have a nutritional label for Facebook. But the public has a right to have real data, not Facebook artistic data, but real data on how these platforms work so they can make choices.
We're calling it Facebook, but the company's renamed itself Meta. So should we be calling it Meta or Facebook, Francis?
I am trying to train myself to say Meta, because I know a big part about why they made this shift is they want to run away from the conflict. And the reality is that people are dying. Children are dying, right? There are going to be women walking around this country with brittle bones in 60 years because Facebook made choices to not stop its algorithms from driving women towards anorexia content. Right? This is a crisis, and Facebook thinks it can change its name and just focus on video games, and that it'll all go away. And so that's one of my goals in 2022, is to be able to say Meta and Facebook in the same sentence, because we can't let them run away from the damage that they're doing.
How would you say that in the same sentence?
You could say Meta's Facebook, or I could say Meta Facebook. But we need to make sure that, one of the reasons they did it was they know their employees feel ashamed to admit they work at Facebook. And now they can say they work at Meta. I have a backpack from when I worked there, And in tech, tech companies love giving you swag. You know, a t-shirt that says Google, a backpack that says, you know, Snapchat. My Facebook backpack had the Facebook logo on the inside. I never received a single shirt, hoodie, whatever at Facebook that said Facebook.
You mean they were concerned even at that point about their branding and the backlash that it might produce if you were wearing it in public?
Exactly.
Wow.
And I think that's a giant red flag, right? Like I part of my mission and like what motivates me every day is I know that people are suffering inside the company, right? Like not being willing to admit reality and the present is really hard. That cognitive dissonance is really hard. And I know that Mark Zuckerberg is suffering and that like every time you go into a restaurant and having people give you dirty looks, that has to be hard. And so we need to hold the company accountable and help it grow towards long-term success, because the current impasse we're in hurts everyone.
So what about Mark Zuckerberg, Frances? Is he a bad guy? Does he have evil intentions? How would you characterize him?
So I never am willing to call Mark evil. It's funny, when I appeared in front of the UK Parliament, there was a member of Parliament that was very insistent. They're like, but is this evil? Is this evil? And I think it's really important to remember that Facebook is full of very well-intentioned people. And I think it is a problem about incentives. And some of those incentives, you know, Facebook has a fiduciary duty to act in the interests of shareholders. And I think it's a lot harder to prove long-term harms than short-term harms. And so Facebook has been stuck in this cycle where when they are faced with these conflicts where it's like, you know, you could be 0.1% less profitable, or you could have 10% less misinformation. Because there is no mandated transparency, it's very hard to make the business case that you don't choose that 0.1% of profit. So mandating transparency gives another center of mass that gives space for people inside the company to do the right thing.
We'll be right back with more from Facebook whistleblower and data scientist Frances Haugen. Welcome back to Influencers. I'm Andy Serwer, and I'm here with data scientist and Facebook whistleblower, Frances Haugen. How close were you to Mark Zuckerberg and Sheryl Sandberg? Did you have any direct contact with them?
Nope, as they like to say, I was a low-level employee that I never sat in a C-suite meeting. I'm a data scientist. You know, I worked on civic misinformation and later counter-espionage. You don't become an algorithmic expert if you like being the center of attention. It's an invisible thing behind the scenes. But the reality is, in Facebook's own documents, I saw the magnitude of the problem, and just surveying operationally and organizationally how Facebook worked. Like I have an MBA from Harvard, right? There's a lot of things where in Silicon Valley, we undervalue the role of leadership and we undervalue the role of organizational health. And I think I had an opportunity to assess like what was the feasibility of change in a way that was different than a lot of people because I had that opportunity for that education. And I don't think there's a path to change inside of Facebook without the help of the public.
Right, and I mean, you wouldn't necessarily need to have access to those people to understand that there were problems there. And in fact, my experience there is when you get close to that, there's an echo chamber.
Oh, yeah.
Right?
Yeah.
And so I want to ask you, I've spent a bunch of time in Menlo Park, obviously not as much as you have on the campus. What was it like?
Oh, the Facebook campus is so fascinating to me as like an architectural object. So most people aren't aware, but Facebook has the largest open floor plan office in the world. It is 1/4 of a mile long. It sits 5,000 people. It is such an amazing, medieval societies built cathedrals because they were societies that were oriented around God, right? Like you have these Gothic arches that lead your eye upwards, like to the heavens, right? Facebook's campus is a physical manifestation of their obsession with flatness. Like the idea that we are all on the same level, that their leadership style is we have metrics and people can do whatever they want to move those metrics. Like we embrace the freedom of like individual employees. But when you don't acknowledge that power differentials exist, you actually reinforce those power dynamics. And I think there are things around a situation where flatness is obsessed over means there's actually not a lot of space for single leaders to come forward to say there is a problem or we need to make a short-term sacrifice for a long-term gain.
I think it was Orwell who said everyone's equal except some are more equal than others. And then that's not even acknowledged.
Yeah.
That's a fascinating point. I want to ask you about this question about whether Facebook...
Actually, can I give you one more little detail?
Sure, please.
This is fun.
Yeah.
To give you a sense of how absurd this space is. So Facebook is obsessed with 15 and 30-minute meetings. So like they're very efficient. They're obsessed with the word crisp. Like, are your documents crisp? Is your explanation crisp? The space is so large that I would regularly walk 15 minutes to go to a 30-minute meeting. And so even that level of absurdity that is more important for the building to be flat than to be functional for us to go to our meetings, it just kind of shows you the blindness of that religion.
And you've worked at other big tech companies. You've mentioned Google, for instance. How is Facebook different from these other companies, and is it better or worse?
Yeah. So I feel like there was more of an acknowledgement of users as equal stakeholders at other companies I worked at. So like Google, I don't know if people are aware of this, but Google is able to support, thousands of languages, partially because they built tools that allowed individual communities to move Google into their language. They said linguistic diversity matters at that level. And even back in the mid-2000s, like I worked on internationalization on Google Books, and like there was a real authentic commitment to how do we get into the most languages and adequately support them. Imagine if Facebook took the same attitude on safety, right? If they came in and said, we live in a linguistically diverse world, let's make sure all of the dialects in Ethiopia are covered. There's 100 million people in Ethiopia. They're having a civil war right now that is being amplified by Facebook. They have 100 dialects, 6 major language families. Imagine if Facebook, instead of being so closed, right? So Facebook has full control of their platform. They're the only ones that can see inside. It's full closed. Imagine if they said, we're going to take a page from the Google playbook and make tools that allow Ethiopians to actually make sure that all the safety systems work in all their languages. It'd be a very different world. And so there's little details like that where I think there's an opportunity to open up Facebook and say, you are the internet in most countries. 80 or 90% of the content in most languages in the world is on Facebook. Imagine if they came in and said, we actually acknowledge that power that we have, and we invite you to collaborate with us. We'd have a very different conversation right now.
We're going to take a quick commercial break. We'll be back with more from Frances Haugen, data scientist and Facebook whistleblower. Welcome back to Influencers. I'm Andy Serwer, and I'm here with Frances Haugen, Facebook whistleblower and data scientist. Do you think this company, Meta, Facebook, is in decline? I mean, part of the reason why the stock went down is because they had a decline in DAUs.
First time. They've never had one.
So what does that tell you about the future of this company?
Yeah. So I've said repeatedly, I view the work that I'm doing as in the best interests of Facebook. Like, it might not feel that way today, but Facebook needs help to make long-term successful choices instead of optimizing so hard on the short term. And like having an environment where people like being on the platform, where they feel safe, where they feel like they're getting high quality information, that is a path to long-term success. Until Facebook takes responsibility and is just honest with people, until they change their relationship with the public, I think they're going to keep seeing users leave.
Have you been in contact, or have top executives at Facebook been in contact with you, or have any executives been in contact with you?
Director level, but not above that. There's a lot of really good people inside of Facebook. And one of the things that I hope comes out of the work I'm doing is that they have more space to be able to act. Rather, the company's already said that they are going to invest some more money. I don't think it's enough. Like, did you know that they're doing $75 billion of buybacks? Isn't that crazy? Crazy. And when they say they're going to invest $5 billion in safety in the next year, it's like, well, yeah, but you lit on fire $75 billion. I mean, like, right. Could you have done $10 billion of safety? But my actions do open up space inside the company for those good people to be able to make progress. And so that's always my hope.
And what about the future of the internet, Frances? Big question. With,
I love that question.
It looks right now, for instance, simplistically, the United States, China, Europe. Is that going to be the future going forward, that there are at least three sort of geographies and distinct internets increasingly?
So I don't think, I think you're totally right that Europe is taking a different regulatory perspective. But in terms of networks, I believe if you look at it, I don't think Europe and the United States are going to isolate. So like when you say China does have a closed internet. And the thing that I'm scared about is Russia and China have made indications that they may kind of merge their closed internet. Like they're talking about building their own closed financial system. They're talking about having their own closed internet. And I think once you start separating the internet and separating the financial systems, that's where things start to get dangerous, because once you begin operating so independently, then you have opportunities for conflict. I think there's some really interesting conversations happening right now around the role of decentralization. So you might have heard of DeFi, you might have heard of Web3 or like crypto-based networks. And those are going to open some really interesting conversations, because this is software that doesn't run in the United States or run in Europe or run in Africa. It runs everywhere simultaneously. You know, it's applications that instead of running in a data center, they're all running in little kind of pockets everywhere on these decentralized networks. And so I think there's going to be unquestionably sometime in the next 5 years probably a social network where no one is responsible for it. And
is that good or bad?
It's a really interesting conversation. It depends how it's designed. There's ways of designing these networks where you do safety not based on content, but you do it based on the dynamics of the network. And if they make those kinds of decisions where they're like, oh, interesting, we're going to cut reshare chains at 2, right? So that means Alice writes something, Bob reshares it, Carol reshares it, and lands in Dan's newsfeed. Imagine if Dan had to copy and paste that content in order to share it. So he can't just hit a button, he has to copy and paste it. That change has the same impact as the whole third-party fact-checking program today.
So it sounds sort of like a social network kind of based on blockchain in a way.
It could be, yeah.
Right?
I think there's going to be one at some point.
I mean, I know you're a big, correct me if I'm wrong, crypto fan. Or
I do believe in the power of crypto.
Right,
yeah.
Right.
Yeah.
Talk about, I don't want to go way down that rabbit hole. We don't have too much time, but tell us why you're enamored of crypto and blockchain.
So I'm a big proponent of, actually, I always try not to give investment advice because people do ask me this question.
Okay.
I do think there are interesting opportunities though around, we're getting new models of how to run finance systems, like the DeFi networks. The rules are transparent. We all see exactly how they operate. And I think there are interesting conversations around governance that a lot of these crypto projects are experimenting with new ways of doing corporate governance, right? In terms of who gets to influence what decisions and how. And as someone who really values organizational design and organizational health, I'm intrigued to see where they go. But beyond that, I don't think I have enough expertise to envision the future.
I want to ask you about your background. You said you went to Harvard. I know you went to Olin undergraduate, grew up in Iowa City. Is there anything about your background, upbringing, you think that informed you in terms of the decisions you made to say blow the whistle? And
yeah. So I'm extremely grateful. So I attended the Franklin W. Olin College of Engineering. It's in the western suburbs of Massachusetts. It's near Wellesley. And it's a very small college. It's 75 students a year. But they believe that in order to be an impactful engineer and a responsible engineer, you have to have more context. And so Olin intentionally incorporates more humanities into their curriculum than most engineering programs. And they also incorporate design and entrepreneurship. And it's based on the idea that engineers that can go found successful companies are ones both that understand the dynamics of entrepreneurship, but they also understand people. Because really good leaders are people who understand what drives human beings. And so I think the fact that I had the opportunity to go to Olin gave me more context. I think the fact that I did high school debate and I coached high school debate, I've had to sit there and wrestle with 14-year-olds on how should society be structured. So think of your 14-year-old being like, that's not fair. And imagine having to teach them how to unpack that and be like, how do we have a conversation about why is it not fair? Tell me more. I think those things made me care more about democracy and what is the role of a technologist in a democracy. And so, I don't know. I think all those things influenced me.
And final question, Frances. What's next for you? And what do you see as your legacy, if it's not too early to ask that?
I love 5 months into my whistleblow. It's like, what's your legacy? My big focus in 2022 is around helping to plant a decentralized youth-led movement around social media.
Decentralized, I'm sorry?
A decentralized youth-led movement around transparency and accountability for technology. And so we are starting a college tour this spring. And the goal is around giving tools to young people, like basically educating them and saying, like, here are levers that we believe exist to either put pressure on Facebook or ways that you can build networks of resiliency. Because young people are dying, right? And until we can get Facebook to do the responsible thing, young people can make a difference by caring for each other. And so that's my big focus that I'm working on right now. And that is going to live under a nonprofit that we're in the process of founding. And the nonprofit is going to have two main focuses initially. One is planting that movement, which will eventually get spun off. And the second is something called open source integrity. So open source integrity is the idea that we, the public, need tools, assets that allow us to hold Facebook accountable. So that means our own data, right? Our own ways of analyzing these things, simulated social networks. Because right now, you can't get a master's degree in these safety systems, right? And we, as a civilization, need 10,000 more of these people minted every year. And so I want to figure out the tooling where we can have that be true.
Frances Haugen, thank you so much for your time.
Thank you so much for inviting me. This is great.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.